Hey everyone, Dave Putz here from JKP Holdings. Alongside me, as always, Mr. Nathan Turner.
Good day. Hello
We
there.
have a great guest with us today, but before we get jumping on the guest, Nathan, it's been a few weeks since we met the Paper Source. We had a great time there. We're actually able to interview a bunch of people. It was
Yeah.
awesome. What'd you take back from that whole experience?
Paper Source is one that it just kind of energizes me, where it's good to get with just everybody. It was great meeting with everyone and seeing everybody. Had some really good conversations. Actually, I got to talk to you a little bit later. Some ideas and some things we may want to look into. But great. It was great to get together and just to be with everybody. I spent an extra couple of days there because I had a different kind of a meeting, basically an investor pitch meeting. So we got a couple of new investors there, and yeah, it's great. Good times.
So, I came back with the energy as well, right? Talking to either new people or people that were in the same level as we are, but just the energy of being around people that we can really kind of talk shop with, right? And feel good about. I'm not big on travel, but it worked out really well. Well, it was great. We had a good, hopefully everyone got to watch the replay. And again, this will be on YouTube and Facebook and all that stuff and whatnot. But we had some really cool stuff that came out of it. Come the fall, we'll be bringing out some new stuff. But I agree with you. The energy was really good. And we got some really good compliments on I wish we had a recording of our presentation, but it was good.
But it was great.
So one thing we've learned is talking with other people either educates us on something we didn't know or experiences we didn't have. That's why it's huge to network with not just one or two people, but a lot of people and hear the different perspectives. For me, learning from people who've done it before is key.
Yeah. It's so fun when I talk to other people, and I've thought this for a long time, but with note investing, so much of it comes down to preference. And do you like this part of the business? Do you not like that part of the business? Do you like this kind of exit strategy or that kind of exit strategy? And there's so many options that you can kind of tailor it to whatever your preferences are.
And that's what makes it interesting to a lot of us, because we can all be in the same space, talk about the same deals, but because of our angles being different, we're not bidding on the same assets.
Right.
That's huge.
Not a huge competition, which makes it a lot of fun to get together. We can just hang out and be together instead of being enemies.
So with that said, one of the things that me and you are not great at, right, are second liens. We had some people on before talking about seconds, and they're a different animal. They're not the same kind of asset that we typically buy. And it's not right or wrong. It's just a different angle. And a lot of times, if we get a second, I'm going to be calling my friends up and saying, hey, listen, I got some questions here. Because it's a different mindset, a different thought process. In your experience, seconds, what's the big difference between first and buying seconds for you?
So I ended up buying, I think I've had 2 seconds in my lifetime. One of them was by accident, and then because I thought it was a first and it turned out to be a second. And then the other one was on purpose, but I actually had purchased the first and the second together. So the first, really. A lot of it, there's a few differences. Many times I like lower balance stuff. Typically on a second lien, it's not on a lower priced asset, a lower priced home. It's on a nicer home in a nicer area. And that's great. I find that seconds tend to be a longer term strategy typically. And you're doing a lot more due diligence on the person instead of the house. And with the first, it's reverse. I don't care so much about the person. I care much more about the house.
True. For me, you're right. It's all about the person and try and get that person to reperform. They really don't want to foreclose unless they really have to.
Yeah.
And I'm sure they deal with the big banks like we do when we're in first space and whatnot. So it's quite interesting. So, it was weird. We were down there in Paper Source and you forgot the people you talk to regularly to bring them on and talk about their stuff. Gerald, you've been someone in this space for a long time, right? You've seen the ebbs and flows of stuff, and your experience is awesome. We're envious of some of your experiences. So wanted you to come on and talk a little about seconds. Tell us a bit about how you got into notes, what introduced you to notes, what did you do beforehand? And now where are you at?
Sure. I worked in construction for about 30 years, heavy industrial, like oil refineries, power plants, municipal type projects, and it required a lot of traveling around. So I was looking for something to do that was closer to home and I could kind of switch careers. And I ran into a guy named Ward Hannigan, heard him speak down in San Diego. And he was talking about buying at the trustee sale. So I went and took his training and I spent an astronomical sum with him. I think I spent $4,000, which is, I'm joking about that. It was money well spent. I probably made a couple of $1 million off of the training I got from him.
Uh-huh.
And it kind of gave me an introduction into real estate and note investing. I mean, to me, note investing, it's not just notes. You have to know real estate as well. You have to know title, got to know, property valuations, bankruptcy. There's a lot of things involved in it, but that's where I got my first exposure. And then I went to one of Ward's, he does a reunion. Every year he'll bring together all of his students. And there was probably 200 people in the room. And Dean Engel spoke. And this was probably around 2003 or 4. Dean thinks it was 2005 or 6, but I thought it was a little bit earlier than that. But, it's so funny that Dean got up and spoke for a couple hours, and he had this book and tape set, like a CD or DVDs at that time.
Mm-hmm.
And it was like $1,000. It was called Note Buying Profits. And my wife punched me in the ribs. "You're not going to buy that, are you?" And I said, "Well, I don't know. It might be worth it." And so I did buy it. And, I bought so many book and tape sets over the years. A lot of them sit on the shelf. This one I bought. I used it. I dug into it. And I was kind of fortunate. It was one of those serendipitous times because a friend of mine worked over at Condor Capital. And Condor was a big hedge fund that was buying up a lot of distressed paper. They call it, scratch and dent stuff. And so he was trying to explain what he did. And I had gotten this introduction to note investing, this education. And so I was able to kind of put the two together. And for the first couple of years, I only bought notes from Condor. They were like my main source. I don't think I bought any notes from anybody else for the first 2 or 3 years. And part of what I did too, I was kind of like what do they call it? I was finding notes that I thought other people would like, and then I'd flip it to them and make a commission off of it. I might make $3,000 or $5,000 or, some dollar amount. And it was good because, I had no money invested. It was quick money. And it gave me a lot of education into the, what people are willing to buy, what they're willing to pay for it. And so that's how I got started.
That's interesting. So back in the early 2000s, was Dean's training, I'm just curious, was Dean's training more about seller finance deals, or was that
not at all? No, it was
really?
Institutional paper.
Really?
It was, yeah. And I joined a mastermind with Dean and them. After I did his book and tape set, he had started a mastermind, and I think we were paying like $300 a month or something. It was pretty cheap, really.
Yeah.
And Kevin Cardell was in it, and I don't know if you know Mike Rasica.
Yeah.
Krupe was involved in it. Jack Krupe was involved in it, and some other guys. But it was such a head start. I mean, it just gave me such a rocket ship into the note investing world, because we get on a call every week and talk about deals. And I remember Mike Rasica talking about buying some note with negative equity. And I'm thinking, why in the world would you buy a second with, the house is worth 200, the first mortgage is 250, and you're buying a $50,000 note for $5,000. Mm-hmm. And, I couldn't comprehend that. I couldn't put my head around that. But then it started to make sense to me, because we kind of followed that deal through, and he said, this is what I bought. And a month or two later, he's saying, this is what happened. And I made $15,000 on it.
Wow.
Off
and $5,000 purchase.
Yeah.
Impressive. Yeah.
So it helped me to understand And that's why I get into the concept of diversification. You know, I like to look at notes as a basket of notes, like a mutual fund. You know, if you got 1,000 notes and 1,000 stocks in a mutual fund, you're really looking at the portfolio return. You know, if I can get 18% of my portfolio overall, you know, I'm going to win some, I'm going to lose some, but I'm happy with the overall outcome. And that's really my target. That's what I shoot for.
Definitely. And that was part of me and Dave's presentation and paper source was they're not all winners. And you're going to get some that are stinkers and you're going to get other ones that are home runs. And awesome, you know, and it all balances out, hopefully on the positive side. But you're looking singles and doubles are mostly what you're going to be getting.
And that's okay. You know, in the beginning, you're looking for that really hype deal and you may get them while you're shooting for a double. That may become a home run. But, you know, if you're shooting for the home run all the time, you're also going to strike out a lot, right? You're better off hitting the singles and doubles and just kind of go through the motion, right? You don't buy in really bad neighborhoods on rentals and wonder what's going on. You want to buy in those BC neighborhoods, right? So you want to hit those good situations. When you first got involved, seconds were probably a huge thing because I know Mike was into them and, you know, a bunch of people were into it. Was first really not as evolved? Was it not as common to buy first? I know, you know, the big funds back then were Condor and you had what's called up in New York as well. So my head.
I know the one you're talking about.
Yeah.
You know, I bought firsts for a long time, for the first 2 or 3 years that I was in this business. And then I discovered seconds. And I remember Mike Rasica and I had a buddy of mine, a guy named Ellis San Jose down here in LA County. And Ellis and I were doing some deals together. And I said, you know, let's have a phone call with Mike and he can explain seconds to us.
Yeah.
And so we got on a little 20-minute, 30-minute phone call with Mike and he explained what he does with seconds. And I toward the end of that call, I said, you know, is that it? You know, is that all it is? And there's a lot of nuances. You know, there's a lot of things you have to learn to make seconds work for you. Things to watch out for. If you don't have the education, I'd be careful putting too much money into it. But you know, first have been around, they're still around. I just have had much better results on seconds. You know, I've got seconds that I bought and have received 20 times what I paid for it. You know, I bought a second in my IRA recently. I paid like $4,000 for it, and I just collected $96,000 on it. It was a hidden gem. It was a, you know, diamond in the rough. You know, people didn't know what they were selling, and I took a chance on it. I didn't know for sure what I was getting, but I figured, hey, I'll throw $4,000 at it, and we'll see what happens. And it happened to just pay off.
So I'm looking at some of these, you'd sent over some slides and we can get on to it if you guys want, but one of the things I saw in here, like, here's one of the things that I can't wrap my head around with seconds is you say like, it could be 3 or 4 years before you start to see return on that. And to me, I'm like 3 or 4 years, I need money now. And so it's hard for me to justify buying something that, you know, there's a good chance that I won't see anything from it for a couple of years. And granted, that happens with first from time to time, but that's more the exception than the rule. Is it how common is that on a second that you're not going to see anything for a while?
It's probably maybe a third of the notes I buy are long-term investments. And I know that when I buy it. But if I buy a $100,000 note for $5,000 or $10,000, I can afford to stick it in the file cabinet, let it sit there, and I pull it out and look at it once every 3 or 4 months or 6 months. I got a friend out here in California named Brucks, and he bought a lot of seconds over the years. And he'll stick them in his trash pile. You know, he call it his trash pile, and they'll sit in the file cabinet, and you pay cheap enough prices for them, and you look at it. And but I've had a lot of seconds where I reconciled it within 6 months. You know, I bought a second on a house in Burbank. It's one of the slides in that thing I sent over. And I paid $70,000 for it, which is, you know, a big chunk of money. but the house was worth 800 and the first mortgage was 400. And so I bought a second mortgage where the payoff was like 170 or something like that for $70,000. And I ended up approaching the homeowner saying, you know, do you really want this house? And he said, he was 75 years old. He's like, no, not really. My grandkids are up in Sacramento. I want to move to Sacramento. So I said, well, how about if I just give you cash for keys, you move out, and I'll give you, I think I gave him $20,000 to move out, which is a pretty good chunk of money.
Yeah.
But there was so much equity in the house that I could afford to do that. So I gave him $10,000 down, and I had him sign a deed over to me that day. So I gave him half the money up front. He signed the deed. I went down the next week and recorded it. So I own the house, subject to the first mortgage. And his first mortgage is fixed at 2%. He got a modification on it. So this is a house that we're going to hold as a rental. And so I gave him, he had like 2 or 3 months to move out. I'm not in any big hurry. I said, you know, take your time, get everything packed up, move it to Sacramento. Let me know when you're ready, and I'll give you the other $10,000 cash. You know, you hand me the keys that day, I'll hand you a check for $10,000.
Yeah.
So that's what happened. And the guy's very cooperative. We're still friends today. I helped him, he helped me, and I got a great rental house. I'm getting $5,000 a month rent on that house. And the first mortgage payment is $1,600 a month.
Jesus. Interesting.
Yeah. So there's so many exits on second.
I'm gonna try to see if I can get that up. It is in a PDF format. Let me see if I can get it up without any craziness, but let me see if I can do it. So everyone who's watching live.
Yeah, scroll down and it'll a little further down. And this is a good one. And, you know, Arnold Palmer, it's a funny thing. The more I practice, the luckier I get.
Yeah.
You know, that's the thing within seconds is that the more deals I do, the more home runs I'm going to hit. You know, if I'm real reluctant, I'm not doing that many deals. I'm not getting the hands-on experience. I'm not getting I'm not down in the trenches doing the deal. So keep going.
Stuff to watch out for. And this is another thing that I get, where is it getting stripped out, stuff like that. That kind of thing just makes me panic when I think about, I don't want to get stripped. Like, for heaven's sakes, I just put money in this.
Why don't you describe a little bit what that means? Because a lot of people are very confused about what strip means.
Yeah.
Well, if the homeowner files BK and there's no equity over the first mortgage, suppose the first mortgage is $200,000 and the house is worth 185, then they can strip the lien. But you have to be aware of that when you buy the note. You know, and a lot of times I buy notes with no equity. I'll buy notes at 140% loan to value, but I pay a lower amount for it. And those are the ones I stick in the file cabinet, and I don't look at them. I look at them once a year or once every 6 months, and I don't take any action until the first amortizes down, you know, the balance on the first goes down significantly, or the home value rises.
Right.
And that has really paid off for us in the last 2 or 3 years.
For sure.
You know, with low interest rates, so many people are refinancing their houses and equity's going up, that we've gotten payoffs on loans that we bought for small amounts of money, getting really large payoffs. But the lien strip, it just means that if the homeowner wants to go out and file Chapter 13, they can't do it in the Chapter 7. They can only do it in 13. And if there's no equity, they can have the lien stripped. It's called motion to avoid lien. It's the legal term you'll see on the docket report. So I had to become real familiar with Pacer. You know, I'm on Pacer almost every day looking at stuff, checking notes. You know, we still have close to 300 notes right now. And we're still dealing with some bankruptcies, but I've had some of my best loans were bankruptcy loans. You know, it's just, and once you know it, you're familiar with it, it's not a scary thing. and there's a lot of opportunity there. You know,
So
I got a
But let me just jump in real quick. A lot of people get confused when you strip a lien. Does that mean you can't foreclose on them? Does that mean that the lien is gone? What does that mean for the investor?
it means your lien is unsecured and you can't foreclose on it. But you probably will get paid something. You know, I had a lien strip happen down in South Orange County, San Juan Capistrano, and we bought the loan for about $15,000, and we ended up collecting about $20,000 over the 4 years. So they pay you like credit card debt. You know, there's different levels of debt in a bankruptcy. There's secured debt and there's unsecured debt. So we still got some money. You know, we got our costs back plus a little bit. It was still a break-even deal for us, but at least we didn't get completely wiped out. So yeah, when they're lien stripped, you can't foreclose on it. It's basically unsecured at that point.
Interesting.
So obviously,
one of the other ones.
Go ahead, you mean go back up?
One of the other ones is statute of limitations. So, and this is again where I'm trying to reconcile the two things, because on the one hand, you're saying you just stick it in a drawer for a couple of years. On the other hand, you're saying beware of statute of limitations. So, but if you stick it in a drawer, aren't you just tempting fate there?
No, we have a spreadsheet or like a Google Doc sheet with all the statute of limitations for each note.
Okay.
And we kind of target that. But in California, it's 10 years after the maturity date.
Oh, wow.
So if you got a 30-year loan that matures in 2056, and you got 10 more years after that. So the statute of limitations is way, way out in the future. But we have gotten burned by this. In Florida, I think it's 10 years after the maturity date, or 5 years after the maturity date. So we just got burned on one recently. And what we ended up doing is we routinely send out discount letters on loans that we can't necessarily start foreclosure on. So we'll send out a letter with 4 options, you know, a full payoff. You know, the balance might be $100,000. We might have bought it for 5 or 8. And so we'll give them a full payoff at say $25,000. And then we'll say, or we can finance it interest only for a year at 7% to where the payment's, you know, $300 or $400, whatever. Or we give them an option to pay it fully amortizing over 20 years or 30 years or down payment. So we'll list out multiple options and let them know that even though you owe me $150,000, you know, we're willing to take $25,000 because we bought it so cheap. And so a lot of times we get phone calls or emails or letters from the homeowner say, yeah, I want to talk more about this. And it all has to do with us, you know, buying these seconds for 10, 15, 20 cents on the dollar.
Yeah,
So,
I mean, we have a full chart of, you know, statute of limitations because every state, I have 1, 2, 3, 4, 5, 6, 7, 8, 9 pillars for statute of limitations, right? From maturity date to last payment received to due date and all that stuff. So you're right, there's different pillars. All you have to do is flag it, right? When it comes up, when it's getting close, it's not that it's the end of the world. Usually there's a way to kind of negotiate. Maybe you do a mod agreement. Maybe you do something to avoid that problem. Or you make an action, right? Some states let you forgive stuff, you know, like Florida. So let me, you know, lack of patient remediation, that's a huge one too. I think people miss out on. And the reason is that if you're in a bankruptcy, you need approved every payment from the origination to now. A lot of times you get a loan with, you know, the last 2 or 3 years of payments, and that's it.
Yeah, you mean foreclosure, right?
Yeah, foreclosure.
Not bankruptcy, but foreclosure.
Sometimes bankruptcy too. Sometimes bankruptcy will ask for that. They contested what the legal balance is, but yes, you're right.
But, you know, my strategy on this is like, we have one right now, same situation. My asset manager said, Gerald, do you want to start foreclosure on this? We don't have any pay history. And I'm like, well, yeah, let's go ahead and start foreclosure. Because a lot of times, once we file the first document on the foreclosure, this is a Florida loan, the homeowner starts to freak out and say, oh, shoot, I'm going to lose my house. And, you know, we might have mailed them 10 letters already. They throw those letters in the trash. But when they get that letter from our lawyer, this like demand letter saying that, you know, if you don't pay us, we're going to start foreclosure on your property and you have 30 days to think about it. And then if they don't pay us, then we file the first documents related to the foreclosure. And we're just trying to get their attention. You know, we only complete probably 10% of the foreclosures that we start. You know, we might start 100 foreclosures and we only take 10 of those to completion, where we actually have to own the property or take it to a sale where somebody pays us off, you know.
See, and then on just to contrast that, on the first side, if a person is living there, same kind of thing, maybe 10% of those, maybe that we actually bring to completion. If the property is vacant, then that's a different story. On a second, that's going to be a different thing as well. But if it's vacant, then I'm going to foreclose because it's vacant. And what else am I going to do?
There's no emotional equity there.
Yeah.
Right. Yeah, they've left.
I heard about the term emotional equity starting back in 2008. You know, and I think a couple people, maybe it was Gordon, mentioned it at the paper source this year. You know, and I forgot to continue thinking about that.
It's a powerful thing.
Yeah.
Obviously, you're talking about mortgages, deed of trust, depending on the state, seller carryback. We did a webinar with Tracy a few weeks ago, and the number of seller finance last year, which we can't figure out why, was dramatically high. With all the house selling and all the money out there, it was crazy. Scratch and dent. For those who don't know what scratch and dent is, it could be numerous things. It could be the fact that the person didn't give all the information on their forms. When they submitted it for the application for the mortgage, they could have bought a car, any kind of numerous things. They didn't have all their tax returns, all that stuff. Could be all over the place. This is a nice place. I'll live there, right? So here's some examples that.
Let's stop on this slide for a second.
Yes.
This is we foreclosed on this from second position, and we took over payments on the first mortgage. And we held it as a rental for 7 years. So that doesn't quite fit your model, right?
Mm-hmm.
Do you think we made money or lost money on this deal?
So yeah, a situation where your income was 120, your expenses 144, and your gain loss of 24,000 just based on the numbers. You lost 286 a month.
Right. We lost 24,000 over 7 years on this house.
You know, numbers tell you have to have lost money.
Well, go to the next slide.
Not a bad return.
You're kidding.
Yeah, I mean the price when we bought the note, the house was probably worth maybe $300,000.
Okay.
Here's your key right here.
Yeah, we paid $17,000 for the note, and we held it, and we ended up with a 23% annualized ROI.
Do you remember what the UPB was on that?
Not really. I think it was in the $100,000 range. You know, we bought this note for us 2011, 12, 13, especially 2013. You know, in 2013, we spent $3 million on second mortgages.
Wow. Good time to buy.
To buy and hold, you know, to hang on to. And the average pool price at that time was like 12 cents on the dollar.
Yeah.
You know, so we lucked out. We just happened to hit it right where we had the capital available. I did some joint ventures with people, and we still have those investors today. Most of them, we're still, you know, we're still going through our loans. But we made $330,000 profit on this deal.
That's nice, really nice.
That's amazing.
Oh, so cool.
So this is a very confusing one for a lot of people, right? When a first may not be a first, or when a second is actually a first. Just before you dive into this one, I want to explain people why is a first and second a second. It's literally the order of the county records. If it's recorded first, it's a first. If it's recorded second. You could be in a spot where the second was recorded first and the first recorded second in your eyes, right? Most time when they build a house, they have to record that trust and they move it over, or do a piggyback. So yes, it could be flip-flop. Can you share a little bit about when a first may not be a first?
Well, in this case, it's a very unusual. I mean, I've been through hundreds and hundreds of these deals, and the county recording shows this loan to be my loan in first position because the document ends in 627. Then there's another second mortgage right behind us ending in 628. So if you go down to the county records office, recorder's office, you'll see these two loans in the sequence. Mine was 627, theirs was 628. So I just assumed, hey, I'm in first position, no doubt about it. And it turns out that the original intention was for my loan to be in second position, but they recorded the documents incorrectly.
Oh.
So it's a big mess. I've been in litigation on this for 3 years.
Yeah, there's ways you can reverse it, but I'm presuming you don't want to reverse it. If your second's actually your first, I mean, I would stay there, right? If you can.
Yeah. It's an ongoing legal, so I don't want to get too deep into it.
Yeah.
They finally came to me last week with an offer to buy us out that is about a third of what I was looking for. So we have to counter offer, but we are making a little bit of progress because Fidelity, First American Title is the company that's suing us actually.
Oh, really?
They're because the other party had title insurance, so they filed a title insurance claim, and it's a long, convoluted story. I've already had 4 different lawyers consult with me on this. I've got one primary lawyer, then I've had some other guys that were, what do they call them, expert witnesses, to help resolve this case. And we've already gone through one mediation, and we're probably going to go through another mediation. So anyhow, it's a messy deal. Most people are not going to run into this, especially we paid quite a bit for this loan. And so it's kind of, on the expensive side.
We have a property, it looks like it's in no man's land.
Yeah.
Right.
And that's part of my due diligence when I look at notes. I like to buy notes in cookie cutter neighborhoods.
Yeah.
But if the price is right, I'll buy something in the boondocks. This is like, out in the, I've gotten stuff in Minnesota, out in, 10,000 lakes, Minnesota, but.
I typically look at the city or the town even, but population over 20,000. Because I figure if I take it back, selling a house in a 5,000 person neighborhood is tough.
Right. But, everything is worth something at the right price.
Absolutely.
If someone gives you a note for $1, would you take it?
Oh yeah, of course.
So
I would do a little bit of due diligence on that, but in general, yeah, for sure.
Yeah. So
if the taxes are,
let's look at the next slide.
50,000,
Yeah.
maybe not.
So there's a junior payoff.
Yeah. Again, this is one that we had to start foreclosure to get their attention. I bought the note for under $3,000, July of 2018. We didn't start foreclosure. We sent numerous collection letters. We made phone calls. We had the property door knocked, and they never responded. So we start foreclosure. A month after we start foreclosure, we get a phone call from them. What do we got to do to clear this up? So we sent them a payoff statement, and they didn't even negotiate with us. They paid the full amount. Normally they would come back and say, well, I can't pay $96,000, but I can give you $50,000. Would you take it? And in this case, they didn't really negotiate. They just paid us off. We get a check in the mail.
That's a little bit of a return there. I mean, anyone who's watching, who wouldn't exchange $2,900 for just over $96,000? Right? That's a decent return. And you said this happened in about 2 years, right? Oh, you bought it in 3 years, you bought it and turned it around. Not a bad ROI on that one, right?
Yeah.
What's the next slide look like? Did I do any numbers on it? Yeah, so here's the numbers. 108% ROI.
Yeah. 32 months. Yeah. Okay.
And if you're going to be a note investor, you really have to learn how to use a financial calculator, and you have to learn how to do IRR, internal rate of return. Uneven cash flows.
Yeah.
I've taken
real quick, just for people who don't know, IRR is even cash flows. XIRR is uneven cash flows, right? That's the way you figure out. So sorry, go ahead.
Yeah. My mentor that's taught me so much about calculators is a guy named Gary Johnson and Clyde Wilson. and they have a class called Financial Freedom. And if ever you get a chance, go take it. It's a 3-day class on using a financial calculator to figure out, what you're doing with your money,
Cool.
and it's well worth it. I've taken it 3 times already over the last.
Yeah, I use net present value and XIR all the time. That's how I make offers. That's awesome.
Yeah, I'm pretty good with the calculator. I'm certainly not a beginner, but I could use some brushing up, that's for sure.
Yeah.
Get into that advanced category.
We're flying over to Vegas now, it looks like.
Yeah. Oh, and this is not really a note deal, but it was such a good deal, I had to throw it in there.
Yeah.
And it's notes in real estate, like Garden Moth talks about. It's notes in real estate. And this was a letter that I mailed. In 2015, I created a private note holder list for notes in California, and I mailed out 7,000 letters to people offering to buy the note. And I got 400 or 500 responses, and I think I bought close to 200 notes out of that mailing. And this is
a great return.
Yeah, it was an awesome return.
What year was this?
This was 2015, but the Burbank property that you saw, the one we did earlier.
Yeah.
I mailed that guy a letter in 2015. 5 years later, he called me up and asked me if my offer was still good.
Whoa! You only one letter you sent to him?
I only sent one letter to him.
Wow.
But he called me up and I made him an offer, $70,000 for that note. And he said, nah, I think I'll hang on to it a little bit longer. And he must have had a change of heart, or, his financial conditions changed. But he called me up 5 years later, and I ended up buying that note from him for the same offer I made 5 years earlier. And it was actually worth more because the equity had gone way up.
Yeah.
So anyhow, this Vegas deal was a result of a direct mailing. And the seller was a court-appointed, like a conservator or a custodian.
Okay.
It was his job to liquidate the property. So he said, I don't have a note. I got your letter and I don't have a note. That note's already gone, but I have a property that I need to bring to auction, and it's subject to a life estate. So you guys, you know what a life estate is?
No, I don't.
Basically, the lady has the right, she's 94 years old. She has the right to live in that property until she passes away or moves out.
Okay.
So it's like a subject to deal. One of the conditions of the deed that I get, so the property actually transferred to me in September 2016 for $40,700. The property was worth about $175 at that time.
Wow.
But I don't have possession. I only have title. So I can't walk in the house and do whatever I want with it.
Weird.
I had to live there. I had to let her live there per the conditions of the deal. And you don't know. I figured she might live 6 years or 8 years. That was kind of when I did my calculations using my financial calculator. I figured a reduced value. I had plugged in the value at like $150,000, and I thought I might have to hang on to it for 8 years, something like that. So that's how I reached my top bid number.
She didn't pay you at all. You just got discount because she's not going to make payment. She's going to live in the house you have title to, but she occupies.
She doesn't make any payments. She has to pay the taxes and the upkeep, any maintenance, property taxes, utilities are all her responsibility. And I have the right to go inspect the property whenever I want to. So once or twice a year, if I'm in Vegas, like for Paper Source, I would schedule an appointment with her and I'd go by and take a look at the house. Wow. And make sure that, the roof wasn't falling in or the plumbing wasn't backed up and there's, sewage all over the kitchen floor. But she kept it immaculate. The house was really well maintained.
How did this house, did it go to foreclosure auction or?
No, wasn't a foreclosure. The sale was held on the courthouse steps in Utah, and there was only me and 2 other bidders.
But what was the legal action that caused the auction?
It was a court appointed, like a receivership.
Okay.
She lost a lawsuit. You know, so her
Oh,
family, her husband or her son or whoever it was, got sued, and they lost the lawsuit.
gotcha. But
And
she's
so
last.
part of they had to liquidate the assets. But the judge was nice enough to say, okay, I'm not going to put you out on the street. You can live in this house for this length of time, but you're not going to own it anymore.
I never heard of that. That's interesting.
Yeah, that's a new one for me.
Yeah.
Yeah. So it's a life. It's called a life estate. And Pete Fortunato talks about that. He's had a couple of deals where there's a life estate involved.
Yeah.
And so anyhow, so they notified me in November of 2020 that she's moving out. And so I went over there and helped her move out, and got her relocated to Denver. I just packed up the U-Haul and they took off down the street. And then we fixed it up and sold it for $310,000. So if you look at the next slide, it'll show the numbers, I think. So that's the numbers on it.
I can live with that.
Yeah, no kidding.
So I only had, for the first 4 years, I only had 40,000 invested in it.
Uh-huh.
And then later I had to do rehab and closing costs and commissions. So at the end of the 4 years, I ended up having to spend another, $50,000 to get the house ready to sell and sold.
Cindy Coleman mentioned it. She actually ran across one. How did this come across your desk? I mean, I don't think I've ever seen email.
Huh? You
How
talking to
did
me?
this come across your desk? Like, how did this come through an email? Like, life estate sale? Like, this come from?
No. Like I said, I mailed a letter to the court-appointed custodian, a court-appointed receiver.
Okay.
Yeah.
This guy was given the job. He does this. He's a professional, like, liquidator, basically.
Gotcha.
He gets assets and sells them. So he had a note, and I mailed to him, and he calls me up and says, "Hey, this note is gone, but I have a property. Would you be interested in bidding on it?" And I said, "Yeah, I'll bid on anything real estate related. Whether it's a property or a note or a, mobile home, whatever,
So you and two other guys at the auction, were the other two guys interested at all, or did they not know what it
Well,
was?
we bid it up, and when we started off, I did the opening bid of $1,000.
Wow.
And then somebody else says, okay, $1,500. And the other guy says $1,800. And then it kept going up and up and up until we got to 40,700 was my last bid, and everybody else dropped out. They didn't go any higher.
Wow.
How many other properties were there for sale at the auction?
Just this one.
Okay.
Really? Wow, that's interesting.
Yeah. Hey, guys, drop your comments below if you've ever dealt with it. I've never seen it. It's pretty interesting. I'm sure it's rare, but that's cool.
Very interesting.
I know we have a bunch of more slides. Gerald, do you want me to skip it through anything at all?
Well, you can brief. This is the one where I mailed the guy the letter, and 5 years later we bought the deal. This is the one where you can scroll down a little bit. This is in the middle of rehab. Go back to that picture. See, that back unit was an addition to the property. The front part is the 3-bedroom, 2-bath, and the back part is a 2-bedroom, 1-bath.
Oh.
And so we ended up splitting it. We closed off the doorway in between and put a new door in the back, and we now rent this out as like a duplex. So we get $3,000 on the front unit and $2,000 on the back unit.
Oh, nice.
So you can go down next slide. Just touch the numbers real quick. I've already pretty much discussed this part. Go to the next slide. Yeah, so this is the numbers on that. We spent a lot on rehab. The house was old and dilapidated, built in the 50s, but it's something that we're going to hang on to for the rest of our life. I think, it's a great rental property, makes great cash flow. And today it's worth probably $900,000.
Yeah.
You bought for 70.
Oh, that's awesome.
You put 90 to this, and then rehab for this much money, and then I guess you paid off the first.
No, I'm making payments on the first.
Oh, okay.
It's subject to. We just take over the payments on, and this is the one that's fixed at 2%. That loan will never go up. It's always going to be $1,600 a month for the next 30 years.
Fantastic.
Boy, oh boy, that's a nice purchase right there.
Yeah.
Well done.
And this just shows the amortization. I always create an amortization schedule. So as of 5/1 of 20, the balance was 396. If I looked at it, it would probably be 375 or something like that.
Right.
But the
And
nice thing,
this is a good opportunity to show people what this looks like. What does this look like for those who may be newer? What do these columns mean and why they change, right? So do you want to quickly share a little bit about that? What do the columns mean? Why do these two change when everything else stays the same kind of thing?
Yeah, this is an amortization schedule. And this is an Excel spreadsheet that we built. And you can crunch the numbers. The spreadsheet will do it for you. It'll break down the payments. If you amortize whatever the starting balance was, 493 over, I think the term was 40 years on this one.
It was 35 according here.
35. Yeah. 35 years. So 420 months. And it'll break down the payments by principal and interest, and it'll show the new balance.
Yep.
So that's the date of the payment due. So this date payment was due 5/1 of 20. It's the 109th payment in that amortization schedule.
Sure.
And the payment amount is not going to change. That's always going to be 1634.44 because it's a fixed rate loan. And the interest and principal are going to continue to change. Every month will be slightly different, and to where the balance goes down. But one thing you have to really look at the amount of principal we're paying down every month. Yeah, almost $1,000. I think right now it's over $1,000 of principal reduction. So the portion going to interest is getting smaller and smaller as the loan matures.
Sure. And that's why a lot of times the beginning of the loan is very valuable because of all the interest and the interest at the beginning. At the end point is the principal's gone. So I know we have a bunch more slides. Do you want me to skip to a particular property or a particular slide before?
It doesn't matter. We can, wherever the conversation goes. I know you guys are running out of time.
So let's back up for a second, right? You bought a lot of seconds. What are some of the things you screwed up on? What are some mistakes you've made that you say, crap?
Well, first thing that comes to mind is like on that Oceanside property that we held it for 7 years. The lady was trying to get a loan modification on the first, which would have dropped her rate from like 6% to 4% probably. And I think I pulled the trigger a little bit too quick on the foreclosure. If I'd have let her go ahead and get her loan modification done, and then foreclose on it, I would have had a lower monthly payment. But then she might have paid me off too, anyhow. So, I think as far as how
about due diligence? Have you ever made a mistake that you've learned from that you say, listen, I can't do that again?
Absolutely. Sometimes we get a pool of 100 loans that they want us to give them a price on. And you can't, when you're looking at 100 loans, you can't dig deep into every single loan.
Nope.
So we plug in a number to each loan. We might have taken a look at bankruptcy or at the credit report, different things that we look at, and then we wing it. We have to provide a number within 7 days or whatever it is, and we can't take 2 months to go through the tape. So, we could have done better due diligence, I think. If you go back to things to watch out for in my slides, let me just scroll up. I got that up right now. Unscrupulous note sellers, be real careful. I've got one guy that I bought notes from 5 years ago that still owes me like $30,000, and it's just not worth getting an attorney and trying to go after him. I think we spent $1 million on a deal, and so he owes me like 3%. He's still, it's a small amount of money. But ask around, make sure you know reputations from people. Because I got a friend that wired off $1 million to buy some loans, and he's still fighting them in court. He's never gotten his loans. So, when you're buying notes, there's no escrow. It's not like buying a house where you open escrow or, over at this local title office. you're trusting people to deliver what you're buying. And, it doesn't always happen. I think I had something on my list about low yield monthly payments. So we bought a note in close to here, Bellflower, California, and the monthly payment was fixed at like $325 a month. Mm-hmm. And we paid $90,000 for a note where the balance was like $150,000. And my partner said, he thought we were going to get the house. And I said, hey, we might not get the house. He said, that's okay, I'll take the chance. And technically those guys could have paid us $300 a month, which is $3,600 a year on a $90,000 investment. So if you just do a cash on cash, $3,600 divided by $90,000 is 4% interest. The yield would be 4%.
Yeah.
Fortunately, they ended up defaulting. I mean, they paid us for a while at $300 a month.
Yeah.
But then they ended up defaulting, and we took it to foreclosure. And somebody else, it went to third party. Somebody bought it at trustee sale, and we ended up just getting cashed out. But be careful. Don't always assume that you're going to get the house back. That's my whole point of saying that is don't always assume you're going to get the house back. Right. A lot of times they'll just make payments, even though you think it's unlikely. They'll get the payments made.
Or they'll reinstate when you thought there's no way they're going to reinstate that.
Yeah,
exactly.
And they do, and you're going, oh shoot.
Exactly.
It's the assumption that what's going to happen before it happens. I think a lot of people make the mistake and assume things are going to happen based on the fact that what they know of.
Yeah, and one of the things that we've done is we have good systems. We use a CRM called ACT. And all of our notes are in ACT, all of our histories, every phone call we make, every letter we send out, it's all plugged into ACT. And we have a small office. We have 5 people in the office, myself, my wife, and 3 others. Mm-hmm. So we have an asset manager, an admin assistant, and a bookkeeper, a full-time bookkeeper that does a few other things. I mean, she only works about 25 hours a week, but she's still considered, pretty much full-time. And, it just helps so much to have good records. We plug everything into QuickBooks. Every loan we buy has its own, it's class accounting. So every loan has its own profit center, basically. So all the charges, all the income and expenses go against that individual loan. And we can run a report on that one particular loan. And then we use Mortgage Office. We use a light version called Loan Office to do all the amortization schedules and statements and coupons. And that's one of the best things we did. We were trying to use something like NoteSmith prior to that.
Okay.
And it just wasn't up for the task. If you got a handful of notes, if you got 10 notes, it might work fine. But if you got 300 notes, it's too cumbersome. So, if you're wanting to start out in this business, in the beginning, you can get by with spreadsheets and stuff. But if you ramp up and end up with a decent volume, get the right software to be able to track your notes. And we self-service a lot of our notes, probably 75% of them.
Wow. Is that just to save money or control?
I think it's a combination of both. It's a little bit cheaper, and then I think we have more control over it.
Okay.
Yeah.
We have a lot of notes in our account. I've got about 100 notes between my account and my wife's account in our IRAs. Okay. So all of those notes we put with the servicer because we don't want to take the chance of getting like a prohibited transaction.
That's a key. Yeah, I do the same thing.
So all those notes, almost all of them. I mean, there's some notes that we bought real cheap and they're pretty much inactive. So we self-service those notes. They just kind of sit there in the file. They're not doing anything. But if we decide to start collection on it, then we'll move it to a servicer before we start collection.
Interesting. Yeah, that works.
So we have some questions. If Nathan, I was fixing some stuff I apologize.
Yeah, you bet. So Cindy Coleman, she's asking about a course or a person that you can learn the seconds business from. Or you don't teach, do you?
I don't teach, and Dean's not teaching anymore either. And that course that he did is not available as far as I know.
Right.
You know, so, you know, Rob Heitha does a really good job. He has some good information on his websites, you know, if you don't mind me mentioning that.
No, absolutely.
He's a good guy.
Fixed Notes, Fixnotes, Fixed Notes. He has a great program. I'm part of his mentoring group. You know, I pay X dollars a month to sit on a phone call once a month. And we had our call yesterday. And Rob's a young guy, probably less than 30 years old. And I've known him for 10 years, does a really good job, has a lot of experience. So I don't, you know, Mike Rasica does a mentoring program, noteconference.com. So I like Mike, he's an awesome guy. Those are the first two that come to mind as far as, you know, the one thing I would say is stay away from the guys that want to get you into a mentoring program and it starts at $25,000 and the platinum level goes up to $50,000.
Yeah.
Don't do it. You know, it's just not worth it. I don't think, you know.
I agree. Go out and buy a note, get some experience.
Get some hands.
That's better. Yeah.
Yeah, it's really going through the motion, right? I tell everyone, you know, when you go to college, right? You go here, you spend all the money for college, and you get out with no money. You just came out with skills, right? And now you can make the money with the skill you learn. Same thing with buying the note. You buy that first note, you learn everything you need to do. So then maybe you lost your money, maybe you made some, maybe you broke even, but then you now have the skills to go buy notes. We run our own mastermind too on a weekly basis. We have some really cool people just talking about high level stuff of different angles, different, you know, positions, because everyone's different. Everyone's different mentality is awesome. I know that it for seconds, you know, for quants out there, but I don't know of any training programs out there per se that's particular on seconds.
Specifically.
I think Rob Heitha's program is covers seconds really well. And Mike is primarily a seconds guy.
Yes, Mike, absolutely.
Some of the first notes I bought were from Rob.
Really?
Oh, really?
Yeah, way back when.
Was it through USMR?
I think so, back then, yeah.
Yeah. He worked at USMR for a long time. He still does, but more as a consultant.
Does he? Okay, good.
Yeah.
I bought my first through Gold, Mark Gold. So that was my first purchase was through Mark Gold. She was not in the business anymore. So
yeah.
I know Mark. Yeah. So my first seconds were through Coast Capital.
Yep.
The Madden.
Yeah. DA. Yep.
DA Madden, Trinity.
Yeah.
Which I don't think they're around anymore. I haven't seen them.
Yeah, no comment.
So we do have another question for you. You know, what resources and services do you use to operate the business, and one of the most important service you use? That's a general question.
Yeah, and I think I covered that. I'm not sure if I cover that in these slides or if the other slides I do. But we use, like I said, we use a CRM. That's something that we have 5 people in the office, and everybody can input data. You know, if a check comes in, we log it into the history. You know, we got a check for $318.42. And it shows that CRM shows the first mortgage, what the balance is, the date of last payment, when we last checked it, things like that. And then we have another box that shows our loan, our second mortgage, and what the monthly is, what the date last paid is. So we keep track of everything, and we can run reports on that as to, you know, if we want to see the delinquent borrowers, we can run a report that'll show everyone who's more than, say, 30 days delinquent. So ACT is a really strong tool. Loan Office is another one.
What CRM is that? Do you care to share which one you're using?
ACT, Sage ACT. And you can, some people use, I forget the name of the Salesforce.
Salesforce, but that's huge. I mean, that's a
big one.
Well, ACT's the same way. You know, I just spent $1,500 to upgrade ACT from, you know, version 21 to version 23. You know, but it's worth it. I mean, you know, I couldn't live without it. And you know, in hindsight, Mortgage Office might have done a lot of what we do in ACT, but I don't think it doesn't keep track of the opportunities and phone calls and people that want to sell notes, things like that. All that gets plugged into ACT. So that's one software. The second software is Loan Office. You know, ACT is CRM. You can use Salesforce, whatever. ACT is the CRM. that is very valuable. I mean, and then loan office does all of our amortization schedules, statements, coupons, everything we want to do with mailing out statements to people. That all goes through loan office. And then QuickBooks would probably be the next one. You got to have good accounting. You know, we have to file our taxes every year. We used to have 12 joint venture partners.
Wow.
Now we're down to about 4.
Yep.
And so I send out quarterly reports to them.
Yeah.
We split money, you know, once a quarter. We take whatever's net after expenses and I'll distribute it between us and them. So Excel, we use a lot of Excel. We do a lot in QuickBooks, but that's the primary.
Yeah.
You know, and becoming familiar with Pacer, you know, the BKs. You know, there's a lot to learn on BK.
So we had another question from Cindy. Where's pricing at seconds at? She's heard that they're pretty high. I've heard they're up at 55, but
I've even heard higher.
yeah, I've heard 55, 60. Where are you seeing prices of seconds right now?
You know, I'm starting to slow down. I'm making our company smaller there than larger. So I've been buying nothing but RPLs for the last year and a half, 2 years.
A lot of people are, yep.
And we're shooting for a yield in the mid-teens.
Okay.
13, 14, 15%, something like that.
Yeah.
And a couple of the big pools I bought recently were in the 50% range of UPB. So 53% maybe, or 55%, 51, something like that. We have bought a couple of pools of higher quality loans where we paid like 75% of UPB. But the determining factor for me is the yield. I'm not gonna buy.
Thank you.
Yeah. I mean, the yield is really what drives it. I'm not gonna buy a loan where I'm less than say 85% of UPB. I mean above 85%. I don't want to be at 105% of UPB.
Yeah.
You know.
Yeah.
Because if I have to foreclose on that, I can't get my money back.
Yeah. So it's weird you say that. A lot of people are still bidding on the percentage of UPB. We've heard it at the paper source and they're being taught to bid on percentage of UPB and ignore the interest rate, right? That yield is your driving force. That the percentage of UPB is a byproduct of your bid. Well, I'm going to bid at 12, 14, 15 yield. Okay, this is my bid. Oh, what percentage of UPB is that number versus the other way around? That's a key thing for a lot of people, is that you should be driving back in the return you want versus bid percentage and then say, oh, this is the return I get.
Yeah.
Oh.
Yeah. My spreadsheet when I'm bidding stuff shows you what my yield is going to be.
Yep.
And my target is somewhere around, say, 15%.
Yeah.
Sure.
You know, if it's a great loan in a great area, if it's down the street from my house in Orange County, California, then I might drop it down to 12% or something. You know? But if it's in, you know, Cleveland, Ohio, you know, Memphis, Tennessee, or whatever, I'm going to shoot for something in the mid-teens or maybe even 17%. Yeah.
Yeah.
So where do you see the market going, Gerald? What's your crystal ball prediction?
I have no idea. It doesn't affect me that much. You know, I'm not aggressively buying right now. I just don't want to work that hard. I've worked hard for, you know, I started working in construction in 1973, I guess.
Yeah.
So I'm 68 years old now, and I'm really wanting to go. I took up golf recently.
Cool.
6 months ago, I started playing golf, and I enjoy it. I just went out and bought some new clubs yesterday.
We're trying to get one of the, you know, the note conferences to do a golf day beforehand or something like that. It'd be a good commodity. So I'm glad to see you're relaxing a little bit. It is, how difficult is it to relax when you've done this for so many years?
I don't have a problem.
Okay.
You know, I mean, some people I know, they work because that's their only interest. That's the only thing they have going on in their life.
Hobby.
Good point.
I have a lot of other interests. You know, I like fishing. I like shooting. I just went and did some sporting clays with my brother down in Houston. Fishing, bicycling. There's a lot of things that I got plenty of things that occupy my time.
Yeah, that's good.
Friends and family. I'm the oldest out of 7 kids. I just went down to Louisiana and saw my almost 90-year-old mom, spent a week down there, and then went to spend a few days in Houston with my brother. And so my focus is more like friends and family.
Yeah.
And recreation. I think we've done well with the note business, and I don't have to be that aggressive right now. I'm if I can get 8 or 9 or 10% on my money as opposed to 18%, I'm okay with that. I'll live with that. You guys are younger than me, and you're still on the upward trend. You're still trying to grow your business.
Yeah.
It's interesting you say that, because we feel like we're getting older as we go on, but then you say you started construction before I was born, which is kind of earth shattering, but it's great. I think where you came from is a good action to realize what goes on. I did construction for 13 years. I wouldn't do it again. It wears on you. But I think that the transition to notes is so attractive. So many people like it because it is real estate without the headache of real estate.
Mm-hmm.
Right.
So,
and a lot of our notes have turned into real estate, like the Burbank house.
yeah.
It's just, so we have, a dozen or so rentals right now, all in Southern California.
Yeah.
And that's a nice complement to the note business. The rentals are fairly easy to manage for the most part. We have higher quality rentals where we don't have a lot of turnover. So we have to do some maintenance on them, change a roof or whatever, but it's not a huge amount. Yeah,
absolutely. Well, Gerald, I'm going to ask you to hang on for a few minutes. We're disconnected from the public. I appreciate you reaching out to us and joining us today. Do you want to give out your email address? I'm sure your website available. I'm going to ask you guys, don't ask him for assets. He's not selling, right? He is where he's at. This is retirement. But if you want to pick his brain, feel free to reach out to him just to just chat for a few minutes. I can definitely share your email address, but do you want to give your website so everyone can see what it is?
Yeah, it's the LemoineGroup.com. So it's THE, then my last name, Lemoine, and then group, GROUP.com. My email is Gerald@the LemoineGroup.com, and phone number is 714-462-8050. Just don't put me on a robocall list. And but feel free to share, if you guys want to email the slides out to people, I'm fine with that.
If you guys want, feel free to email me or shoot me a message or whatever you guys do. And reach out to us. Let us know.
My contact information is the last slide.
Sure.
Okay.
In that presentation.
Okay.
All right.
There's no way of doing it. Okay. Well, Gerald, I'm gonna disconnect from the live feed. Guys, have a great weekend. If we don't talk to you, hopefully we have some good stuff coming up. Our next event's actually on Facebook. We'll have a really good conversation. You'll see all the details coming up soon, but stay tuned. All right, guys, have a good time. Enjoy your weekend.
You bet.
Thanks for the invite.
Hey everyone, Dave Putz here from JKP Holdings. Good afternoon. Always aside me, Mr. Nathan Turner. How are you, sir?
Hey, very good. Thanks. How are you doing?
Good. Hopefully the weather is kind of being a little bit better for you guys. We're getting like 60-degree weather here. I'm kind of impressed right now.
It's been above freezing just the last couple of days, where we discovered we've got a little bit of a leak in our basement. So we're trying to figure that. Once it warms up and we can dig, it's an easy fix. But anyway, we're having to deal with that right now. Lots of fun.
Yeah. So hopefully things are working out. Things are kind of turning in. For those who don't know, DME is around the corner. There's a couple more conferences. Our due diligence portal actually has a list of all the conferences coming up. So definitely take a look at that. This is being recorded, it'll be on YouTube. And I'm telling you, the pre-gaming talking, I guess the green room is, they talk on TV. We had some cool topics. This is gonna be a fun one with Joe. He
nailed down one more for us at the end of March. So we'll talk about that later. I don't want to give it away, but it's gonna be good.
We have a bunch of stuff coming up. I'm sure you see the feed in the Facebook events. We have a bunch of new topics coming up on Fridays and be cool. So Nathan, I know you we were talking offline as well. You're submitting some offers. We're doing some
Yeah.
offers too. Things
Yeah.
are kind of opening up a little bit. Winning some bids, buying some partials, selling some deals.
I got in contract
time
on,
early.
yeah, I went into contract on 2 last week. I just, I got my due diligence back actually just this morning. I was supposed to be closing today. BPOs are not fantastic.
Ooh.
And so I'm actually debating or negotiating, I'll say, with the seller right now, or seeing if we can do something a little bit better on their pricing, because that's with I know you're not a huge fan of BPOs, but with the values that I'm getting versus what they think it's worth, we're not on the same page. So we're trying to figure that out. But some other bids in aside from that as well.
So is it the fact that the values of the area are bad, or the house itself is not in good condition?
The house itself. Yeah. One, there's some damage to the house, and we already knew that. Last July, they got a valuation of 80,000. Today I'm getting a value of 50. So that's a big difference. And so we're in negotiation, and we'll see if that closes or not. But and what I tell people all the time is, you don't try to make the numbers work. Don't try to force something that isn't going to go, because you'll be sorry.
Don't get emotional about it, right?
No. And there's always another deal. And if you need to pass on this, as much as I want to keep the relationship, and it won't damage the relationship in this case, but don't try to force something if it's not there. That's kind of what I'm getting at.
Joe, can you give us a background where you came from, real estate wise? How did you get into notes? How did you come across this crazy thing? And what was your learning curve? What was your background?
Sure. Well, I came from my mother a long time ago. After that, I had a corporate career. I spent about 30 years doing oil and gas finance, international operations. And so I actually lived all over the world doing finance for oil and gas operations. So doing project economics is a very familiar thing with me. We would do that for all these different projects, all over the world. So that part of it was, when I left the corporate world, it was kind of just intuitive for me. And so I had invested in real estate in the early 2000s, mostly rentals, that kind of stuff. And then I heard about notes, and I thought, well, it's kind of interesting. What are they? How do they work? Mm-hmm. The first impression is, the banks are the only ones that hold the notes type thing. And so I started doing some research and got involved with some different groups and started to learn kind of what they were and how you could access them, kind of the difference, like there's performing, non-performing, and then you get into the nuances between those two, because they're completely different type animals, as you guys know. And so I guess it was almost 5 years ago, I took my plunge and got my first note, and started. I actually started off. I wanted to learn with somebody that I thought knew what they were doing, so I jumped in a joint venture, and I jumped in with the wrong person, and so that didn't turn out well at all. It ended up with me having to basically take the notes back to avoid lawsuits and all that kind of stuff. So, which I did. But then, I started working through them myself, and with, listening to a lot of different people like this, and other people, other professionals, you learn a lot. And once you start doing it, I can't emphasize enough that, you learn by doing a lot, when you start doing it. Just, you got to pull the trigger. And so anyway, I started moving forward. I really enjoyed it. Doing the economics on these things were easy for me, that kind of stuff. And so it's a matter of, finding them, evaluating them and seeing if they're a good fit, and then understanding kind of what you're buying and where you should and shouldn't be buying, and all those kinds of things that you basically learn as you go along. You just don't wake up in the morning and know all this stuff. At least not me. It takes me a while to absorb it. So that's kind of how I got to notes. And the other thing I find is that kind of once you get into space, it's kind of it's a niche group of people, and once you get to know them and they get to know you, I really enjoy working with the people in the note space. They're really, there's obviously some exceptions, but they're really a good group of people that, I enjoy interacting with and working with. And, even though you may not be able to agree on a particular note that you're selling or buying or whatever, that's just today. Tomorrow you'll be working together again, because that's what you do. It's not like it's something personal, because if you start making it personal, then you're going to be making the wrong decisions for all the wrong reasons.
Yeah.
Is my experience. So that's kind of where I got to today. And so
it was kind of forced upon you, but you took it on and and just took the bull by the horns.
Well, yeah, I learned because I was sitting watching nothing happen, they were non-performers and nothing, there was no action being taken. And so 18 months later, I said, hey, I'm done just sitting here watching nothing happen.
Mm-hmm.
We need to take some action. And so
that's good.
How you move along anyway.
Yeah, no, that's good. And then coming from a finance background, we talked to everybody. I think Dave and I included, we all came from a real estate background.
Right.
So coming from a finance background in a lot of ways is a huge plus, because that's really what this business is about, is finances and numbers.
And people get in a space like, I don't want to mess with numbers. I just want to buy real estate. And it's like,
right,
you're doing both.
Yeah. If you want to donate money, it's a good place to do it.
Sure.
Yeah. It's a shame, because it's a lot of people get into this stuff because of landlording, right? And they just get banned. They get bored of it, tired of it, the struggles, the headaches.
Yeah.
And it's a little bit, it's still real estate, but it's just not dealing with the tenants.
Right.
But there's more than just a house, right? You're not doing REO rehabs. There's numbers. This is a bank versus being a real estate owner.
Right.
Yeah.
Right.
So different look at the numbers. And then you said you got a preparation. Yeah. You prepared a presentation for us on numbers.
Yeah. If you want to, this is a cure for everybody who has insomnia problems, because we're going to talk about numbers. And I have to say that this isn't the introductory course. It's just kind of a little more advanced that we're going to be talking about. So, hopefully if you have some exposure to doing some notes or whatever, this might be a good fit for you. We will get into some things that are normal when you get into buying notes and stuff. So, it's some things you should know. So if you want, we can jump into that.
Let's jump in. So Joe's going to bring us on to learning about the differences, right? This is the idea here today, is there's multiple ways to calculate your returns.
Mm-hmm.
Now, there's some simple ways and more complex ways. And you may say, well, I just want the easy way. Sometimes the easy way is the wrong way and gives you a fake return. Sometimes the easy way can give you a roundabout idea, right? And there's some ways that are just a lot more complex that can be overwhelming. So hopefully that kind of helps.
Right.
So
I'm going to start out about, talk about understanding the returns on notes and kind of a good way to calculate that, because that's what it's all about.
Mm-hmm.
So a lot of common questions, some people say, well, isn't the return just the interest rate on the note? If it's 5% note, isn't that my return? Well, if you paid the full unpaid balance, yeah, that would be, but I don't think a lot of people want to pay the full unpaid balance. Plus, you have all these other things that jump in, like, what the legal balance, because, that's another part that you need to consider, depending if they're behind and all kinds of stuff. And so, then the other question is, they have all these acronyms. What do they mean? What's ROI and IRR and XIRR and yield and NPV and XNPV? Golly, your head just swims with all this stuff. And, so, okay, how do I know which one is the one I should be using when I'm looking at this particular note? Well, I'm going to just quickly go down. I'm not going to go. I thought about actually showing the mathematical equations for these, but then we would all be asleep, myself included. Okay. So we're just going to talk about what these particular formulas do and how they apply. Most of these, not all of them, most of these, because I like to use Excel, and a lot of these are Excel functions that you can use in an Excel spreadsheet. So, you can use them there, but the ROI, return on investment, is just a total net profit compared to your cost. Tends to be backward looking, and it includes asset appreciation. Well, asset appreciation doesn't really apply to a note because your note doesn't really appreciate. Now, if you're talking about real estate, doing, looking at ARV values and all that kind of stuff, that's another dynamic. But if you're just looking at the note, it doesn't appreciate. So that doesn't really apply here. And there really isn't an Excel formula for ROI.
Let me make sure people understand it. You can use your calculator, the fancy calculator everyone uses, but you can also use spreadsheets to calculate the same returns. So that's what Joe's saying, is that there's people out there push the calculator, right?
Yeah, like there's a calculator. You can use that, baby.
You can use the calculator. But what Joe's talking about is you can also use, which I use, spreadsheet formulas to equate the same numbers so that you can put this alongside of any asset, any tape, and get the returns right on the spreadsheet in a quick formula. Sorry, Joe, go ahead.
Yeah. So Dave, who has a calculator that can do that?
Many people.
You've included, right?
People, yes. So many of the people who are been in the space for a while or old timers use the calculator, right? And we have one, and it's great on the fly. So yes, we have them. Yeah.
Yeah. No, you have a good one. I know. I'm not talking about the handheld calculator. I'm talking about the Excel spreadsheet that you've got.
Not many people use the spreadsheet, but you and I both do, and it's easy for us to calculate deals.
Yeah. Oh yeah. Yeah. That's I only use the calculator if I don't have my computer handy. Otherwise, it's always Excel. For me. Anyway, IRR is internal rate of return, and it's for a series of cash flows, which relates a lot to our notes because that's what we're looking at. We're looking at a series of cash flows. To do IRR, they have to be equal. In other words, you're getting the same payment each time, and it has to be at the same interval. So you have to at least receive one every month or every quarter or every year to be able to use this particular function. Now, the XIRR, that's the internal rate of return. It's for a schedule of cash flows that aren't necessarily periodic. Now, we tend to have more periodic ones. I mean, if you just strictly look at the note, but if you think that you're going to get multiple payments at a certain period of time, or you think you're going to get an early payoff or whatever, that's when this comes in handy. My only problem with it is that's hard to forecast when you're forward looking. I mean, you don't really know. My expectation on most of my notes is that, they're a monthly note, but you can use that, and you can also use it in backward looking, because these are the kinds of payments that I ended up getting. Rate function is just the interest rate per period of the loan that you've received on periodic equal basis. Probably one of the most used ones that I use is the rate function. All of these four, they're going to give you a percentage. So you're going to end up with a percent that says, okay, this is the percent return based on these particular criteria that you put into that equation. You can also use the NPV, or it's the net present value, and that will tell you what all those cash flows are worth today. And a whole lot of this is based on basically the present value of money. You know, it kind of goes back to the principle of $1 today is worth more than $1 tomorrow. And I think we know, if we looked at the news, the dollar today is 7% less than $1 was last year because of inflation. And so that's what this is trying to tell you, is what the value of it is today, based on whatever, you know, we're seeing on the news at 7%, but you can put any figure in if you want your discount rate and determine what the current present value is. Right. And the net present value function, that's for just a schedule of cash flows that's not necessarily periodic. You know, maybe you get one today and one in 2 months, and, you know, however, in my corporate function, we would use this a lot because we were looking at projects, and projects have, you know, a lot of varying cash flows over time, depending on your expenses and your revenue and all that kind of stuff. Whereas notes tend to be, you know, more consistent. Now you can have some notes that, you know, have some nuances, and that's where you can play with those also. But those, in at least my experience, tend to be more of the exception than the rule. So when do I use them? Like I said, ROI, I kind of use it. I always, after I sell a note, I like to see, how did I end up doing? You know, did I get this one right, or did I miss something? And so I do kind of a post appraisal, if you will, and an ROI is one way to do it. After I sell a note, I can see, well, how did it perform? You know, and I take into consideration, you know, my purchase expense, my due diligence expenses, my servicing fees, if I had forced placed insurance, my legal expenses, the payments I received, sales expenses, and all that to see, you know, what kind of return did I end up? And what I like to do is, because when I buy a note, and I think most of you guys do, you calculate what you think your return is going to be on it when you buy it. And then when I sell it, I go back and I calculate to see, what did I really get? You know, and did I get more or less? You know, what was it about on target, or were there some surprises? And, you know, there's always surprises. And, you know, there are some ones that are kind of standard, but there's always some surprises that pops up. So I do that kind of for, you know, a backward looking purpose. The IRR and rate, they're the ones I most often use when I'm preparing to a bid. And so notes, like I said, they're based on periodic, consistent payments. And, you know, if they're all the same, you can use the rate function. But that doesn't mean that I don't take into consideration servicing fees. I don't, you know, I do take that into consideration. I do take into consideration things like my due diligence expenses. And I also take into consideration the purchasing costs, the boarding costs, all those kinds of things when I go through that calculation. Yeah. And
so, Joe, I don't typically interrupt, but one of the questions was, what do you mean by rate? What is rate?
Rate basically is going to give you a percentage. It's your rate of return, if you will.
Annual rate return. It's your return. You figure out ROI is a simple one, right? Over 5 years, your annual return.
Right. It's an annual return. It's based on an annual basis.
Right.
Some people, you know, it's interesting. Some people call it yield. Some people, but if you go and you look at the Excel formula, there's an Excel formula for yield. The yield formula on Excel basically is structured to determine the yield on a bond. And a bond is a little different than what you get, because a bond, you end up, it's got to pay off at the end, and the variable in the price of what you paid for it. So the components for it are a little different than for a note. So what I find is that the rate formula in Excel is a better application for calculating this. So when I say rate, a lot of times people use that term interchangeably with yield. And what that means is it's your annual rate of return.
Yeah.
You can also use the I on the calculator, right? For those using the calculator, it's the I, where these correspond in the time value calculations. It responded to the there's actually letters on the calculation that there's I, there's N, there's NPR, constant with that. So you know what you're using. Rate is a term we use because it's an equation in our spreadsheets, right? Where on the calculator, it's an I function. So it's a return annually. So yes, so you can use the word yield, but what we're looking at the fact that the annual return can be a yield, could be an IRR, which are completely different calculations. We're going to get into that in a few minutes.
Right. And then, like I said, XIRR, that's just, like the IRR, it's just with if you have inconsistent payments. So what I did is put together a little sheet to say, okay, what's the difference between these things, and what are the parameters that you have to have in order to be able to calculate that? So yield or rate, if you want to calculate that, you have to have equal payments at an equal interval, and then that will give you a percentage return. If you want to do IRR, you'll look, it doesn't have to be equal payments, so the payments can be whatever.
When we make sure clear, it when he means regular, meaning the same time, same month, same amount, right? It could be different amounts. That means it's irregular or different clockwork. Yield is the same, the first of every month.
Right. That's with yield. On the yield one, yeah, you've got the first of every month, and you got the same dollar amount. Cha-ching, cha-ching, cha-ching. Now, if you have a situation where I'm trying to think where you don't have equal payments. I don't know. There probably are some loans that might have variable interest rates, and if you know if you could predict them, and okay, the rate or the payment is going to go up at a certain period of time, but it's going to be every month. The payments are going to be made. Then you can use that to calculate what your return is.
Or if payments are every other month and the borrower is not consistent, you can use the IRR.
Yeah, exactly. Yeah. The problem I have is I can never forecast that.
Yeah,
correct. So internally, we use IRR for another way is that payoffs, right? Yield typically goes to a maturity date, where we're using IRR to say, I'm going to sell a loan in 3 years. Or if there's a payoff in 5 years, it's not going to go to maturity date. So we use IRR to say, I'm not going to hold this for 20 years. Where yield calculates to maturity bond, right? To 20 years down the line, says, what's your return every single year till the maturity date?
Yeah.
Right. Yeah, because I use something similar like that because one of my exit strategies is if you take a non-performer, you get it reperforming and you sell it. Mm-hmm. That's a potential exit strategy for my non-performers. And I also then calculate, well, what price can I sell that at based on what I think the buyer is going to want as a yield. And based on that, I can calculate the sales price. Yeah. And then you can put that in to determine what your rate of return is going to be. So you're right. You would have consistent payments until the time you sold the note. Well, if it's non-performing, you won't necessarily have consistent payments, but you hope you would after a period of time. Consistent payments. And then you'd have the lump sum payment when you sold the note, and then you could calculate your return. Right. And so it was just I just kind of put it together. I hadn't really looked at it from this perspective, but it kind of makes sense where what you can use in a particular situation to give you your return, either in dollars or the percentage amount.
Right.
When I first started out, I was exposed to some people that were suggesting that you ought to just bid as a percent of UPB. Just, make that your basis for your bid. And kind of always thought, why that doesn't sound, it sounds strange, but mm-hmm. I was a newbie and, thought, well, maybe they had some other things, some experience or, there's always shortcuts that, people have, and figured this was kind of a nice shortcut. So I thought it might be interesting to kind of look at some examples of a comparison of if I bid based on UPB percentage, or if I bid based on what I want my yield to be or my return. Okay.
Mhm.
So I thought I'd put you two guys to a test.
Ooh-wee.
All right.
So here's what we're going to do. Here's the basic assumptions for a bid. Okay. All the notes that are going to be presented, they're performing. Okay. So you can put that category there.
Right.
All the UPB bids are going to be bid at 90%. So I think that sounds kind of like what a lot of people who are bidding UPB bid for performers.
Yeah.
And as a yield bidder, somebody who wants a return, going to be somebody who wants a 12% return.
Okay.
Might be a little high. You know, I think some people have lowered it a little bit, but
Not high.
for this exercise, we're going to use 12%. So
All right.
here's what's going to do. We're going to do. We're going to have 3 notes that are come up. UPB bid is going to be 90%, and the return is 12. Now here's the first one. The UPB is 50,000. The interest rate's 9.5%, and it's got 163 payments left. And the payment is 546.56.
All right. There's
Okay.
mine.
You're cheating.
I'm a calculator guy.
So we already know the UPB bid on this one's 90% of 50,000 is going to be 45,000, right? So
Right.
boom. You didn't need the calculator for that one.
Nope.
That's an easy. So the question is, the yield bid, the 12% yield, is that bid going to be higher or lower than 45,000?
Let's see it from the audience. I know that probably a little bit delayed, but so the question is, will the yield go up or will the return, will they go up or will go down?
Right. Because
If
the
everything else stays
return,
the same,
you're going to bid on a 12% return.
Yeah.
So is your 12% return going to be a higher or a lower bid than 45,000?
If you want 12%, what I get is if you want 12%, you're going to have to bid lower than 45.
Okay, you say lower. You agree, Dave?
you're going to have to bid lower.
Yeah.
Okay.
Let's find out.
Yes, you are. You're going to have to bid lower if you want a 12% return. So the good news, well, okay, so now let's look at what is the yield on the UPB bid. When you do the calculation, if you bid 45,000, I'm not, you can tell, do you know the answer, Nathan? You want to guess? Of course, I also included costs for the
Okay.
servicing and all that kind
Additional
of stuff.
costs in
So
there.
that might, but
If I just put in just a straight 12% yield without
Yeah.
any additional
right.
expenses in there, the bid's going to be 43,860
Right.
and 22 cents, but that's without any additional expenses in there.
Yeah, because this bid that I did, it includes about
That's a net bid.
yeah, it's a net bid after $30 servicing, after close to $500 in expenses when you consider, you know, the cost to acquire it, you consider your due diligence, you consider recording fees, all that kind of stuff. But anyway, so the yield that UPB guy is going to get is going to be 10%.
Make sure you guys all know this. This is based on 0 servicing fees, right? This is a gross yield. Just FYI.
No. This is a net.
No,
yield.
this is net.
This is a net yield.
Okay. Oh,
This is net.
okay.
This is after servicing, after your acquisition costs, all that
Gotcha.
kind of stuff. So, so they're apples and apples with the 12% return and the UPB return of 10.
Right.
So this bad news in this situation is I lost the bid because I wanted a 12% return. I only bid 40,568. The UPB bidder bid 45,000. They got the bid, but they're going to get a 10% yield. They're not going to get to 12, which I was hoping to get. Okay. So I lost that one. Let's go to the next one. Sorry, we knew the return yield was 12 because that's what we based it on.
Yeah.
Right.
All right, loan 2. It's got the same UPB as the first one,
Okay.
50 grand. Interest rate's 3%. It's got 104 payments, and the payment is still the same, 546.56. Now we know that the UPB bid's going to be the same. It's still 90% of 50,000 is 45,000. So is my bid to get my 12% going to be higher or lower than 45,000?
It's gonna be a lot
We'll
lower.
give it a little pause for Facebook catch up. So again, Joe, just so people were kind of lost, explain it again. What are we trying to figure out? What are we solving for those people?
Right. We're comparing for those people that just bid on a UPB, as a percentage of UPB, because some people do that. I mean, I was originally taught to do that.
Yeah, we all were.
As opposed to how you would bid if you base it on a given return, what your required return is. Okay. And then in this example, I said, okay, well, we'll look at a bid based on a 90% UPB bid, as opposed to a return that I want to get a 12% return. So I'm looking to see how this UPB bid is going to compare to my bid that I want to get a 12% return on. And will I win or lose the bid? And if I win or lose, how does my yield, which is mine's based on 12%, how is that going to compare with the yield that the person got when they won the bid, like in the first case, when they won the bid for their 90% UPB.
Right.
And in that first loan, like I said, you can see that to get my return, I had to bid less. They bid 45 based on the 90% UPB. I only bid 568 because that's a 12% yield. But at the end of the day, when you compare, well, what yield did they get compared to what I wanted to get? Well, they would get a 10. And of course, I would
more
get
than
12,
likely,
that's what mine was based on.
Because more than likely they bid strictly on percentage UPB. They probably didn't calculate the return.
No, they didn't. No, they just did it. And so my objective was to see, well, what return would they get? What do you really get?
And they're going to be
that was
frustrated.
What loan number one was. So loan number two is the same scenario, only what you're seeing is you're seeing a lot lower interest rate. You're going from a 9.5 interest rate on the note to a 3%. Now, I still want to get a 12 return on my note, and they're still going to bid 90%. So what do you think?
They bid 45,000. What do we have to bid? So they're bidding 45,000, and we have to bid here based on our 12% return.
Right.
I'll do a little, circle thing. Right on that 12%. What do we have to bid to win to get our return?
Right.
Yeah. What do you have
So
to
I've got
bid?
the gross
What's
number.
the bid to get your return? So you think it's
And they
higher
bid
or lower?
45.
Huh? You
The
say it's
question
lower,
is-
right?
Yeah, much
lower.
lower.
Yeah,
much
exactly.
lower.
Much.
That's what you have to bid. That's what, to get that return, that's what you bid.
Yeah.
You bid 32,461. And the reason why that's so much lower is because the differential between the interest rate and your return.
Yeah.
This note only has a 3% interest rate. That's nothing, relative.
Yeah.
It's something, but it's not much. So in order to make up that differential and get my 12% return, I have to bid a lot lower to get that return.
So understand that you can look at two loans, identical numbers, and with that interest rate changing, we talk about this in our weekly mastermind group, that changes your bid dramatically, no matter what the UPB stays the same.
Right.
So
Right.
understand that the interest rate, you can't ignore it. You have to look at it.
That's why in all these examples, I kept the UPB the same and I kept the payment the same.
Right.
It's going to be the interest and the number of payments are the ones that are going to wobble. So, what kind of return does that UPB bidder get?
So we're going to say, what did the return, the person who bid 45, we're solving for the I or the angle return, right? What are they getting?
They're going to get a 3.7% return. And what would we get if we won the bid? Well, we get 12% because that was what the whole thing was based upon. So far, I'm not doing very good bidding. I'm not getting any of the bids, but by the same token, I'm not ending up with a 3.7% return either.
Right.
Yeah.
So,
And-
So I think you're right.
we'll go to the
It's not
third
a-
case. This one,
Yeah, let's do it.
So now
right.
the guy that's getting that 3.7, unfortunately, they're going to find out that they're very frustrated with notes as a investment. They're going, well, this
Yeah.
thing is stupid and it doesn't even make any sense. I'm not making any money. You're right.
exactly. Exactly.
I think I can help your problem. I'll be an idiot just like you, and I'll buy it from you. Right?
There you go.
So here's the third one. This one's a little trickier.
Ooh.
The UPB is just a little bit larger. It's 51,000 to 11. The interest rate's 12.5%. There's only 12 payments left because this is a 5-year balloon. It was amortized for 360, 30-year amortization with a balloon at the end of 5 years of 50,102. So basically you are going to get 12 payments of the 546. And then after that, you're going to get the balloon payment. So now we know the UPB bid is again 90% of the 51.2. So that's the 45,341.
Mm-hmm.
Now, what are you going to bid, higher or lower?
What's our going to do for delay? You're bidding higher or lower than the UPB bidder? We'll give I know
Yeah.
Facebook's
Are you
about
bidding
30 seconds behind.
more than the 45,341 or less than the 45,341?
Dun, dun, dun. Right? We're solving, we're putting our interest rate in, we're putting in the payment, we're putting in the balloon. Right?
Right.
And we're solving for what is the PV, right? Or rate
Right.
equation, or the PV, the formula for PV. So
And the
we're going to
answer
pay
is-
higher than the UPB,
Right.
than the UPB bidder.
All right, I hear one higher. You, Nathan?
Higher. Yep.
Ta-da!
Yeah.
You definitely are going to bid higher. Time value of money, you're going to be getting that balloon payment early. You've got a 12.5%, so the interest on the note already is higher than what the yield you're looking for.
Yeah.
You know, so you could bid 49,781, and you're going to win the bid compared to the UPB person, and you're still going to get your 12%. The UPB bid, if they got it, they'd have like a 20% return, which is nice. I mean, you'd like to get that one, but
All day.
if you're bidding against me, you're not going to, you know. And of course, our return is 12%. So that's just kind of examples of different types of notes, how the interest rate definitely has an impact on what your return's going to be, and how the present value of money, because you're getting a balloon much earlier than waiting next 20 years to collect these payments, are going to help your return. That all affects what you want to look at and how you calculate it using these different parameters. So
Yeah.
congratulations, guys. You passed with, I have to give you each one of you guys a star for the day.
I like it. A little sticker. I like it.
So
What do we learn from this situation, right? We're learning the fact that if you're bidding based on BPO or UPB and ignoring all the other numbers, your return is dramatically different
that's
than if you
correct.
use math. And why it's essential to use math? Because if you don't, you can end up with a 3.7% return
Right.
because you didn't calculate it. So you may not understand it, but you must understand it if you want to be successful.
Learning.
Right?
Yeah.
So let's keep that on the screen for a few minutes. Let's talk about a little bit more about real quick about the balloon, right? Can you explain, Joe, what is a balloon for? Why is it there? And how does it change that number? Like, what does it do, right? Not mathematically, but why is it changing? If that was a zero, it'd be a totally different situation because it's a different loan.
Right. Well, you know, a lot of times the practical application is a lot of times what I've seen is you can see some balloon notes or situations where people who maybe they don't have good credit when they're getting the loan. So they end up getting a loan that has a higher interest rate that, you know, a lender will lend them the higher interest rate, and they'll agree to a balloon because what they want to do is they want to improve their credit rating, which will then allow them to get more of a commercial type loan at a lower rate. So they're going to refinance it. So they'll pay off the balloon and refinance at a lower interest rate. And I've seen that, happen with lots of different situations. There's also the situation where they get to the balloon and say, no, we can't do it. Can you extend it? And so then you have, recalculate, okay, we'll extend it and see what the payoff is. And that's another exit strategy you need to really consider, I think, in one of these, because you need to see what your return would be if you did extend it. But the benefit of the balloon, that's theoretically, that means in 12 payments, they're supposed to pay me $50,102. So that means in 12 months, I'm going to get that 50,102 plus I'm going to get that 546.56 every month for that 12 months. Well, the fact that I'm getting that so early is very beneficial. And so that's the reason why I can bid more, because of the present value of it is greater than if I had to wait for, 280 more payments. And again, it's the time value of money. The further out you go, the less that money is worth, is basically what it is. And the fact that you're getting it earlier means it's more valuable.
That's great.
Money today is worth more than money tomorrow.
Absolutely. Absolutely.
That's
So,
a really good lesson for everyone to learn.
Yeah.
You cannot just look at a percentage of UPB. I think, if you go back 10 years ago when everything was underwater,
right,
even then it didn't make sense. But I think that what we heard a lot back then was bid on a percentage of UPB or value, whichever is lower.
Yep.
Mm-hmm.
So
right.
it made a little bit more sense back then, but only kind of.
And I think it made sense because we couldn't screw up. I think that's what it comes down to.
That's really what it is.
You couldn't, when you're buying it so cheap that, you're wrong, but who cares? They're all getting killer returns.
Right.
Yeah, that's true.
Yeah, that's true. That's a great point. Today, I mean, I jumped in after the 2008 and all that kind of stuff. So, I don't have quite that experience that you guys do, but now you need to figure it out. The good thing now though is, and I heard this,
I think we're losing his audio. I think we're losing his audio.
Coming back.
Come on, we can do it.
in there when you're buying notes.
We lost you for a second or two, man.
Yep.
So I wanted to show people, right? I did something similar, but I wanted maybe you can kind of see. Let me see if I can find it real quick. We're on the fly here. Let's see if I can.
So Cody asked a question there about, are we finding that sellers are more looking at a percentage of UPB, or are they actually looking at yield calculation? I'm not sure about you guys. My experience is they're more looking at yield calculation. I don't know about you guys.
Yeah. Yield calculation I'm kind
of seeing a mix. I'm seeing some sellers wanting to have particularly on performing, it's like, oh, we want 100% of UPB.
Yeah. Dave and I looked at a couple weeks ago where they wanted a premium. They wanted 101% or 102%. And we ran the numbers and they just really didn't make sense.
Yeah. So let me share. I'm going to share with you guys. So for those who may be a little confused a little bit, I'm going to show you a side-by-side comparison of what, and I'm sure I've shared this before with you guys, but let me, hopefully everyone can see that. Okay. So we have a situation where we have a coupon rate of 3, right? UPB, if we bid 60%, right? Look at the difference in returns.
Mm-hmm.
right? Because of the interest rate on the coupon, the original coupon. We bought it at 30. The change is dramatic. We changed payments. It changed dramatic, right? So the UPB stayed the same. You change this number or this number, the change is dramatic of what it is. So we got to be careful being simple with things. So, let's open for some questions here. Let me bring this.
And I like simple. I'm a big advocate of simple. However, you do need to know what you're doing.
I agree with simple too.
Yeah. But, even I've had people ask me before, well, do you need a financial calculator? But if you're not using a spreadsheet, then yes, you do need to know how it works and how to plug the numbers in and solve for X. And if you don't, you better learn it, because you'll get yourself into a real world of trouble if you're just using a regular calculator to try to figure stuff out.
So one of the things, Cody, I think we talked before about this, is that sometimes sellers are not selling based on yield or ROI. Big funds do, right? But some people, hey, Joe, I'm going to buy an asset from you or whatever. I'm going to bid this. And you're not a sophisticated investor. You may look at your basis and say, hey, I'm here. I'm doing greatest loan. I owe you $4,000 to break even. And you want to buy for 20? Done deal. I get out and I'm moving on to a different deal, right? I may be in that position where that was what we did at one point, is we went based off our basis. And if we could sell it, if we're completely in the black here and we're in infinity return and you want to buy it for 10 grand, it just adds to our thing, right? So some sellers do that. I don't agree with it, but it definitely can be doing it, right? So making sure when you bid on things, and you can put this formula inside your spreadsheets when you get them and run it down the entire list. And then that could be a filter, right? I tell my mastermind guys every time, you get a tape, some of the best filters is just to take away the low interest coupon rate loans. Take them out, because you're probably not going to turn a 2% into a 10.
Right.
You're not going to.
Yeah.
So
another thing that I noticed too, besides the low interest rate, is a lot of times loans that have a small monthly payment. When you start deducting servicing fees from a small monthly payment, that becomes a significant percentage reduction of what you're going to receive. $20 as a percent of $100 monthly payment, as opposed to a $500, that's a significant impact on your return.
Absolutely.
That's another way to filter, right? We all talk about states and all stuff. You may filter by interest rates above 6 and any payment that's above 200, and eliminate anything else. Because if you're paying $20 a month, or if it's not performing, you're paying 95, whatever you're paying, it's crazy. So yes, you may be able to filter doing this process, and sometimes I do. If I see 2%, if I get a tape in and it's all 2%, I'm not gonna bother.
Yeah.
No, neither.
No.
It's not, the math won't work, right? And that's one way of doing it.
You end up
unless you have a seller that really has to sell.
Yeah.
Yeah.
Otherwise, you just tick them off because they're like, "What is this? What is this garbage bid?" Well,
yeah.
So I don't know if you know the answer. Cindy asked a good question, and this is hard because this fluctuates so much. Can we accurately account for inflation? I don't know of a way of doing it.
that's over my head.
No, I mean, I would tell her that if you could, let's talk, because we can make a lot of money.
Ooh, I like that. So someone asked in the group about what the formula in Excel is for rate. For those who will be listening to the podcast later, = rate, open parentheses, and it actually tells you what to put in additional spots.
Exactly. Yes.
It's nice and simple. And I'm gonna tell you guys, I used to use a formula called dated if. I'm gonna encourage you guys to use the MPER formula to calculate how many payments are in the loan, right? The number of periods inside that situation. So it gives you an accurate, because if the UPB is wrong or something, it's going to give you an error. And you may go back to your seller and say, hey, listen, the numbers aren't making sense. Oh, it's a balloon. Oh, okay. Right. So all these formulas have it. Yes, you can use a calculator or you can use a spreadsheet. I'm a spreadsheet crazy person because I can process 100 loans in a minute using a formula where a calculator takes a little bit longer.
Yeah.
And I'm only looking at, if I'm looking at 20 loans, I don't mind doing that by hand. I could get all fancy and use your spreadsheet, but for 20 loans, it's not a big deal. I don't mind going through and plugging in the numbers and just seeing what they all work out to individually.
So this is a good question. The ask was, if you use a formula inside Excel, right? And I'll put it into the chat so you guys can see it too. Will the future value always equal 0? So I want to make sure we're clear. Future's value is a balloon value, right? But you may be talking about something a little bit different. So balloon value doesn't always equal 0. It depends on if there's a balloon or not. However, there's another function right after the FV, the future value, 0 or 1, meaning is it the beginning or the end of the loan? So is the balloon the beginning or end? So most likely, I don't know of any loan I've ever bought where the balloon is the beginning, right? Usually have balloons at the end. So hopefully that helps.
Balloons are not super common, especially if you get anything established after Dodd-Frank. They're not common at all. So don't get too hung up on it. It's important to know how they work and when to use those calculations, but you don't see them a ton.
If you do have a balloon, make sure you record any mods you do with them, because that it can change your maturity date and stuff. So but yes, good question. So yes, you can do a rate formula in Excel. Google Sheets is sure, I use all the time. Same idea. And I run this calculation. I have a spreadsheet. For those who bought the beginner series, I actually have a yield calculator that I can share with you guys. You can run through assets through that way. So awesome. If you have any more questions, feel free to let us know. Joe, when you came into space and ROI was what you did and your percentage of UPB, did you have an aha moment where like, holy crap, I'm not getting the return I thought? Was there a story that came along with like, uh-oh?
No, I mean, like I said, based on my career experience, I didn't really have that. I guess the thing that when I first got into JV, the thing that bothered me more than anything was because of the lack of action on dealing with it. The clock is ticking, and the longer and longer the things go on, the more and more your return is reducing.
Yeah.
So what I knew, but kind of reinforced, is that you need to take action. You just can't sit there and hope something's going to fix it, because the longer it goes on with it not being paid, no action being taken, the worse your return is going to be.
Yeah. It's a shame. So guys, awesome information from Joe. Well laid out too. I do a terrible job laying this stuff out, but it was a very well organized situation to show you the comparison and the effects of it, right? And the different ways of bid, ROI versus IRR. Now, those who are curious about the XIR versus IRR, it's a very similar function. Again, still in Excel, but it really kind of tells you, XIR it compares payment to date, where IRR is a simple payment string, right? And it just takes a payment string, where XIR takes the dates and uses the formula to figure out if it's been skipping months and all that good stuff. So awesome stuff, Joe.
Yeah, thank you.
I think a lot of sellers understand this and a lot of new investors don't.
And unfortunately, for the most part, by and large, I don't think sellers are trying to take advantage. But at the same time, if they're getting that bid that's at 10% of UPB, and it's, $5,000 or $10,000 more than your bid, they're probably going to go with that higher bid. And, the seller, honestly, they have to assume that the buyer coming in at that bid is doing it for a reason. So, not that they're out to try to screw anybody over, but if they get offered a higher bid, they're probably going to take it.
Yeah, absolutely. And I think, some courses don't teach it. Some courses do. They don't emphasize it enough. It's not hard to do, and you don't need to understand the exact math behind it. Just understand that it's your return. And you look at bank statements, your bank account. If you look at your mortgage statement, you can calculate your mortgage as well, your personal mortgage with this stuff.
Oh yeah, absolutely. Yeah.
Cool.
So then, Joe, what do you see coming down the pipe here? You've been around long enough that you can see things as they are. What's your crystal ball prediction here?
You know, I'll be honest, my crystal ball, to be politically correct, is lacking. I actually thought that we were going to see a turn in the market last year. And I think that, the continuance of, the moratorium that we had on foreclosures, I think that, the payments that went out, all those kinds of things protracted it. But yeah, I was expecting us, to be honest, to see a lot of non-performers start to hit the market basically in the last quarter of last year. It didn't happen. And now when I listen to people, which is most anybody that's smarter than me, talk about the forecasting and stuff, they're seeing, and I tend to agree, unless we have some more economic easing or whatever going on, that there is this pool that's sitting out there that's just kind of waiting to kind of filter its way down. And it's before it gets to little guys like me, it's got to go through the hedge funds and kind of filter down, etc. But I think there's some coming. It's got to be. I think the stock market's going to correct too, but don't bet your money on that.
And I mean, we had the question about inflation earlier. Is inflation the trigger? I mean, who knows, right? But maybe.
Hopefully it doesn't get too crazy. But there have been talks about this thing start going up like the early 80s, right? And that's much younger, right? That's scary to hear. And for those maybe even younger than I am, we're not talking like 8, 9, 10. We're talking double-digit inflation.
Yeah.
Right.
So we shall see.
Yeah. It's.
Well, thank you very much, Joe.
Yeah.
We're going to disconnect from the Facebook Live, and hopefully we've given some tools, resources to those people who are newer or just didn't know about this. So, Joe, again, thank you for presenting, coming on, and chatting with us on this Friday afternoon.
Thanks,
Thanks,
much,
guys.
Joe.
It was a pleasure spending time with you.
You bet. Thank you.
All right. Y'all take care.
You too.
Welcome, note investors. I'm Dave Putz from JKP Holdings. And this week, Nathan Turner and I were joined by Candance Horne. She's a newer note investor who's attended a few note conferences, but shares her journey from beginning a note investor to owning a few assets. We discuss some of the issues and struggles she's had, some advice you'd give, how to get over some of the hurdles that she's gone through, and some great pointers of what to do when you first begin. We also share our upcoming 5-week education class Nathan Turner and I will host starting October 25th. This class will be 5 weeks of intense learning with homework, tons of resources. So be sure to check out our website to learn more. Hey everyone, Dave Putz here from JKP Holdings. Alongside me as always, Mr. Nathan Turner. What's happening, my man?
It's morning. I'm still getting used to that, but yes, it's morning where I am. It's been good.
Yeah.
It's been good.
We've had conferences starting up, right? We had a lot of fun stuff happening. I'm really excited about where things are going. Things are kind of starting to open up too, like notes and stuff like that. We're seeing more portfolio tapes coming out. Assets are coming more consistent. I just read on one of the articles I get in my feeds about like August was increase that was pre-pandemic. So I'm kind of curious about that whole thing.
Yeah.
I'm very interested to see what will trickle down in the future. So
yeah, really interesting. I actually just got home last night from the IMN conference. It's kind of the fall conference season.
Yeah.
And it was fascinating. It was really interesting to hear all the different panels, and I was surprised that not everybody thinks we're going to see a huge increase in notes. There were some up there that were saying, I probably.
Oh, we losing Nathan for a minute?
So we'll see what happens here.
Yeah, cool. We like for half a second we lost you, but yeah, I was at Noteworthy, and the conversation for us was there's just shift going on somewhere with anything right now. Something going on. We don't know what to look like, but something's happening, right? Yeah. We're seeing interest rates going up. Obviously, we're seeing money market CDs increasing, which is a curiosity of what's happening. So I think that we're expecting something to happen. The problem is we don't know what that something is, right?
Well, and what the fallout will be.
Very true.
And then we'll just kind of have to wait and see.
Yeah.
But I mean, we're overdue for market correction that should have happened a couple of years ago. So
huge. And we don't know what it look like. It may be residential, maybe commercial, and maybe whatever, right?
Right.
So it's interesting you say that we're sharing with everyone else. I was at Noteworthy last week, and for those who are affected by the hurricane, we're hoping you guys are all safe.
Yeah.
If you're not, hopefully, if we can help out in any way, let us know. It's pretty devastating what we're seeing from afar. So if you need help, if we can do anything, let us know. Please reach out. Being in Noteworthy was really exciting to be around the group. We had about 80 people in attendance, which was really actually good. We're hearing from a lot of attendees about how awesome it was for the intimacy, being able to talk to people. So that was really cool, and whatnot.
Good.
One thing I wanted to bring up too before we get to our special guest today is that Nathan and I are running a really awesome 5-week class that's going to start the October 25th. We're going to be talking about really deep diving stuff. So if you are a newer note investor who's got some basic knowledge, who's looking for the in-between, I would ideally say reach out, look to us. You can bring a partner on for half off and whatnot, but this is ideally for those people who are regularly started notes investing, 1 or 2 notes, 3 notes, or took a beginner class and looking for the next step.
Yeah. If you've got some kind of basic knowledge, you've read some books, did some videos, whatever it might be, and then just looking to just dive in and get the confidence you need to actually get into this. It's a fantastic business. Yes. There's lots of room for a lot more players. So we're excited to be able to share what we've learned over the last several years. And just see what we can do to help.
So in the class will be 5 weeks. They're going to be intense, right? There's going to be homework assignments. We're going to go through collateral files. If you find a problem with it, that's going to be a homework assignment. So you're really going to have live action doing stuff like this. We're also going to provide resources that you've never seen before that we don't share publicly ever. And we'll explain why in the course. But there are things like statute of limitations, debt license stuff, big calculator stuff. So it's a really good course and whatnot. So that's going to be Tuesday, October 25th. You can sign up on the website. If you have questions about that, reach out to one of us and ask about it. Right. This class came out of a conversation we had in Las Vegas. Right. So we were sitting in Las Vegas talking, and we were approached by a few colleagues who are in the space and whatnot. And the question was, we've gone through basics. We have the knowledge of that stuff. We just didn't know where to step to, right, Nathan? And we just kind of collaborated and said, what could we provide? So what we found was that the basic knowledge is easy, understandable, but then it was how do I do due diligence correctly, systematically? How do I filter tapes down easily or faster? Because I can know what I'm looking for, just don't know how to do it faster or systemized. And that's where this came from, right, Nathan? Yeah.
And we're just, again, there's a lot of really great courses out there. I've got one, Dave's got one.
There's
mostly it's geared towards kind of basic knowledge, and that's great. And you've got to have that basic knowledge. I was talking with a friend at the IMN conference where we're saying notes is not like real estate investing, where in real estate investing you can be like, okay, let's go out and buy a house and rent it out. And pretty much anybody can do that. For notes, you've got to have more information. You've got to have more training. And so that's what we're offering here is to give you that training, because it's not like real estate. You can't just go off willy-nilly. You've got to know what you're doing to get.
And the resources we're providing will be immense. So you're going to benefit from that. The homework assignment is geared for those people who want to learn on the job kind of thing and say, we're going to a deal. You're going to have to break it down and figure out the problem and give us a homework assignment back before class.
Yeah.
So it's really, really, really intense. So it's really cool. But we wanted to bring on our special guest who introduced us to this whole world of bringing on this idea of bring new investors who got basic knowledge into the space, but then bring them on and say, let's bring them to the next level.
Mm-hmm.
So Candance is joining us today. She's not a new investor, right? She's done a few deals. Candance, welcome. Thank you for joining us today.
Hi, guys. Thanks so much for inviting me. I love your podcast, and I've listened to a ton of episodes since I met you and have learned so much.
Good.
So how'd you get started with notes? How'd you get involved? How'd you hear about this world of notes? Were you landlording? What were you doing?
Yeah. So you guys know me. We're friends. But for everybody who doesn't know me, I'm a solo parent. And a few years ago, I was looking ahead to this time in my life. My youngest son just went to college. And so I knew that I would be ending up with a lot of free time. And if you have kids, there is no such thing as free time. So like, what am I going to do with my life?
1 second. I'm sorry. They're saying they can't hear us. So let me figure out what's going on. I apologize, guys. Let me see what's happening. 1 second. I apologize, everyone. Hopefully there's more sound, Cindy and all that stuff. I was not looking at the chat comments. I apologize. Hopefully you guys can hear us now, and it's better. If you can, let us know. Hopefully.
As always, we record it though. So
yes, always go back and check it out and figure out what's going on. Still no sound. Let's see. Give me 1 second, guys. Check 1, 2. Let's see. That should be 1, 2. There we go. That looks better. All right. I'm not gonna start from the top. We have this recorded, right? So I apologize, everyone. So hopefully you hear that. Stacy, Cindy, Theodore, Marco. I appreciate you guys chiming in there and letting us know that we're having a problem. So hopefully that fixed the problem. Hopefully that corrected the issue. I'll just wait for quick responses on that. Yay! Thank you, Marco, for informing us. So
good stuff.
Go back real quick. We're gonna summarize real quick. We started some beginner courses. We know that people start beginner courses, but a lot of people want the in between. And what me and Nathan created was a 5-week course on how to go from the beginner stuff to more advanced stuff. Collateral file homework. You're gonna be homework, rolling down tapes, bid calculations, stuff like that. We're gonna give you homework assignments. So this 5-week course will start on the 25th of October, Tuesday night, 8 o'clock. You can learn more at our website. You can take a look at it. We'll post in the comments below. And that's a 5-week intense course where you can bring a partner for half off. So
come and join us.
Back to Candance. Candance is one of the people who came up with this idea for us to start off with, for those people who has done a deal or two or has done beginner course, but wants that next level, right? So with that being said, Candance, welcome back to the program, right? I apologize, I hadn't restarted. It was a button unclick. So, kids, how did you get involved with the notes and all that good stuff?
Yeah, everyone's gonna eventually hear what I first said, but I'm really big on living your life by design. And so a few years ago, I was finishing up graduate school. I went back to school after my kids started school. I'm a solo parent, and as I said, like if you have kids, there's no such thing as free time. And I knew that in a few years, I would be having a lot of free time. My youngest son just went to college a few weeks ago, and I like to look a few years down the road. So like, what am I going to do with myself? I had a lot of ideas. Am I going to go back to school and get my PhD? Am I going to get an MBA? Like, what am I going to do? One of the things I was interested in was commercial real estate investing, and I wanted to learn more about that. I'm in my mid 40s, and as much as I love school, I knew I would not want to be doing homework and research and writing a thesis.
Yeah.
I want to take the summers off. I want to work in my garden. I want to travel, and working for someone else or being in school doesn't allow for that. So I'm like, well, let's learn about commercial real estate investing. I know some people in office and hospitality, and I was in a room about maybe 5 years ago where I heard about a development deal. I'm like, well, that sounds interesting. And I said, is there a way I can get in on this? And they're like, oh, funding's closed. And the next year when I was in the room, like I had done a little more research, because in the conversation, I heard a term that was totally unfamiliar to me, and that was accredited investor. And I went home and was like, I knew that I'm like, next time I see these people, I'm going to be prepared with some better questions. Well, I learned that I was an accredited investor.
What?
Right. I'm like, okay, well, this is a new, like, I don't know what that means, but apparently there will be some options for me. And so I went back the next year and had some better questions and said, hey, is there anything else like this happening that I can get in on? I'm like, surprise, like I'm an accredited investor. And, can you point me in a direction that I can learn? I'd been in school, so I didn't have 2 years of full-time employment. I wasn't going to qualify for a mortgage to buy a rental property, for example. And I didn't know the term leverage as it applied to real estate, but I knew that's what I wanted to do with my money. And so, like, I'm not trying to put a couple $100,000 into a condo and, get $600 a month. Like, how can I make it grow? Well, I learned two things that day. I didn't really get the guidance I was looking for from that person, which is okay. They've become one of my biggest supporters. Like, they didn't really know what my vision was. I didn't really know what my vision was. But it led me to look for places where I could learn and grow in this space. So I looked for a women's real estate investing group, and I found one that was having a 3-day seminar like a week later, which was awesome timing. And I went to that seminar and learned about all the different asset classes and ways to invest. I learned about syndications, buying land, and this really weird and confusing thing called notes. That was about 3 or 4 years ago. If you've never heard of notes, like, nobody's heard of notes. Everybody has a mortgage. Nobody has heard of notes. Right. So it's very strange. I dug into a couple of areas of real estate, and that was one that really aligned with what I want. We have freedom and flexibility and options and how to pivot. And that's what I loved about notes. So that's where that's when I started investing in my own education started. And then, 2 or 3 years later, here we are, and I have a few assets under management, and I'm not brand new, thank goodness, but I am newer and learning every day.
And there's a lot to learn. And we've talked about this before, Dave, where it's hard if you're teaching notes, it's hard to say, here are all the possible things that could happen, because they're limitless. Everybody's got a story, everybody's got their own situation, and in a lot of cases, it's really a case-by-case situation. And then, like, okay, so what do you do here? And it's a different situation because it's a different person, it's a different asset class, it's a different state, it's a different county. And a lot of it is just kind of on the job training, and you just kind of figure it out as you go. But that's one of the things I love about it, is that it's different and it's exciting, and you never know exactly what way it's going to go, which can be fun. It can be frustrating, but it can be fun.
So Candance, what about note investing was so attractive to you that you would switch away from your goal, which was commercial real estate? What was it about notes? Was it one thing, two things, or was it a person, like someone came around, like really kind of held you and said, this is the way to go?
A combination. My education has come through our friend Paige, and she does an amazing job educating. And I gained a really solid foundation and kind of went through all of her levels of program. So that was the start. But, and it's like, this is a relationship business, at least to me. And so it's like, who do you want to align yourself with and who do you feel good about learning from? But from the notes aspect, I really like that there are all the ways to pivot. That makes me feel safe.
Mm-hmm.
If plan A doesn't work out, we can have a plan B, C, D. And that really works for me. I like that flexibility and those options. So that's what I love about notes and the ability to scale.
It's very much a thinking game.
Yeah.
Where you're like, okay, this didn't go the way I thought it was going to go. And then, okay, so what else could we do? And you get creative and it's very collaborative. You can talk to me or Dave or anybody. You can talk to just about anyone. And it's a very open community and we like to share ideas and war stories and all that kind of stuff.
Yeah.
That has for sure been one of the greatest things. If anyone newer is listening, go to conferences. This year was my first year going to conferences. I met Nate at DME and met Dave a couple months later in Las Vegas.
Yeah.
Get in the room and learn from people because everyone is so nice and helpful and will totally like bring you along. And I'm glad to be, joining that group of people who can be helpful to whoever's a few steps behind.
So there's a lot of people who've said to me, I'm very intimidated by conferences, right? I don't want to go there. I don't know much. I'm going to be around a bunch of people who talk probably way above my level that have millions of billions of dollars that I just don't. What do you say to those people who say conference is a big deal? Is it a big deal?
Oh my gosh. I've only told a couple of people this, but now I guess everybody can know. I was terrified to go to my first conference. I mean, I knew Paige and I knew the people that I'd gone through her education with and have some friends. Nobody I knew was going to be there. And I almost didn't go. And I just said to myself, literally like, Candance, if you're going to do this, you have to do this. And are you doing this or you're not doing this in your life? And I went and my strategy was find someone who looks nice and sit next to them. A lot of what I heard at the first conference, and even, every time, there are always going to be smarter people in the room than you. There are always going to be people who are talking about things you don't know. That's the point.
Yeah.
That's how you learn. So most people are really friendly. Stand around in a group, say hi, introduce yourself, and take notes because the list of what you want to learn about is just going to grow. That's okay. To me, that's kind of the whole purpose.
And it's interesting too, when you get into a conversation, we kind of talked about this at the beginning, you can get in conversation and you're going to get different points of view and different opinions, and that's good. And you want to have as many different opinions and points of view as you can, so that you can say, okay, so that you can start to kind of put those pieces together and say, so in this situation, I could do that, or this, that seemed to work for this person and that didn't work for that person. And that's all part of the education, all part of forming where you're going to go.
Yeah. And with that said, like a lot of people ask the question, well, should I go first or seconds? You're going to talk to a bunch of people who do all kinds of stuff, right? Is it overwhelming at first?
Yeah, yes, because I know I have a solid foundation in the notes business, but you can't learn about all the parts no matter where you get your education from. And so I did go to the conference, and here I learned about partials. I learned about, Paige doesn't do first, and there are reasons for that. And then there are these people who are seconds. Then there are people who only do seconds. I'm like, well, that's a new perspective. Yeah, it's a little overwhelming, but when you're new, like the shiny object syndrome, like everything's amazing, exciting. And it is like, that's the great part of this.
Yeah.
You don't have to do everything. And hearing about these things that everyone else is doing, at least for me, is really helping shape what I want to do and how I want to grow my own business. It's a wonderful thing. You can't pick everything. That's okay. Figure out what aligns for you and what you want. Are you doing this as an investor? Are you doing this as a business? There's no wrong answer.
Right. Yeah. A lot of it is just personal preference, what fits you best, and go for it.
Absolutely.
That's really cool. So what's your do you have a favorite conference?
Yours, obviously.
That was a leading question.
If you all don't know, Nathan is hosting the DME in a few months, and I just told him, like, I haven't scheduled a trip to Portugal with my brother until I knew when his dates are. Every couple of weeks, he's like, "Do you know when it's happening yet?" I'm like, "I don't know," and I'm going to the DME next year.
Yeah.
So everybody should go and support Nathan.
And yes, come to mind, but go to anyone.
All of them.
Go to
Oh,
all
man.
of them.
I just was with Dave in Orlando, and that was my third conference of the year, and I have 2 or 3 more coming up this year, and every single time, like, life changing.
And you meet different people. I mean, I've been doing this for years, and I just met some new people at IMN that are going to be great partners, and we're going to have, we're going to do some really cool things together. And that's, so many years later, and I'm still meeting new people and getting new ideas and things. So it's great. Go to conferences. Go.
If anyone is feeling overwhelmed about the idea of going to conferences, the way I look at it is, I don't need 1,000 friends. I just need 10 really good ones.
Yeah.
You don't have, my first conference, like I said, I was so nervous. Literally, my only intention was like, if I exchange business cards with 5 people, it will be a success. Well, I walked away with some people who are going to be friends for life and business partners, and set your intentions small. Have the goal to meet 1 or 2 people. That will be worth it to you, and you grow from there. Build your confidence from there.
I actually did the exact same thing. I'd forgotten about that, but my first conference, I was like, 20 business cards. I'm going to give out 20 business cards. That is my goal. And I got it. And it just balloons. It goes from there.
Yeah.
So people get in the space and they get completely overwhelmed in different directions. If you restarted right now, how would you get to where you are today, I guess, faster? Do you think that you need to learn all these little parts to get to where you are? Or was there a fast track that you could have used to get to, I'm going to buy this note based on some kind of, hey, my personality said this, this, and this, I'm going to go this direction?
I think I'm moving pretty fast. I did kind of my big advanced education at the beginning of 2020, like the first half of 2020. And then last year, people ask you, like, when you get in the space, everyone will say this, when you're looking for assets, they're out there and you find them through relationships, but people are going to want to know, what are you looking for? And you need to know why. And people ask, like, how did you learn about notes? How did you get into it? And I've heard a lot of people say, like, not to me necessarily, but why, if you learned about this 3 years ago or 10 years ago, why don't you have a note yet? What's the delay? I didn't get active in notes last year because it was a big licensing year for me in my other profession. And so I was balancing building that business. But I was totally ready to go. So I knew that as soon as this year started, that would be it. And then as soon as I started, I have closed on 1, and I've originated 2 notes. 1 was commercial, and that exited pretty fast. That was securing collateral for a bridge loan. And then I purchased 5. I just closed on 2 more assets yesterday. So nice. I think I'm going pretty fast, but definitely get your education. There are so many places. Ask questions. I think what holds a lot of people back is fear.
Yes.
And I was thinking, you said, like, we're going to talk about your journey and then what hurdles you've overcome. And I was thinking, what hurdles have I overcome? Fear was a big one.
Fear of what, though?
Losing money, losing my kid's future. Not
noteworthy into it. I like it.
Not trusting, not getting aligned with people who are trustworthy. I don't worry about that too much because there are a lot of great people, and just got to follow your intuition there and ask questions and ask around. But how do I not mess this up? And I've had some great mentors, but before I took action, I was asking a couple of friends and my financial advisor, my accountant, like, how do I not mess this up? How do I not lose what I have? And I received the best advice that allowed me the kind of the piece to move forward. And they said diversification and due diligence. Okay, well, those are two things that are in my control.
True.
Right? We can learn how to do thorough due diligence, and we can choose not to put all our eggs in one basket.
Yeah.
And that's what helps me sleep at night. And so that's what helped me move forward. So one, get some education, make some friends, and move through your fear. Small steps if you need to, but just do your first deal. Like, I just need to get my first deal over with so I can start learning the lessons and, move forward smarter.
Yeah, Stacy Michelle said in one of the comments here is that you're not alone. She was terrified in attending the first event too. I soon realized it was not. It wasn't what was in the head of, oh my God, I'm going nuts. This is going to be overwhelming. So Stacy, thank you for sharing that. We were talking at the conference too about this, and this is Nathan I've said repeatedly, is how do you find out who's trustworthy, who's not? And what Notes is really different from a lot of sectors is we're real small. So if you ask any 3 or 4 people that you see repeatedly around about a certain person, you're going to get a response that are usually pretty common, either yay or nay, right? But so you get that confidence in who you're talking with before you get into it. And the other parts are confidence builder, right? If you're confident in your due diligence, if you're confident in your analyzing, and you're confident in your math, it actually comes about to reduce your risk, not eliminate, but reduce it.
So
Yeah.
I'm curious, Candace, now, so you did a bunch of training and you learned a bunch of things, and then you bought a couple of notes. Have there been any surprises, any things that you were like, oh, I didn't learn about that?
When we do a follow-up on this in like 6, 9, or 12 months, I bet I'm going to have a lot of lessons to talk about on these like 6 or 7 assets. I just know it. It's like waiting for the lessons. The thing so far, I learned a little bit about how foreclosure, for example, or bankruptcy can play a role in the note space. Those are huge areas on their own. Mm-hmm. Insurance, huge area on its own. I'm sure I heard about statute of limitations, but that's not something that I had retained. I'm like, okay, well, this is something I need to brush up on. Yes. Over the last couple of months that I've been dealing with these assets, like you send someone out to do an inspection and they don't do it as fast as you're expecting. Like, gotta be on top of things and follow up and allow some margin for things not progressing at your own timeline. So those are some challenges right now that I'm learning.
One of the biggest questions we get from newbies is, where do I find assets at? How difficult was it for you to find assets? Because that's something we don't crack, right? It's hard to crack into that world. How did you find assets the first couple you're buying? Was it through a mentor, through someone you knew, or through a tape you saw? And B, when you got that note tape, how did you work through it and know what you wanted?
Right. So I'll start with the second part first. I already knew what I wanted because through my education and training, like what's your buy box, why, know your why. I already knew what I was looking for. And I have I don't know if it's a calculator or whatever, like a big spreadsheet analyzer that breaks it down. I put in the assets and that helps me narrow it down. But if it's a smaller group of assets on a tape, like I can look because I'm organizing by state, I'm organizing by, securing collateral value. That's going to be how I narrow it down first. And that eliminates a bunch. So those are my criteria. Yeah. How do you find assets, man? It's like the one secret. Nobody's going to tell you. But they're out there. As someone who didn't grow up in this space, like, oh my God, the amount of money available in the room is like, my brain doesn't even go that big. Yeah. But obviously, like our friends who do paper stack, right? They're online market, like trading. I don't know exactly what that's called, but like trading platform. That's a great place for new people to look. Yep.
I agree.
And see who's on there. Like, reach out. Hey, can I ask you some questions? Get to know people. I hate saying the same things that I hear from everyone else, but it really is the way. One of the ways that I found that I got my first couple of notes was through relationships. You know, a couple of people that I had known for a few months independently said, you know, what are you looking for? And I said, look, I'm really trying to get a couple of notes purchased so I can get learning about this in real life. And I have this capital, and like, that's what I'm ready for. And one of them said, maybe, you know, let's partner, and, you know, you have some capital, I have some capital, like, I'll bring you in, like, let's look at a tape together and see what we can buy together. Partnering is an awesome idea. I've offered that to people who I know that are, you know, at my level or below, like, let's do this together. And then the other one was, they said, look, I have a tape. I can't buy anything off of it right now. So, like, let me broker these to you, which was amazing. Like, the biggest favor, because I really was hoping for that timing to come through, and that helped me get going. And since then, you know, I've had other people reach out to me and say, I know you're doing this. Like, I have this asset. So I get calls and emails about that, kind of from random sources, just literally just from meeting people and making friends.
And you know what? That's a big deal. If people know that you're for real, you've got money, and you're actually ready to perform,
Yeah,
that's a huge plus.
absolutely.
Because the tire kickers are not worth the time, honestly. And I know that kind of sounds a little bit harsh, but people want to deal with people that are ready to go and are actually going to do what they say they're going to do. And so when you've got that and you're ready, then you get calls. People reach out to you and say, hey, I heard you got some money that you want to spend.
Right.
Do you want to buy what I've got to sell?
Yeah. And, you know, everybody doesn't have, like, oh my gosh, so, like, we know that deals are out there, but then when they really do start coming across your desk, it's like, I just want more money to, like, it's hard to let deals go by. So one of the things, like, how do I build my network? How do I pass these along? How do I make this happen? But that does happen for sure. And if you don't have your own capital, like, figure out who you're going to partner with, get a JV agreement set up, and have that ready to go. So you can just say, I'm looking to buy. If you have anything, let me know. I hope it's as simple as that.
Were there any gotchas that you didn't realize when you got into your notes and you actually live do it? You're like, oh crap, like I'm a little underconfident in this area where I don't know. Was there any of that stuff? And what'd you do to get over that hurdle?
Oh man, I'm terrified. I think I fought well. Like, we'll see how they exit. This last weekend, I was sharing that, and someone who's been doing this for decades said, look, the problem, like, your experience is going to stay the same even as your level grows. You know,
Yeah.
if your stomach doesn't turn a little, like, you're not an investor.
Yeah.
So I definitely, in those areas I mentioned, like foreclosure, insurance, bankruptcy, really want to learn a lot more about that. You know, the legal side, you know, when you have to deal with the attorneys about the stuff that comes up with borrowers, like, I want to learn more about that. Even if that's not my role in the business, I want to be educated so I can, you know, manage that part with whoever I'm partnering with.
What assets have you bought so far? First, seconds? I know you bought
Only
a first.
first.
Yeah.
Yeah, only first. So I'm looking at my whiteboard here, like, got everything so I can see it easily.
Nice. That must
Yeah.
be, yeah, that's awesome.
So what was your question? What assets have I bought?
Yeah, what kind of assets? First, seconds, performing, non-performing?
Yeah, I looked at first, non-performing, and all of these happen to be vacant with the deceased borrowers, and they're in foreclosure. So I like REO. I'm really happy with REO. I know everybody doesn't like that model, but it totally works for me. So even though that's not what I was expecting to start with, I'm loving it. A couple of the assets I will hopefully price at foreclosure so that they'll go. Cause I mean, I want to turn my money faster, but
Yeah.
a few of them I'm going to keep. So, and then originate notes from there. I think that's what I really like.
Which is also really fun. I like originating.
Yeah.
That's good. We got a flattering and potentially embarrassing comment. You ready?
Oh, who's it from?
Marco
Marco?
Barrio.
I love you, Marco. Let's have it.
Marco says, I had the opportunity to work with Candance on a potential deal. She has integrity. That's number one for me when choosing a partner.
Thank you so much.
Yeah. There's
Thank
a
you
lot
so
of
much.
great people in this space,
Yeah.
and no one's better than others. It's just different experiences.
Yeah.
And talking to everyone's a key thing. You know, people say, well, I listen to this person. Listen to everybody. There's so much knowledge out there, and it's all based on experience, based on what they've done, right? You could take someone that I've never dealt with, that I've never done with something with, and they're brand new, and they could teach me things.
Mhm.
That's the cool part about this. Your first deal, you probably didn't have this fancy dancy calculator like we all have and all stuff. How did you pull that trigger and actually make that purchase and feel confident, or 50% confident that you're doing the right thing?
So, I mean, it's probably a calculator. I didn't build it, right? I got it from my training program. That's something that I paid for. What I have learned is that I don't understand how it works. And I know that, oh my God, Dave, my brain is not, you're just a freaking numbers genius. Like, you talk fast, you think fast, you know how numbers work. That's something that I want to learn to figure out, because I have this tool which will break it down for me, but I want to learn what's behind it so that I can make adjustments myself and things like that. So that helped me because I already knew what I was looking for and I had guidance. So, the person who's like, let me arbitrage these with you, I asked, hey, this is what I'm thinking for a bid range. How does that sound to you? I don't know what people are bidding. I don't know if people talk about that or not, but I don't know what things are going for right now. And so I said, here's what I'm thinking. They said, that sounds good to me. And it ended up working. So that's how I felt confident at first, but honestly, not 100% confident. It's scary. Like, how is this going to go?
It is scary. It's money that you're putting out, and with the potential return somewhere down the road, 3 months, 6 months, 18 months, we don't know. And that's kind of the exciting part, but kind of the scary part, especially at the beginning, where you don't have the hands-on experience to know that, yeah, this really works. It really does.
Yeah, definitely.
So you approached this in Vegas about beginners and newbies and stuff like that. And the insight that me and Nathan gained from that is tremendous, because we don't know what other people don't know. And it's to talk at a different level sometimes is difficult for us, right? Debbie Anderson said the bid range for non-performing seems incredibly high right now. We're going to talk about that in a minute, because someone actually had a conversation with me yesterday. We talked about what's hot right now, what's the good pricing. So Debbie, good question there. What we found out was that confidence was the core guide to success. If you're confident in the fact that I'm going to make a good bid based on good numbers, and then I have resources and tools moving down the line. I know who my servicer is. I know who my attorney is. My collateral is solid. I can move forward with the fact that the risk level is there, right? So for me, when we had that conversation with you, me, and Lorraine, was how can we help, right? But the problem is, at the same time, that these things get complicated, overwhelming. Like you said, your calculator does. Is there a way for new investors to kind of get into this without being overwhelmed with the calculator? Or are you going to decide like you need to learn this stuff, even though it is complicated?
I think having someone that you can check in with is crucial. Is it a paid mentorship? Is it a buddy that you met on, at Urea, who also wants, who's been doing this? Is it your new group? I love that one of the things you're building is, let's go through this next step together in our 5 or 10 week course, and then have that cohort of people at that level. So I think that's critical. Can I pick up the phone or send an email and like, Jean, like, what do you think about this? Like, am I thinking through this correctly? or who do you know that does this if I have a question? So important to have somebody to bounce that idea off of. And I think that's critical. Or, there's always the option of, if you're ready to go, or you're almost ready to go, ask someone who's doing it, hey, can I bring you a deal? Will you walk me through it? You keep I'll bring the deal, you keep the profit, walk me through it so I feel safe, and then I'm going to feel confident. But I think you guys are providing that, and a lot of people provide that in their groups and training and mentorship.
Yeah, I think you said a good point. The network of people, that's why the 5-week we're going to do is that getting together with just not one person, not just me and you, having that brain of power together on a weekly intense basis that wants to succeed just like you do is crucial. Why do you think me and Nathan talk off air, right? We need each other to bounce things off of, and just ideas and thoughts and brainiac stuff. So well said.
Yeah, all the time. And we constantly do that. Like we've got our own private Facebook group for our class. We'll do a private Facebook group so that we can just chat together and say, okay, so, what are the challenges? What are the things you're coming across? And what are the things that you're wondering about? What does this acronym mean? Anything like that, where you're just not sure.
Yeah.
There's ways to find out. And if it's part of a group that you've joined where you can have a private group, so you're not putting that out on the World Wide Web and feel like an idiot, that's fine. And then you've got that kind of that safe space to do that.
Yeah.
And if you have a question, someone else has the same question. Nobody's just saying it.
Yeah.
For sure.
Nowadays, ITV's out there, LTV's out there, BTV's out there. These new acronyms are coming out because of the way the market is. And if you don't know what it is and you ignore it, you're going to have problems.
Yeah.
Right.
Yeah.
I think that with collaborative talking allows you to actually partner with someone without actually partnering with them, right? Allowed you to connect with someone and say, hey, I'm looking back to this deal. What does everyone think about this situation? And having that confidence and trust in that group to really dive into it and solve those issues. We're talking noteworthy. I think one of the people who spoke that got the most attention was Ken, who literally had the room write down their fear, like true ultimate fear of if I fail, or what your fear is, your spouse, whatever. And it was really cool to see that opening up and that having that true feelings was really crucial. And like Nathan said, we have a private Facebook group of about, 8, 9 investors. We've been doing it for 7 years, and we share our private conversation to each other and bounce real true ideas off of. You need that team, not that person, but that team to really bounce ideas off of. That we may not have the experience, or may not be in an area, and you may have someone who has that experience in there.
Well, and we share successes and challenges and failures in there as well. And and we always say, Gabe, he's got these amazing deals.
He's got the Gabe cast, right? Like,
jealous,
right? But he's killing it, right? And he's killing it his own way.
Yeah. Right.
So it's all different stuff. Stacy made a comment, the best way to partner with someone who's done the kind of deal you want to do. We've talked about mentoring, and my Facebook group that I'm offering, the person with the most comments, whatever, the 2 weeks we'll do a mentoring. But we have to realize that to partner with me, Nathan, and stuff like that, that's a lot of time of our time, right? And we can't always teach one person for weeks and weeks, because it just doesn't work out well for both sides. It's frustrating. So I agree the fact that partnering is good, but having that collective group is even better. So yeah, definitely look at stuff. Candance, I want to know, now that you're getting experienced and you have this recognition of people, and you've been to the conferences, and someone says, I'm stuck, what question would you ask them to figure out where they're stuck, how to get over that feeling of being stuck? I don't know what to do. I'm lost. How can they do your professionalism, right? How do you get to that level of, I don't know?
We're gonna settle in, boys. We're gonna have a therapy session. Time for some group counseling. I've been there. I've for sure been there, and I think we've all been there. If if you haven't felt stuck, I don't think you're committed enough to the growth. Honestly, or you're just really, really freaking lucky. I don't know anyone like that, but don't tell me if that's you. You know, it's really what are you afraid of?
Yeah.
What don't you know? If things were going the way you want them to, what would be different? You know, like, oh, I don't have anyone to call. Oh, I don't know about this thing that I heard. And I think when you can bring yourself back from the emotion, like name it. sorry, here's the therapist to me, like figure out like what is your emotion. It's like, I'm scared, I'm nervous, I'm frustrated, I'm confused. Okay, great. Acknowledging that. Then it's the facts. It's like we should not be making decisions from emotional place. We should be like figuring out what's real. Okay, what's real? I know some people. I'm in a Facebook group. There's a podcast. Do I know where to go? And I'm scared to do it. Okay. It's just like, I don't know. I think it all comes back to people. Who can I ask about this? If you tell me you're stuck, I'm going to say, how can I help you? I think almost anybody would say that.
Yeah.
Does that answer the question?
Yeah, I think sometimes is walking them through that issue or problem or concern is the key thing to figuring this out.
Yeah. And I think I have more time than you guys do for this right now. And so someone I met at the last conference is a little bit behind me and was talking to me. And I said, look, you know, you're not at the point of buying assets, but you're curious. Like, let's jump on a Zoom. I'll show you a tape I reviewed and like, I'll show you how I'm thinking about it and we'll go through it together. I'm not the expert in the room, but I'm happy to share what I know and show you how I'm starting with this and see where I can direct you, you know, beyond what I know.
Yeah, I think what you say makes a lot of sense, right? I think for a lot of new people, for us, we hear, I'm stuck, I don't know what to do. I can't help that. We need you really to kind of figure that out and help us help you. Right?
For real, you need to know where you're stuck.
Yes. Thank you. Well said.
You need to know what's
Cadence
wrong.
we love. Yes. Yes.
But you did like Ken was saying, like you have to sometimes dig down a few layers to figure it out. So if you don't know that, when you know what you need, find someone and say, I realize what I need. Can you help me? Or do you know someone who can? Then it's easier.
If you were to do it all over again, you would do the trainings and stuff like that. You would do that formal education, the resources, all stuff. Do you think if you started over again and just didn't do anything, watch YouTube videos, you would be anywhere close to where you are today?
Oh no. No, but you know what? It would have given me, if I had started there, I think I would have had more understanding about the space before I got started. So it might have accelerated that, but no, absolutely not. I mean, like I said, I learn a ton from your podcast. I listen to a few others, and I learn something every single time. But that's the really slow route to, you know, getting change in your life and making progress in this space. That's the slow route. That's when you're driving home from work saying, I don't like that, you know, I want something different in my life. But when you decide that you're serious, you know, that's just not going to cut it for me.
So what is your goal? What's your goal 5 years down the line, right? Where do you see yourself going with this?
Candace the planner.
Candace the planner.
Hold on, let me go with
Oh
my
my gosh.
notebook. Yes. How long do we
No,
got?
I know exactly what I want. It's just honestly, I'm still developing my idea of how I want my business to grow.
Cool.
But I'm narrowing it in a lot. Like I said, always learning. Every conference I go to, I learn something new. Every person I talk to, I learn something new. I'm starting to really narrow in, you know, I'm not going to end up buying it across the country. I'm going to be narrowing it on about 5 markets and building teams there. And that's what I think is going to work for me. So, I mean, 5 years from now, I'm going to be the girl who's friends with everyone and is making a boatload of money. I don't know.
That's awesome. So If anyone has additional questions before we tune off, please feel free to ask Candance. She's doing this for about a year or so. She's had some education, she has some training, but she's actually jumped in. A lot of people can't say the same. They've had maybe education or attended these conferences or one or the other or neither, and they haven't done anything. And to get started, they have to do something. How, when you're getting into this space, it's overwhelming and whatever. And there's a lot of different people in the sector all over the country. Like Nathan's in Canada, I'm in Jersey, right? It's all over the place. When you go about this whole course, right? How was it for you to connect with others, right? Was it something you were out shooting out to do, or was it something that came natural with the group that you connected with?
I feel really fortunate that I found that educational group that was just about real estate in general, because it connected me with a lot of people, and it was designed like there was a small group component that a lot, that you guys have, that a lot of trainings have. So that helped me for sure. And then I kind of narrowed in my niche from there. But will you repeat your question? What are we asking?
Others. A lot of people either standoffish.
Oh, right.
How was it for you?
I'm always a little nervous about that, but as soon as you put yourself out there, I think you just have to show up and be who you are, right? Everyone says it, just say if you're new. If you just say, hey, I'm new here, nobody cares. Everyone's going to be extra nice to you and bring you in. Just say that. And I think that opens a lot of doors. But it's okay. It's okay. You don't have to connect on this huge level. Just find one or two people to connect with to start building your community. I don't know. That's what brought me some confidence.
That's awesome.
And see if it's the same experience for you. But the people that I learned with years and years ago, I'm still, we're still in contact all the time. We're still, exchanging ideas and things. And some have moved on to other things and others are still in business, but we still keep in touch, and we still talk about like, oh, do you remember 2009 when we had that class? Years and years and years ago. And they're lifelong friendships.
Yeah. It's funny, you go on social
that.
media and like, you talk to your personal friends, like, who's that person? Oh, they're in Alabama. What do you even do? Like, it becomes a different world for you, right? And you get sucked into it, and that world becomes part of you. And I think it's really cool. And it's exciting to have someone new kind of walk through their journey and see where they're at today. And we'll check in, I'm sure, in the future. And we'll be bringing some of the things on here that Candance has brought up. One of the questions regarding non-performing assets and whatnot. You have to be mindful what you like, but you also have to be mindful of what is well priced. What does well priced mean? We say go based on your desired return and back into it. So if you're looking for an X return with all your expenses and income, what's your best purchase price and what is selling right now? Non-performing notes are expensive right now, right? Because of the fact that demand is high and supply is somewhat low right now, but it's going to start peaking right now, right? Things are starting to change. We're watching ARMs real closely to see how many ARMs are created now, because ARMs were one of the big factors of 06, 07, 08. So we need to look at that kind of stuff. But yeah, non-performing notes are high priced, but granted, go buy an REO. What are you paying for that? If you're in real estate and you're looking for an REO, you're paying retail, right? You're paying 95. So yes, they're expensive compared to before. But when me and Nathan bought in 2010, 2011, they're never going to get that price again, right? No. So it doesn't mean we're not going to buy. We're just going to be very strategic of what we're buying and how to make things happen.
Yeah.
So good question on that. So Nathan, I don't think people heard you before, so I'm sure it'll be on the recording on YouTube. Maybe you can watch this on the YouTube channel, which will have all the audio. We record this on Zoom. Nathan announced he has a big announcement that he'll be launching publicly next week. Nathan.
Yeah. So
a drum roll, but
finally last week, after extensive search, We finally nailed down location and time for the Diversified Mortgage Expo, which is coming up June 2nd and 3rd in Nashville, Tennessee. We'll be at the Hilton by the airport. And that's very exciting. It's a beautiful location, 20 minutes from downtown if you want to get downtown Nashville and go see the sights and everything else. But if you want to stay near the airport, that's fine too. Come the day before, we're going to do a big axe throwing tournament. So we'll have an axe throwing DME champion, trophy in the whole 9 yards. So if you're participating in it, awesome. If you're not, it's a fantastic networking activity. You can come and meet some people and have some fun. And
Yes,
all that
Debbie,
kind of stuff.
June 2023.
Yeah, June 2023, 2nd and 3rd. So mark your
Don't go to the
calendars.
website yet. This isn't public. He's letting us all know before he got actually officially
coming.
launched. So
It's coming.
yeah.
I just got home, guys. Give me a break.
Yeah.
I gotta
Hey,
update it. It'll take me a minute.
Before we wrap up,
Yeah.
what Nathan just said reminds me of something that I think will help anyone who's new. The first conference I went to, I said who I was. I said I'm new. I asked some questions, but honestly, almost every conversation I had was on the personal level.
Mhm.
So when you say, it's a great networking and social activity, that's, if you're nervous about the business side, or you're like, I don't know how to have these conversations, just get to know people. Where do you live? What do you do?
Mhm.
That's where everything started to build for me. And then I know that unless you're listening later, if you were listening at the beginning, Dave just mentioned how it's a small space, and
Yeah.
we have friends and colleagues from all over. And I know that you brought up, the hurricane and
Yeah.
how
Yes,
it's
the
really
people that didn't
impacted.
hear it, please.
Yeah.
Oh.
I think you posted today the video of flooding in front of the resort that you
The
and I were
hotel
at
they're
5
actually
days
at
ago.
last week. Yeah.
Yeah. And, definitely on my mind, if you don't have friends in Florida, you definitely have business associates and colleagues there. And I think I'm going to do a post in the next week or two on some resources of how it's going to be easy to help some people get back on their feet
Mhm.
when needs become apparent. So if you don't like to do that sort of legwork, let me know and I'll be happy to send you an email or tag you on my post.
Yeah.
I hope we all give generously to the things that we care about. And, we've all got a lot of friends down there in Florida and on the Southeast. So
And I said earlier, I know it's muted, but if anyone is affected by that or know someone affected and there's something we can do to help, please reach out to
Absolutely.
us. We'll do our best to help you, connect you with something or whatever. And we'll do our best to help you out down there. But yeah, it's devastating to see what we see from afar, right? We're not affected directly, but we all can feel for what's going on down there. It's not comforting. So please make sure if you have connections or issues down there and we can help, please reach out to us and whatnot, which is great.
In the meantime, please be safe.
Yes.
Just so everything's
Smart.
going okay.
But we're gonna wrap it up there. Again, if anyone is interested in the 5-week course, we'll be bringing it up again, I'm sure. October 25th, Tuesday night, 8:00, we'll be starting. You can go to our website and check that out. That's a really, really cool thing that Candance and Lorraine brought up to us in Vegas. And we're really excited about bringing it up. Again, a lot of the resources we'll be sharing with that will be unseen before, statute of limitations, debt license stuff, things that we've never shared before. We'll be part of that group, bring a partner half off. But the homework to us in the networking will be the biggest part. That you're really going to have homework every single week, and you're going to have to bring it before class. And that will challenge you to actually pretend it's a note you're looking at, as well as connecting with others who are part of that group and continue to network with them so that and they know that you're in it together. So
we'll collaborate together so we can all learn at the same time. Excited to do that.
Well, Candance, I appreciate you joining us on this Friday afternoon, or a little earlier for you, but it was great seeing you last week. It's great seeing you again here. We hope that we're able to answer any kind of questions that people had. If they feel that you feel free to reach out to Candance online, send her a message, hit her up on Facebook and everything else.
Awesome. I think she's
Right.
frozen, but
Oh no, guys, at least we got an end smile from her.
There you go.
All right. Thank you, everyone. We will
Thanks,
talk to everyone
everybody.
soon.
Yeah, that's great.
Hey everyone, Dave Putz from JKP Holdings. Good afternoon. Mr. Nathan Turner was inside next to me. How are you?
Hello, hello. Very good, very good.
Awesome. It's good to connect. We had a great session last 2 weeks ago. We talked about a lot of awesome stuff. I would definitely recommend anyone who missed it, take a look at the podcast, the YouTube channel, whatever, you can get a hold of that. Recently, things have kind of started to change for me. We're seeing some new product that are coming from different areas. I know that recently we got a pool of assets. We talked to Paper Source with a gentleman about some seller finance stuff that's coming about, which kind of lends to what we talked with Tracy about, the seller finance world being something that's growing.
It is. It's an interesting time, and we'll one of the cool things about notes is it's very easy to pivot.
Yeah.
So if seller financing notes are more available and that looks better, do that. I'm also buying some reverse mortgages right now.
Ooh.
They're available, so I'm doing that. And just you can pretty easily just kind of go back and forth, and whatever's available, whatever works at the time. That's good.
Yeah. One thing about seller financing and notes in general is understanding the numbers. I want to let everyone know that I'm going to run a spreadsheet training course for everyone. Just to understand how to create a partial yield calculator. I could post it to whoever wants it, but it's going to be a 2-3 hour. You're going to create your own spreadsheet to understand time value, understand the formulas, and get away from this brick and mortar financial calculator that some people find confusing, where you can plug and play numbers on a spreadsheet, right? For me, I like the spreadsheet. It's not as grand as a calculator, but I think spreadsheets make a lot of things easier for newer investors to kind of grasp. Deal flow and deals, what's going on with you? We bought a few partials recently. We've actually looked at a few performing notes we purchased, and then there's 2 non-performing notes that we kind of back and forth on that I may not go with.
Yeah.
What's been with you? What's been going on with you?
I've got these. It's a few different reverse mortgages. Another. Just a kind of a regular first mortgage, and then I sold a couple of the loans that I've been holding on to, just because it's time, and I'm selling off stuff and getting everything kind of going into the fund, and so we're
awesome
winding down and building up at the same time. So it's a lot of fun.
That's awesome. For those who are interested, we had a comment. Just go to JKP Holdings /spreadsheet-calculator training, and we'll go through it. And I'll be talking to Nathan afterwards. We have some really cool stuff that's going to be coming about for September. So tune in for that kind of information. It'll be a training course. But with that said, seller financing notes, we both came from the institutional world. We did some lease options. The seller finance notes is the Wild West that we thought we walked into when we bought into notes. Notes was like this Wild West theory for a long time. And then we got to grasp at it. And then you walk into seller finance notes. I feel like I'm back to the Wild West on just different things.
I like seller finance. That's the same thing. That's kind of where I got my start. Is at the very beginning, I was creating notes, and I was doing seller finance, and so that was an interesting learning curve, figuring out how to write paper and how to make it a good piece of paper to be able to resell if I choose to in the future.
Yeah.
So I'm a big fan. There's all kinds of fun ways that people put them together, and they're a little bit goofy sometimes, but I mean, if people are paying,
yes,
sometimes that's all that matters.
Yeah. So without further ado, we have gentlemen here that's going to be tuning in with us. And if you don't know Jeff, get to know him. He's a wealth of information. His experience is no other. He's been doing notes for a long time, since the 80s, I know, right? And we ran into him at Paper Source. His knowledge is amazing, but he's a seller finance person, right? This is his bread and butter.
Yeah. I admire Jeff's analytical skills to look at it and treat this like a real business, like a real project, and something that can be tweaked, and you can look at different things and what works and what doesn't work. And I like that approach. I like, kind of the systematic approach to it. That's good.
So Jeff, welcome, man. How are you?
Yes, sir. Hello, guys. How are you? I'm doing good.
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 Well, let's start from the beginning. You know, we all start where we're at today. Some people that's overwhelming, some people it's exciting. Where did you get started with real estate and how'd you get into notes? And if you can keep it under 4 hours, it'd be great.
Yeah, that's the trick here. Well, let's see. Long story short, when I was 19, I purchased my first property, a triplex. I lived in one unit, rented out the other two, covered the mortgage. I learned that and I purchased that property at 19. I decided when I was young, about 15 and a half years old, I read the book, Think and Grow Rich. Someone gave it to me, and that's like the cornerstone of my success for sure. And in reading that book, I decided about 16 years old that I would never be a renter. I'd own. When I moved out, I was going to own and buy something. So I bought my first property when I was 19, a triplex, lived in one unit, rented out the other two. And then from there, I purchased and lived in and fixed up and moved several times. By the time I was 25, I had 27 doors. At 25 years old, I had 27 doors.
Nice.
And I was taking care of them all myself. We're talking within, you know, a half hour driving distance of my house. And being a landlord, I know it all. We can go over stories with that another time, but you know, landlording is not all it's cracked up to be, and neither is rental cash flow. You know, a lot of people tout, hey, I got a rental property, you know, the expenses are $1,200 a month and I'm getting $1,500 a month, and that's $300 a month positive cash flow until something happens, right? Until the water heater breaks and there goes 4 months, 5 months of cash flow, or a bigger expense comes up. So I was always, you know, people think, oh my God, 27 doors, you must have been rolling in it. No, I was barely making ends meet, keeping all the maintenance on all the properties, covering, you know, 18 different mortgages and doing what I had to do. And there had to be a better way. Went to a boot camp seminar. You guys know these dog and pony shows, right? You go to them free, come learn how to be a millionaire. And so I went to dozens and dozens of those. I tried everything. You know, I was an entrepreneur in a mindset, and I still am. And I went to this one, and the guy said, "Be the bank, not the landlord." And I was like, I don't have to be a landlord? What? Went back of the room within 20 minutes, signed up, $7,500 5-day boot camp, right?
Yeah.
Called in sick for a week. I was working at Ralph's grocery store in Southern California since I was 15 and a half. And at 25, I went to this boot camp and it changed the direction of my life. I was like, oh my God, this is for me. Now, if there were 200 plus other people in that class, after about 6 months, nobody was around anymore. They went off to the next shiny object. But I knew in my heart of hearts that this seller finance note business was for me. At first, brokering notes, and then eventually to buy them and be the bank.
Yeah.
And that's the short story of how I got into it.
Wow.
How's that?
What year was this?
This was 1991. Yeah, started in May of 91. So I just had my 31-year anniversary last month.
Oh.
And I do nothing else. I don't invest in anything else. No stocks, no crypto, no, nothing else, just notes. It's all about the cash flow. Sold off all the properties, carried back notes on some, got cash to buy notes with others, built up the portfolio. Life happens, got a divorce, lost everything, started over, and building it back up. It's been 11 years since the divorce, but you know, still got to build it back up to where it was. And you know, I know how to do it. So it's been you know, nothing happens overnight. And to grow businesses and to start these. And I'm glad you mentioned too, Nathan, that it is a business. We're not going after it like it's a business. We're going after it as it's a business. It is a business. And if you're just lollygagging around thinking that you're going to find a note by building a website, it's not going to happen that way, guys. Not these days.
Yeah. Yeah.
It's interesting you said all that. You know, we do have some members and people who follow us are probably born after you got started, right? It's kind of
absolutely. I'm not as young as I look.
And we want to make sure people understand that where you are today and which we're going to get into is not anywhere close to where you began at, right? It's years and years of work and hard work to get into where you're at today and the knowledge you have and experience you have. So can you, in the beginning, what were some of the hurdles you came across, the struggles that you had that they can probably relate to?
Well, the biggest hurdle is that you see the potential and everybody else making money with notes or supposedly making money with notes. And you want to be that guy tomorrow, next month, in 6 months, you know, and it doesn't happen like that. It is going back already to it's a business. And most businesses fail. 7 out of 10 businesses fail, any business, in the first year of their business, whether it's a restaurant, a gym, I don't know, a beauty shop, a storefront, you're starting an online business. I mean, most businesses fail in the first year. And this is just like any other business. If you don't attack it and think of it as a business, you're not going to last long as a business. We're not talking about just buying a note here and there for as an investment in your IRA and stuff. We're talking about running it as business. And I think a lot of people, when they get into the business, they think they're going to be successful in 6 months and in a year, and they don't give it enough time to really ramp it up and build your business and grow your business. And that's a huge hurdle I think people need to get out over, is that do I just want to dilly-dally in this, or am I going to have an actual business and one day hopefully quit my job?
Right. And nothing ever moves as fast as you'd like it to.
Never.
And you just got to understand that and be okay with it.
Yes, absolutely. Yeah, it takes time, and you know, since 1991, are there things I do differently now than I did then? Oh, for sure.
Yeah.
Right. I'm not as tech savvy as you guys, but you know, for instance, I didn't really start using Excel spreadsheets till about the divorce, 2011. So
I have an email that I just saw recently that said exactly that, which I was like, whoa, right?
Yeah, so that made me more efficient and things like that. But but I still use, hey, come on, don't diss the calculator, man. Right? I can't pull a spreadsheet up when I'm out on the boat and someone asks me about a mortgage. I can pull up the app on my phone, right?
This is true. This is true. And I think the difference between the calculator itself and the spreadsheet is that we get a tape of assets that comes in, right? Of 50 assets. To run 50 assets on a calculator would take some time.
Oh, absolutely.
You can use a formula and go right down the sheet and say, okay, here's my number. So yes, and there's certain things that spreadsheets actually struggle with the calculator. I'll be going into that eventually. They don't do points, right? It's not 34.38, it's 34 payments. It doesn't do, it rounds it off. And there's ways to avoid that. But for some people, that calculator gets overwhelming, right? And what they do is they just avoid it instead of working with it and understanding it.
Well, it's people watching this in the future and stuff. HP 10B2 calculator. I teach it. It's the calculator to use. I have a whole calculator secrets book with 120 plus examples and practice things in it. It is so simple. It's 5 buttons. That's it, guys. Don't be afraid of the calculator. I do usually one at a time from individuals, one note at a time. And you're right, when there's a lot more, when I get a tape in or something like that, you got to use the Excel spreadsheet. You're not running it through, or another program called T-Value I use a lot of. And so yeah, with the numbers, I mean, we can talk about numbers all day long, but yeah.
So you hear all about this, bank originated loans that we all pretty much came off of, right? This is what we did in 2010, and most of the people in the space did a lot of this origination loans, where you were in a different track, right? You did the seller finance world, where getting inventory, you're not getting a 500 tape asset list, right? You're putting in work to get asset lists.
Yeah. When did you guys start? What year?
2010.
2010. Yeah.
10. Okay.
Yeah.
So before the crash, there's not a lot of tapes around, you guys, right? There weren't, and you're talking about, we all deal with banks. Well, we all don't. I don't, deal with banks. We do if they come across us, and if someone comes across us, we're happy to deal with banks. But there's a difference. If I could share my screen a second, let me show you the difference between different types of notes. Is that okay?
One second. Open.
All right. I'll hit the little button here. Tell me when.
You should be good.
Okay, boom. And then I'm going to pick, I made a few documents here.
Yeah, perfect.
So that we can see this. So, oh, wrong one. We're talking about notes. We'll get to that one in a minute. Here it is. Okay, there's 3 types of notes. Here they are. This is it. A conventional note, a bank, mortgage company gives someone a loan. It's a debt instrument created when a bank or mortgage company finances the sale of real estate, right? Most people understand that. You want to buy a property, you go get a loan from somewhere. That is a conventional note, okay?
And
then you have
right
a private
now,
mortgage note. Maybe the person can't get a bank loan, can't fit in that box, which is getting tighter and tighter these days, right? And then there's private mortgage notes. So an individual investor, maybe a real estate investor, but an individual investor will fund the loan to purchase the house. So the person's taking money out of their pocket, 100% providing the loan for the person to buy the property. That's a private mortgage note, a debt instrument created when an individual, not a bank, finances the sale of real estate. Then we have what's called a purchase money mortgage. This is a debt instrument.
Right now we're not seeing that screen, Jeff. We're just looking at we've got value-based investing versus speculation. That's the one we see right now.
What? What? I'm showing this one. This is my screen.
Are you sharing a screen or
yeah, it says I'm sharing my screen.
Correct. You may be sharing a tab or window.
How about I stop and then I'll share again. Let's see if it works now. I'm sorry, guys.
No problem.
Boom and boom. Now?
There it is.
Boom. Okay.
Yeah.
Okay. So we did a conventional note, bank note, private mortgage note, individual, a person giving a loan, right, for someone. And then a purchase money mortgage note, a debt instrument, note and mortgage, note and deed of trust, sometimes a recordable land contract, carried back by the seller of their property to facilitate the sale of their own property, a seller finance note. That's the whole key. A seller of their own property, selling their own property, carrying back the note on the property they own. That is a seller finance note. And the differences between them are as follows. You can have, when a conventional or private note loan is given, they have to follow all of these rules and more. There's a loan application, references are asked for, they run your credit, there's income requirements, right? Debt to income ratios, lending guidelines, employment, LTV regulations, the truth in lending, and all these different things. When a seller sells their property and carries back a note, none of that is applicable. None of that is applicable. So if I buy a conventional or private note, guess what happens? I have to follow all those same rules and requirements. If I buy a seller finance note, there's no regulations.
Right.
We'll go one more. When you purchase a conventional or private note, you have to follow all the regulations that they do when they gave the loan, just as if you gave the loan yourself, including the collection regulations. When you buy a seller finance note, a purchase money mortgage, the regulations lenders follow do not apply as defined and discussed in a class that I do. I have a little home study course, and this is on day one. We call it, it's called a holder in due course. There is a technical legal term for it. It's called a holder in due course. It's as if I sold the property myself and carried back the note myself. I become that person. So it's the same with a conventional or private note. If you buy a note from a bank or a mortgage company or a private individual that gave a loan, it's as if you gave the loan and you have to follow those regulations. When I buy a seller finance note, it's as if I sold the home and carried back the note myself, so I don't have to follow these regulations. Okay, so that's the differences between what you guys normally do, which is go after bank loans and tapes and mortgage company loans, and what I do, which is go after the individually held first position performing seller finance notes.
And then you're just looking for already created, like you're not even creating your own necessarily?
Yes, existing. Absolutely. Yeah, I don't want to buy properties, carry back notes, like that. That's a lot more work, man. I want to sit home and go bass fishing and go snow skiing and go hiking and,
That's awesome
stuff, right?
Yeah, for sure.
Yeah, okay, so I'll stop this now. We can continue. So does that kind of explain it? And then you asked a question, and that's why I brought that up.
Yeah.
What was that? Did that answer the question, or was there more to it?
No, I think for most people, they have to understand the differences, right? That was a good explanation of what that looked like, and good definitions. We did one question that came through from Steve Johnson regarding, mobile home parks and notes like that. Do you get involved with the mobile home parks and buying notes on them?
Yeah, well, those are seller finance usually. However, most of the time we just go for mobile homes on land. So it's not in a park, they own the land and the mobile home. It becomes real property. It's the same as a note on a house.
Mm-hmm.
Can you buy notes on mobile homes on leased land on a lot where they pay lot rent? Yes, you can, but it's a whole different ball game of requirements and due diligence, because that is not real property. Just because someone's living in it doesn't make it real estate.
Yeah.
And when they're in it, in my world, if a mobile home is older than 10 or 15 years old, it's old. It's like vintage, right? And it's not worth much. It's a wobbly box. It's a pregnant roller skate on wheels. It's just just like cars depreciate, so do mobile homes, right? So there's different things to look at. Can they be purchased? Yes. There's just different due diligence and things to go for like that. Have I purchased them? Absolutely. Right.
Yeah,
that's awesome.
We did have another question regarding your due diligence. When you're going through your due diligence, who helps you with your due diligence on an asset? People are looking for companies and teams and local Walmart to get their due diligence. Who's just special godlike, secret person that you use for your due diligence to review assets?
Time on the water, man. Time on the water. If you don't know all about it yourself and you're going to trust someone else to do that, that's a scary situation for me. I am not a risk person. I do not like risk. So when I buy notes, yes, there's still risk, right? There's always risk, but I try to minimize it and keep myself in a position where, even if it goes bad, it'll still be good, if you follow me there. And now I forgot the question again.
No, just due diligence, right?
Due diligence. So is there a place you can go? I believe there's a few people out there that will process your notes for you and things like that. However, in the beginning, you should absolutely try to do it all yourself. Make that phone call to the title company, order a title insurance policy, right? Make that connection to the appraisal company and order that appraisal yourself. See how the process works. Learn how to read an appraisal. Learn how to read a title insurance policy. Learn how to read the documents. We just read a security instrument yesterday that had some language in it that I couldn't believe that was put in, and I caught it. And so now there's a different price because there was like, this person doesn't have to, this person gets a 15% discount if they pay off before 2025. And I'm like, well, that's a whole different ballgame now.
Yeah, it's a different note.
Now I have to lower my price and adjust for everything. But you've got to learn yourself. If you start out and you just trust people to do things for you, you are eventually going to get burned because it's not their job to keep you safe. It's their job to do the due diligence and then give it to you.
So
and it's a different perspective. Like,
yes,
sometimes I'll buy a note and I have this kind of exit strategy in mind.
Right.
And then what if it changes? And what if I don't decide I don't want to do that for this particular note? I want to do something different. And I mean, if you're trusting somebody else to do it for you, they may not know your end game, or they won't be able to guess your end game. And so that makes a difference on your due diligence.
makes a
So
big
also
difference.
make sure clear everyone what title policy really means, right? It's an insurance policy saying that the title's clean when the loan is originated. And why is that important for origination as well as buying? Is that we can then we order our O&E, which says from the time it was purchased to now, what has happened. So if the title policy is there and something comes up, you actually have an insurance policy to deal with the issue and sometimes pay you off if the circumstances are right. So it's a huge tool that if you don't see a title policy, you should be a little worried, and you need to make sure that there's a clear title besides just your liens.
Absolutely. Yeah. The chain of title to the property. And in 31 years, knock on wood, I've never had a claim with a title insurance policy, but it's like car insurance or house insurance.
Yep.
You pay it every year. This you pay one time. And, just like house insurance or car insurance, you might not ever use it.
Yes.
Right. So you've got to think about that. And I see a lot of now, someone might bring up the fact that, well, aren't seller finance notes messier? Well, a little bit. Yeah, they are, because they don't have to get an application. They don't have to get, truth in lending and write out everything and sign this and fiduciary responsibilities and stuff. The guy sits at the table and says, so you want to buy my house for 120,000? Great. Give me 20,000 down. I'll hold the note for this long. How does that sound? Great. Sign the documents, done. And I've gotten a note written on a piece of a yellow legal pad, right? And that had to be corrected, So there's in seller finance notes, we do a lot of work, not a lot. We do some work on cleaning up the file, making it presentable to investors, whether institutional or private. And for myself, making sure I have everything I need in case after I buy it, I need to take action and get things corrected. So
you'll buy it and then do some fix up and then may or may not sell it.
I'll make sure it's fixed up before as I'm buying it during the due diligence process. Yeah. There's one right now. We're doing a land contract in Georgia, and they recorded a warranty deed and they have a note, but there's no security instrument. There's no deed of trust.
Oh, okay.
And so we're like, well, that's got to be fixed, right?
Yeah.
And if you want us to do it, our price is going to go down a little bit. If you do it before that, we'll keep our price the same.
Got it.
So the guy's like, "Rah, rah, rah," and he used an attorney. Guys, attorneys, no offense to anyone that's an attorney, but they don't know everything, and they especially don't know about seller finance notes if that's not like their core business. Yes. If they're not a real estate attorney, they probably haven't done these transactions, and they just, I don't know, look it up on Google and do their best. I have no idea.
So before we get into some deals, right? Everyone wants numbers. It's exciting. Can you share a little bit about how you come across these assets, the secret ideas, new cool technology that you use to find great new deals?
We would just love it if there was some new cool technology to find us seller finance notes. But I tell you what, guys, 31 years. I mean, both of you have seen my marketing presentations, and thinking of it as a business. I think my last figures that I quoted at the Paper Source Convention was, over all 31 years, over 709,000 people have responded to me. Yeah. And I've closed, 2,300 transactions, a very, very small percentage of them. But that's a lot. That's a lot. And when you talk about, what cool technology is there to find notes, guys, these notes aren't online usually, and if they are, they've usually been through us meaning the people that regularly buy seller finance notes, the institutions, some of us larger privates. And I've seen notes that we've canceled up on those up online. And if that's your mode of finding deals, great. Trust but verify. We talked about trust earlier with the due diligence stuff. Trust but verify. Look at that stuff. Read it yourself. Get what you need to get. If they don't give you enough time, bail. Right? Mm-hmm. You need to know what you're doing. You need to know your investor mindset, and you need to know what you're doing. When we're trying to find seller finance notes, yes, there are some online marketing strategies that we use. Social media, every now and then, Google AdWords, things like that, search engine optimization, all these different kinds of things. But The core of finding an individually held seller finance note is marketing, right? I talk about marketing all the time. Marketing is something you have to do for every business. And for me, I'll quickly go through it. It's you've got to have 3 to 5 things working for you at any one point in time. And of those 5 things, half of my business comes from direct mail. I purchase names and addresses of note holders, and I direct mail to them. That's half of my business every year. Half my deals closed, even and last year was like 62%. But of my deals that I closed were from my direct mail campaign. And it's not a one-time throw out 1,000 letters and get a deal. It's a consistent program over time, 1,000 a month, 2,000 a month, whatever you can afford. It's expensive, but it does get me deals. Second is classified ads in small outlying rural areas. Third is building a referral network. It takes more time. You got to be in business for a few years for people to start getting to know what you do and that you can do what you say you can do. And then those referrals can start coming in. Online marketing, we already talked about. And then direct contact, talking to people all the time about what you do, because it is such a niche within a niche within a niche, right? Oh, you're a real estate investor. Well, kind of. Oh, you buy properties. Well, no. Oh, you give loans. Well, not exactly. And, so we're in a niche within a niche within a niche. And in the note industry itself, there's a bunch of little niches. I do this one little thing. You guys do that thing, and other people do this thing. And you've got to focus on one and build up your marketing. I offered the marketing plan to people at the Paper Source Convention. Dozens of people requested it. I sent it to them. I haven't seen one back yet. I'm like, hey, I'll do it for you. I'll go through it. I'll help you. I'll make sure everything's good and get your best foot forward.
Challenge
right?
accepted. And
you're just like, people don't want to do the work. They want the easy way out. Oh my gosh, if it was that easy, everyone would be doing it. Right? Because that question always comes up. Why isn't everyone doing it if it's so great? Well, because there's work involved, right? So
it's
how many
not a
pieces
get rich
of
quick, and never has been and never will be. It's
never has been, never will be.
how many pieces of mail do you think that the 2,300 you close on average those people received? How many marketing letters?
There's competition, and it probably came directly from me telling people to do it, right? But it's okay because there's plenty of notes.
How many do you think?
However, I'm going to say at least a dozen, if not a couple dozen.
How many pieces of letter did you send to that person that closed? How many did you send? 3?
Oh, me. They get 4 things from me in 19 months. Okay. So they'll get a letter, right away. 6 months later, they get a follow-up postcard. 12 months later, another follow-up postcard, and 18 months later, a follow-up postcard. It's a program, right? I'll get that first contact in. They'll call me or email me or fill out the worksheet online from the letter. And then not everybody needs to sell right now. A lot of them are just curious, right? Sure. I'm usually the first person to tell them, no, you're not going to get the balance of the note. There's a discount involved, and let's see how bad yours is going to be, right?
Yeah.
So, or how good it's going to be. Sometimes they're good, but smaller discounts. But it's action and marketing and in a program. A consistent program. That's why the direct mail works. It's a consistent program, not a one-time thing.
Yeah. So I got a question on the notes that you're seeing, where people are responding and you're reviewing all the documentation and stuff. What's kind of an average interest rate that these loans are being written at? I know it varies wildly, but
so people carrying back notes on their properties. The ones that do it. Most of them, it's one in their lifetime they carry back, right? Yeah. It's not a business for them. I had to sell my property. I carried back a note. So they don't know what they're doing. And if they don't contact us beforehand, we see stuff, 0 down, 0% for 50 years. Oh, and you're just like, oh my God, do you have any more properties? I'd be happy to buy, right? And so we see everything from those to 2%, 3%, 4%. And you're just like, what are you, a bank?
Yeah.
Now with interest rates going up in 3 to 6 months, we'll see some higher interest rates, I'm sure. However, going with that, our yields are going up too, because we got to keep the same profit going, right? Yeah. So prices are still going to be the same, if not lower, in the coming future. yeah, that's a big thing.
All over the place. Yeah.
All over the place. Yeah. Okay, would you buy a note with a 0% interest rate for 50 years is going to get a huge discount, performing
Yes.
or not, right? So it's one of the fun things about the business that really keeps me doing it year after year, is that every person that contacts me, it's a whole different puzzle.
Yeah.
How am I going to fit the pieces in, right? How's this going to work, right?
Yeah.
With 29 different ways to buy a note, which one's going to work for this guy?
Yeah. It keeps it fun, keeps it interesting, keeps it fresh. Yeah.
So let's get into some fun stuff here. You don't have to share screens. Give us an example of what note you've seen, what numbers have come across in the last, say, year or two. Give us a kind of a general situation you've run across and some numbers of a property.
Okay, so let me share my screen. Okay.
And
Let's do
you're
this, and I'll hopefully get the right one this time.
Jeff, you're in California and you buy all over the place, right?
I'm in Arizona now. I was in California, been
okay.
Lake Havasu City, Arizona now for 7+ years.
Oh gosh,
And,
okay.
yeah, it's 97 degrees already. It'll be 107 today, and AC is already running. So you guys up there don't know what that is.
Yeah, we're hitting 90 today. We're hitting 90 in Jersey.
Woo! Oh my gosh, 90. That's a cool day here.
Yeah.
We pray for 90-degree days. No.
But you're buying all over the place, right? Like it.
Yeah, but we're buying nationwide. Yes, yeah. Nationwide. We even did a deal once, Puerto Rico and Guam, all the states. I think maybe there's 1 or 2 states I haven't done a transaction in all these years.
Yeah.
Like Maine is one, I think.
Maine's tough.
Anyway, yeah, this is nationwide.
Oh, that's cool.
Yeah. Oh, what did I finish the question or?
No, yeah, you're good. We were looking for you were going to share a screen.
I was going to share a screen and show you some numbers. Yes.
Yeah.
I do want to go over that investor mindset too. So let's.
Sure.
Boom. This is a recent transaction. I want to share that one. There, you guys see Kingston, Georgia?
Yeah.
Okay, cool. So here's a recent one that we took down, meaning purchased for my self-directed Roth IRA. We're all doing this the right way. That's one of the best ways to do it is build up a self-directed Roth IRA and put them in there. So long story short, a person in Kingston, Georgia, little small rural town in Georgia, sold a regular house, owner-occupied, single-family home, owner-occupied single-family home. You can get that out of the way. That's distracting. There we go. And 120,000 sales price. You got 20,000 cash down payment, $100,000 seller carryback note, 30 years at 8.5% interest. This guy knew something, right? This guy's a little more savvy than a regular individual seller finance note holder.
Yeah.
He knew to get the interest rate a little bit higher. He knew to get a decent down payment. So that's great. So we plug it in the calculator. We run the numbers. The payment amounts $768.91 there. First step. Second step, verify the balance. When they call you, they've received a few payments. So we got to know what the balance that we're purchasing is. So we run it through the calculator. Here's the little steps. The balance is $99,630. Then the next thing I do is I'll calculate the loan to value, right? Balance of the note divided by the sales price of the property. In this case, came out to be 83% loan to value. Mm-hmm. Yeah, but Jeff, if the property was sold, a year ago, the property is probably worth more, so the loan to value is going to be lower. Yes, but initially on the initial price, we don't know what it's going to come in at. We don't know what it's going to appraise at, even with going online and stuff, because I don't really trust the values Zillow and all those other ones give. I trust the numbers, right? Yeah. So the numbers, I know that it sold for 120, it's going to be at least worth that. So my loan to value is at least, at the most, let's say right now, 83%. Okay. So if the appraisal comes in for higher later on when we're doing a transaction, then great, my loan to value is lower and I'm actually safer. Okay, or let's not use the word safer, more secure, right?
There you go.
And then I go with my full purchase on this one. We had a good down payment on this one. I wanted a 12% yield on this. Not the greatest. I usually like higher, but it's a bit competitive out there right now. I came in at a 12% for a purchase price of 74,620 to the note holder. This is direct. I'm doing this direct. I didn't broker this and everything. So that was the price for note holder. And yeah, okay, it's a $25,000 discount, but I have to wait 30 years to get my money.
Yeah.
Right. And I want to make some money.
Yeah.
So the issue with this one was, of course, this person had contacted some other companies, right, competition, to see what they could buy. There was some poor credit on this one. So that's the reason for the higher for the yield and for the discount.
Okay.
I don't know what that is, cents on the dollar, but it looks like about 75%, you know, or somewhere around there.
So pause right there. I stress this dramatically because people don't realize this. People bid percentage of UPB or BPO. This is a case example. Jeff doesn't even know what the percentage of UPB is or BPO is because he's based on a return, not based on a percentage number, right? He's guessing because it doesn't matter if this is 80% or 20%. His numbers based on a return he's looking for based on the situation. Sorry, Jeff, go ahead.
Correct, based on the situation, because we use all 4 or 5 different ways, right? Yield, investment to value, cents on the dollar, et cetera, right? There's other ones that are blanking now, but those are the 3 major ones that we use.
Yep.
Cents on the dollar, if we didn't say that, to calculate our prices. In this case, the final number did come from a yield-based calculation.
Right.
And of course, this is an initial price subject to verification of the information that they gave us and acceptance of the payer's credit, appraisal, and title. We already saw the credit, right? And did a soft pull and we saw the credit. So we already knew that. So now this price is still subject to appraisal coming in for at least the sales price. And like we talked about earlier, clean and clear chain of title.
Okay.
And with that said, and then we do one last calculation to check our safety and security, is investment to value. Investment to value is the purchase price you're paying compared to the value of the collateral, ITV. This is a term you got to learn and a number you have to calculate. This is your security. We're at 62% investment to value, meaning there's 38% security above me, equity above me, that if something goes wrong, worst case scenario happens, and I have to foreclose, take back the property, fix it up, resell it, and carry back another note or sell it for cash, I'm going to have enough room to do all those things and still, at a minimum, get my $74,000 back.
And what the market is today, this is a big deal because if the market drops at all, you have to be in a spot to absorb that impact of property values increasing.
Correct. So I like to keep myself for my own personal portfolio and my personal preferences under 70% investment to value, and usually under 60% investment to value. I am not risk averse. I manage my risk, and again, in 31 years, I've had 2 foreclosures, and I actually made a ton of money on both of those foreclosures.
Before you go on, we had one question about how much, if someone begins, how much should they budget for marketing?
Oh, geez. You know, look, guys, when I started out, there was no internet, right? And I was working night crew at a grocery store and work nights and take care of the properties in the daytime and try to start this business in the daytime. And my budget was really small, a couple $100 a month, you know. As deals started closing, I could put more towards it. I would prefer when people work with me and I mentor them or I coach them on their way to starting their business, I like them to have a minimum of $1,000 a month for 12 months. Commit to 12 months, commit to at least $1,000 a month, and you'll see some progress. You'll see some deals starting to come. Does that help?
Yeah, I think it does. Yeah, absolutely. Yeah, it makes sense. You can't be bootstrapping this business on because you're never getting traction.
Again, it's not a get rich quick, and it's not you're gonna make $1 million in a month.
Not.
It's not how it works. That's just not.
Nice.
So So there you go. Yes, good question.
That's good. That's really good.
So I do the ITV, and then we have on the bottom there, we have the information that we verified on the calculator and the numbers we calculated. And this guy went for it. Appraisal came in for like 122. So we were okay on that one. Title was easy. They had a title insurance policy. So we just had to do an update or a date down, it's called, from the time they got the policy till now. And that was one we recently purchased. And those payments are just going in the Roth IRA every single month.
That's a good looking note. I like that one.
Yeah. Yep. Now, are they all like that and that's simple to do and easy? No, I picked out a smooth one for you. But, you know, there's always hurdles and surprises, just like with you guys. I'm sure you guys have a few more hurdles and surprises with some of the non-performing and stuff.
Yeah.
But people seem to think that I don't purchase non-performing. I do, just not at the prices you guys do. So
It's definitely changed over the last couple of years.
yeah.
We had another
And
question
it's gonna
regarding
change again. Yeah.
Yeah, regarding from April, regarding when someone says no to your price, right? What do you say then?
How do you overcome some of those objections?
So, okay, so part of the business is marketing and getting those calls to come in, right?
Yeah.
All right. So I can get the calls to come in for people starting a new business or starting out and stuff. But what happens when you pick up that phone and start negotiating and talking and communicating with these people? That's where the deal is made, right? So on that very first phone call, I have an idea. By the time we're done with it, I'll have an idea of what they're looking for. If they're looking for par, 100% of the balance, or a 5% discount or a 10% discount, guys, don't waste my time. This is not how this works. If you can get 90 cents on the dollar, you should have this, that, and the other thing. You don't, so your discount's going to be a lot less. So when I do call with the prices, they are already thinking in their head, oh my gosh, this guy might not even buy this note, right? Because as I'm going through getting their information and filling out the worksheet, most of the time verbally, I would say maybe a third of them go through the website first and put their information on my form and send it to me. Guess what? I'll call them up right away when I get it and start verifying the information. That person-to-person contact, that relationship building is what this business is all about. It's not all about numbers sometimes.
Right.
I bought lots of notes at lesser prices than competitors because I built a relationship and they liked me better, whatever that means, So
and that's worth something. Like that's not nothing. That's definitely worth something.
Right.
Like
and that didn't happen
something.
in the first year. That took years to learn how to negotiate and talk to people. So on that first phone call, we're getting to when they say no. On that first phone call, ooh, a 3% interest rate. What are you, a bank? Dude, why would you do that? You should got like an 8 or 9 or 10. He's like, well, that's what the banks are giving. Well, our underwriters aren't going to like that, right? And oh, you got 1,000 down on a $200,000 property. Underwriters aren't going to like that. Oh, it goes for 50 years. Underwriters aren't going to like that. So by the end of the phone call, they're like, oh my God, my note's really crappy. I hope I can get something for it.
Yeah.
So when I call them back and give them a price, the discount's not going to be a shock to them, right? They're going to, there's a discount involved. I get it. And they'll be more open to hearing the options. Right? It's not all about the full purchase, then we got the options. So when they say no, I go back and I said, well, on the first phone call, wait a minute, didn't you say, you'd like to pay off some debt or, buy your daughter a car or pay for your son's college so let's see how we can work this out. Here's 3 options. Here's a full purchase price. Here's a way to get just what you need to pay that college tuition this year. Here's a way to get a couple of years of that. And I give them some different options. Now I don't get everybody to say yes, obviously, right? I don't. What's I think my stats are like 2.3% over 31 years have accepted and closed. Yeah. Now I'd probably get 10% to say yes. It's the other, a lot of them don't work out. So when they say no, I just go with those other ones. I try to figure out what's going to work for them. And then sometimes they still say no, You know, a lot of times they still say no. However, then you just follow up with them. Call them next month, call them 3 months, 6 months. And I keep saying call. Yes, people, we got to talk to these people. It's not all about, oh, I could just send them a price in an email. And if they say yes, great. If they don't, great. You're just throwing stuff against a fan, wallers to see if it'll stick, right? That's not the business, right? You can send out numbers all day long. We're not quote machines, right?
Yeah.
We want to get a deal. If I'm sending you a price as a broker, you negotiate the heck out of it, right? That's your job. And
Yeah.
that's skills to be learned also is the negotiating side.
And deals are made on the phone.
Yep.
Emails are for confirming details and things like that, but deals are made on the phone.
Lots of phone time.
And
Lots
you
of
get
phone
information about that you wouldn't get on a form, right? Why they sell the loan,
Yes.
what are the numbers, you know, hey, situation, hear the tone of voice. You can get a grasp of what's really going on and more than just the asset itself.
Absolutely. And you can hear their tone. And I'll tell you this, and whether it's a bank that you're buying it from or a mortgage company tape or an individual note holder, there's stuff they're not telling you, right? And our job in due diligence is to peel that onion and find out what they're not telling us, because there's always something they're not telling us.
Yeah.
Right? Oh, you showed this to other buyers. Why didn't they buy it?
Yeah.
Well, I don't want to tell you. Well,
Yeah.
I'm going to find the same stuff, so you might as well tell me right now.
Yeah.
Right? And not waste either of our time. So
How many assets do you see are actually serviced by a licensed servicer?
half, maybe half. Yeah, like some
That's
states
more than I would have thought.
require.
That's pretty good.
Some
Yeah.
states require it, like Arizona requires that if you carry back a note, it has to be serviced by a licensed servicing company.
Yeah.
And other states have similar rules, but you know, note holders, again, you know, they carry back one note in their lifetime, right? It's not their business, and they just get the payments every month. And these days they get Cash App or a Venmo or a PayPal or something, and that's where we get the payment histories from. But I would say about half already have a servicing company in place, right?
That's pretty good, actually.
Yeah, I'm kind of surprised by that, right? You know, most of these are backwoods kind of deals that just happen and whatever. How do you deal with, are you licensed in all states to buy debt, right? There's certain states out there that require a debt buyer to be licensed. Do you do that or without going too far?
This is seller finance notes. The only state that I know of that has regulations on brokering notes. If you're buying them for yourself and you keep it full term, you're not a broker, you're a buyer and a holder. And that's one thing. But if you are going to broker them, the only state that I know of that has regulations is California. California requires that you have a real estate broker's license to broker notes.
Yeah.
And that's hard for some people to swallow because there's a lot of notes in California.
Gotcha.
I have my license there because I live there and that's where I started. So I just got it, you know, don't need anybody slapping my wrist or checking up on me. But other than that, you know, as far as I know, you know, I'm not a licensing expert, but as far as I know, you can broker notes everywhere except California if you don't have a California real estate broker's license.
Yeah, that's cool.
Yeah.
And classic California.
Yeah.
Well, let's not get into that. This is a business call.
So I'd like to know, give us your worst story you've ran into where it just was just bad, or your worst mistake, even.
No, I try to forget about bad things that happen. Even like an argument with the wife, you know, last week, I'll forget about it because it just drains your energy and stuff. But the worst successful one?
Yeah, and just the fact that lessons for others who are watching and saying
successful, meaning I purchased it. The worst one, there's this I'm really struggling. I have other people's stories of their worst deals, but you know, like buying what you thought was an owner-occupied single-family home, a note on an owner-occupied single-family home in Oklahoma, and it turns out that it was built out of hay. It was a hay home. There's a process. I looked it up. There's a way to do it, but it had burned down, and they didn't have insurance. But again, that's not my story. That's an associate story. But yeah, my worst. I've had there are transactions where you're like nail biting, wondering if it's going to get to closing or not because of title issues, or because the note payor is not friendly with the seller of the property, right? There's a little battle going on. They don't have a good relationship. They hate each other, and it gets sticky. You know, it gets stressful on our part because we're like the mediators trying to make everyone happy, and things like that. Gosh, I really wasn't prepared for that question. I don't have, even like my 2 foreclosures, I had a windfall on them. So, you know, those aren't even bad stories.
Have you lost money on a deal?
I think
Have you lost money on a deal?
Oh, go ahead.
Have you lost money on a deal?
No, never. Why? Because I purchased it properly.
Yeah.
Right. If you purchase it, if someone says, hey, this is how much I'm selling my note for, and you buy it for that price without doing your due diligence, your own due diligence, you know, it's a crapshoot. You're taking a risk. You're being a speculative investor at that point.
Right. Right.
Oh, is this a good time to do that before we're
Let's do
almost
that.
done?
Yeah, we've got not a lot of time yet left, but yeah.
Let me. I'm going to share this real quick because I really want your listeners to know the difference. I'm pretty sure it's this one. Value-based investing versus speculation.
Okay.
I learned this from this big, thick book. This is Graham and Dodd, Security Analysis, McGraw-Hill. This book is huge. Look at that, half my face. And it was written a long time ago. And it's a lot about stocks and different things like that. But it really stresses the difference between a value-based investor and a speculator. A value-based investor, I'll just read this off because I think that'll go quicker. A typical note investor seeks an investment that provides current income, preservation of capital, and growth potential with minimal risk. The typical note investor seeks a relatively safe, secure, trouble-free, cash-flowing investment. This is me. What do value-based investors want? EPI. This is a phrase I've coined. EPI stands for extreme passive income. Extreme passive income because the check comes into your box every month, or you get your ACH payment deposited every month, and there's no one calling you up about toilets, termites, taxes, or tenants, right? Extreme passive income. Value-based investors want to take advantage of the power of compounding, right? What is that? When you've gotten a loan in the past and you signed your truth in lending document, and it shows you're getting $100,000 loan, but you're going to pay the bank $272,000. That's the power of compounding. That's what we're taking advantage of here. We want preservation of capital. We don't want to lose money. We want minimal risk. There's still risk. We just mitigate it. We want a relatively safe, secure investment for the long term. Would a value-based investor buy non-performing notes? Absolutely, but not for the prices that speculators would pay for them. Sure. Let's talk about speculation. A speculative investor is as follows. A speculative investor knowingly assumes the risk of incurring a large loss if he or she believes the possibility of a large gain exists. The speculative investor understands the risks, expenses, and the time involved in the investment. He thrives on the concept of the greater the risk, the greater the returns. Speculative investors want a home run every time. They'll take large risk for the possibility of large profit. Will use their last dime with a promise of huge gains. Will pay little or no attention to the downside risk. Will abandon strict standards of valuation and risk aversion. These are the differences. These are the two types of investors out there. And I can go on and on about this for an hour or two as well. But I really want people to start thinking. I think that's one thing I got out of the conference at Paper Source last month when we met and we talked, is that people want that quick buck. They want to make a decision. They don't want to do the work. And they get away from what a real investor should be doing, which is knowing what they're investing in. You know, crypto, for example. Oh my God, the people that were raving about crypto last year, whoo, I can't even count how many people. Where are they at now? Right? Catch me outside, right? How about that? It's down like 90%. And but that's always been, crypto's always been and into the foreseeable future here, a very speculative investment.
Sure.
So I think at the conference where I was going with that is that a lot of people do not know their investor ID. They do not know where they're at. And it takes a while for you to figure it out. So while you're figuring it out, why don't you broker some notes, flip some to investors that know what they're doing, and see how the process works, and see if you like how that investor does it, or you like how that investor does it. And then you'll narrow it down to what you're, I'm looking at your picture, I should be looking up here, what you guys are looking at as far as what your investor ID is.
Fantastic.
So I wanted to get that out there for the public in general. You got to know what kind of investor you're in before you start investing in anything.
Absolutely. So we kind of hinted at it before, but you talked about looking out to the horizon here with the non-performing and just market conditions and all of those kinds of things. What's your take? What do you see coming?
Well, we've never seen nothing like this in history, right? All of these different things that are happening at once with the war in Ukraine and in Ukraine and the gas prices and the oil stuff and the inflation hitting 8.6, and then interest rates just bumped for a 30-year fix 6.1 now. 2 months ago was like in the 4s.
Yeah.
This is unprecedented how fast interest rates are going up.
Right.
Now I'll tell you this though, been doing this for 31 years. I know when interest rates hit 6%, for me, my opinion, my statistics, when interest rates hit 6%, much fewer people are going to be able to qualify for conventional bank financing. And there's going to be a lot more seller financing coming up here, right? So I'm jumping up and down. I've been waiting since the early 2000s for right? Go up. As note investors, as performing individually held single family, I want interest rates to go up because then they'll get closer to my yield and I can give a little bit better prices sometimes.
Yes,
you know?
key item.
So I think that we're going to see more seller finance notes on the horizon. I don't know how all this is going to play out, you know, with the economy and everything like that. We just dipped into a bear market. A recession is looming. And we're just going to continue to move forward. I'm going to continue to do the marketing, but I do expect that I'll be very busy in the next couple of years.
So
Very
awesome.
we'll see.
Jeff, I know April said that it gave your TWITA comment in the thread. So
Twitter, yes. Twitter's my little slogan I came up with. I thought way back when I watched Austin Powers, I was just like, that's what I'm talking about, right? Everyone says it now. That's what I'm talking about. And that's just a mouthful, right? That's what I'm talking about. I'd rather just say Twitter, TWITA, Twitter, and get it out. I use it when anything exciting happening, when something's positive, when I catch a fish, I'll shout it out. When I hit a good golf shot, boom, Twitter, you know?
Yeah.
So that's my little thing, kind of like, I guess, branding, you know, or whatever. That's my thing. I'm Jeff Twitter Armstrong. Find me on Facebook at Twitter Jeff on Facebook.
Nice.
So
Jeff, we're going to disconnect for everyone.
I
appreciate you coming on for the hour, giving us great insight.
That's really good.
It was awesome. Just that experience and knowledge is overwhelmingly awesome. And guys, feel free to reach out to Jeff. He puts out a newsletter that you can grasp so much great information from. Just stay in tune with them. Take a look up on LinkedIn, Twitter, everything else out there, and just tune in with them and learn from him. He's a great guy to learn from, and he's open book. So
thank you, Dave. Yeah, it's, you know, my website, armstrongcapital.com. I send out every Wednesday. I'm pretty sure you guys get it.
Yep.
I hope you get it.
Yeah.
A little tips and training by Jeff, just little tidbits, an article every month, things like that, just to keep that motivation going. You know, please feel free to sign up for that newsletter on my website. And questions, email me. I'll get back to you. Email's always best. I'm really busy on the phone, so most of those go to voicemail, and I return phone calls. But email me is best. You'll find it on the website. Thank you guys for having me.
Thanks, Jeff.
everyone have a good weekend. We will be catching up with everyone soon. But if you have any questions, feel free to take a look at the YouTube channel, Facebook group, and all that good stuff. And take a look at the note training that will be coming out shortly. Thanks everyone for tuning in, and we'll talk soon.
You bet. Thanks, guys.
Calculate that as an annual return versus a one-time lump sum ROI. Because that will dramatically increase your returns no matter what you do. And you could do this, if you could do this 4 times a year, season it for 2 months, sell it to us, season it, sell it over and over again, that 10 grand on 40 multiplies.
And yes, we're more than happy to buy notes from you all through the year, any day.
Hey everyone, Dave Putz here from JKP Holdings. Alongside me, as always, Mr. Nathan Turner. How are you?
Very good, very good. Trying to stay warm.
Oh my God. Apologize for that. I hit a
There.
button. So I wanted to make sure that we connect for a few minutes. Let us, people who don't know who we are, kind of get to figure out what's going on here. I'm Dave Putz. I've run JKP Holdings for about 10 years plus. I've been buying notes, mortgage real estate backed notes for that many years. And I've been primarily buying bank originated, but we're working into this idea of seller finance notes. We bought a few of them, but we're learning a little bit more about them. And that's where I'm at. Nathan, care to share about yourself?
So I'm Nathan Turner. I started in notes in about 2008, and I was creating notes like a lot of you guys do. And it was in Ohio. So in Ohio, it's a land contract. We were making all these land contracts, and one of my biggest stumbling blocks is like, okay, how do we cash out of these? How do I make money on what I've now created? And took some classes and started meeting some people and learned all about notes and this whole secondary market that I had no idea existed before. And now it's kind of come full circle, it feels like, where now Dave and I are here. We want to help those who are doing what I used to do about creating notes. There is an outlet, and there's a way where you can cash out of these. You can go out and make some more money, and we are more than happy to buy your notes. So we're going to get into all that stuff today, but that's just kind of a real brief introduction.
Absolutely. We have a lot of people here who don't know who we are. A lot of people are really interested in this topic. And what we found is a huge bridge between the world of note buyers and those who originate notes, the seller finance, owner finance, origination world, and us. It's almost like 2 different bubbles. And what you're going to find out today is that our connection between what you guys do and what we do can be seamless, where it just flies, which is awesome. So I want to make sure you guys tune in, ask questions. I got a few things going on here to kind of track things. We're on LinkedIn, we're on Facebook. Hopefully everyone can see us and hear us and all that good stuff. If you have a problem, make a comment in the box and we'll go from there. But we wanted to start off with you guys. We do have some guests, which we'll bring on in a second, but we wanted to just kind of introduce what we do and some of the first things what we want to talk about today.
Yeah, so we, like
This
I
is new
said,
to us.
it's a big world and it's a big leap. Like I say, I started out with creating notes, which is great, and I love creating notes. I still do it today. A lot of seller finance notes. Mainly what I buy, and Dave as well, is mortgage notes. So people will go and get a mortgage with a bank, with whoever, Wells Fargo, Chase, Bank of America, you name it, whatever bank. The bank will then sell that note. And there's all kinds of reasons why they sell that. But the short story is we will buy those notes. We are not banks. We act as banks do in some cases. But we don't actually own the property. We just own the mortgage attached to the property, or the note attached to the property. And so we collect payments in that way. So that's a very, very brief introduction of what we do. What else you got, Dave?
Yeah. So one of the things we wanted to first share with you guys is that we get the concept of mortgage and note, and what you guys are doing, we get, right? But what we want to share with you guys is why? Why would you sell a note? You know, and what do you need to provide to us, and what you don't need to provide to us to make the numbers work?
Yeah.
Right. So one of the things we want to share with you guys is that you guys make huge profit when you create that note. Huge profit. You create a note that you're into a deal for 40 grand, you create $100,000 note. Oh my gosh, it is awesome. Out of thin air, you created money. And we have some great people who are going to be joining us today who are doing just that, as well as those who are doing it on a larger scale. They'll be in the chat, I'm sure. So when you create that note, what you don't realize that you can cash out everything you're into it for, plus more, which is awesome.
Mm-hmm. That's what we do. We go around, we buy the loans. Like I said, I do some origination still, and I enjoy doing that. But my main business is buying already originated notes. So somebody else created that note. I'm just buying it as an income stream. That's my core business. So hopefully you can see already how our two businesses really come together.
So we have some cheat sheet here to kind of go down our checklist and make sure we include everything for you guys.
Yeah.
So when you create that note and you create this money out of thin air, do you know you can sell that note to us, the collateral, and just create another note? Amazingly enough, I'm finding a lot of you guys don't know that we exist or where to turn to sell that note. And today we're going to talk about what you can do to turn to sell the note to any of us and what details you need. You can take this money and go buy another property with it. You can do anything you want with it. The one caveat is some of you guys have some assets that are non-performing. Oddly enough, we buy them too. Call them crazy, but we buy them too, right? So
yeah, both Dave and I started out really, after the whole recession happened. So we both started out buying non-performing notes as our main business, where people are not making payments, living in the house. That's what we started buying in 2010. And that's been a major part of our business for the last 10, 12 years.
Yeah.
So if you've got one of those problem notes, or let's say they're just not paying regular and they're just kind of a thorn in your side, we buy those too. We call those scratch and dent. So we'll buy the scratch and dents, we buy the non-performers, we buy the performers, we buy pretty much anything. So hit us up.
yeah. So when you're looking at buying this kind of stuff, there are two different worlds you play in. We have the seasoned note and buying at the table, at the closing table. You can sell either one of them.
Mhm.
Understand the fact that if it has some seasoning, which just refers to a time period of proven payments, we can buy it for actually a bit more money, right, than if it's brand new. The risk level is higher. You can also sell part of the loan payments in the first 5 years, or you can collect the whole thing and sell the whole note off and do what you want with it.
Yeah.
One of the caveats we've seen recently, and we actually have two people who are professionals in their space as well, is creating what they call an 80-20 loan. We have 80% on first, 20% on the second, and you can sell the first off and keep the second for payments and sell the 80% of whatever loan you're creating for huge profits for you guys.
And then you've still got that 20% second that you can collect some money off that as well. So you still have some cash flow, but then you've got that big chunk that you can go back out and do whatever you're going to do, or whatever personal thing you've got. Maybe you're sending somebody off to college, or maybe you're, renovating your own kitchen, or, whatever it is you've got money needs for. We're here to help fill that gap.
Yeah, absolutely. So I'm just going to bring up some information here. What we do have today is a few special guests who are not going to be on video, and then two guests who are actually be on video. If you're familiar with note creation, subject twos, or any of that kind of world, you've probably used an underwriter. Well, we have Max from Quality Underwriter on. He'll be all video, but he's going to be discussing things or answering questions we need to go to him. We also have Sohal, who runs Home Key Servicing. Sohal is a service provider who will act like a landlord for rental properties, but for note space. We're going to get into why a servicer is key for us, as well as for you guys, as we go along.
And Sohail that's one service company. There's a bunch out there. We happen to have Sohail here. He can answer all kinds of questions. He'd be a great resource for you. If you move your services over to him, fantastic. That's good for him. Good for us. and we'll talk about why that's good for us as well. We'll get into that.
Awesome. So let me switch over here. We should be good. We have some special guests on right now. Maybe just make sure we got going on. We have two guests with us right now that we are really excited about, right? We have Justin and Melissa. Hopefully you guys are there and we all have her unmuted. So what we want to talk about today with you guys is this idea of you guys create notes and create dollars out of thin air, which I think is awesome. Oh, Justin, you're still muted. Melissa, can you share a little bit about how you got started in this idea of creating notes?
Okay, so please forgive me because some of the things that you are going to see are probably going to make you cringe, like the fact that I use apartments.com.
That's okay.
Definitely open to doing more better, as one of my real estate associates say. I've only been in this market for about 2.5 years. So it's been a learning game, right? It's definitely been a learning curve. My first deal was kind of just dropped in my lap. And I feel like God says, okay, you're done doing wholesaling. You're smarter than this. This is what I want you to do, and it just really, after learning this strategy, I was able to get out of the rat race and create millions of dollars in like 18 months. So it was life-changing for me very fast. I do specialize mostly on getting subject twos and then doing an owner finance with those subject twos.
Mhm.
And I get 20% down and I create a great monthly spread for the most part. And yeah, everybody pays through apartments.com and it's a good life. However, I do often find myself cash poor, right? So I'm like, now I've gotten a hotel that I'm looking at and I've created all of these millions in notes. And I wouldn't mind cashing some of them out so I could get some cash to reinvest into this hotel that I'm looking at. So hopefully learning all of this by the end of this session, I'll be able to do that.
Yeah, awesome.
We may have to spread this out into a couple of webinars because there's a lot of information, but you're in the right place. This is great.
And we want to remind you guys, if you guys do catch this video in your middle of it, this will be on YouTube, will be on the Facebook page, be on our website. But yeah, YouTube channel, all the good stuff is there. Just look up JKP Holdings on YouTube and you'll find this video. So Justin, can you share a little about your background? How did you get involved with notes?
Very, very similar way. I started off wholesaling and I just really didn't like it. I was cold calling and, it was like offering these 50% deals or 50% for cash. And I just didn't like it. And then I kind of discovered the more creative route that you could take and just making win-wins for owners and, for buyers and sellers, making win-wins for us. I just try to make as many, it seemed like I could help more people that way. And help them faster. There was, I didn't have to raise as much capital, and a lot of times when I did raise the capital, I was able to, very, very similar to what Melissa was saying, buying subject to, and then if I had to come out of pocket any cash, I just turn around and get that cash back from an owner finance buyer. A lot of times, but sometimes, we've flipped a couple of houses that we just, that we couldn't find buyers for, and we just ended up owner financing them. And then, we were like, well, we can sell it. We've heard that you can sell notes. So, eventually, I was, earlier this week, I actually sold my first note. So I've been through the process. But as soon as I opened up that can of worms, it was like, holy cow, there's so much more to this than I even knew.
Yeah. And you know what? I went through the exact same thing. I started creating these notes in 2008 in kind of all over Midwest, Ohio, Indiana, Michigan. And it was like, okay, there's got to be a way to cash out of these. And I'd heard rumors, I'd heard these stories about people that buy notes. And I went to a training seminar in 2009, and it just blew my mind. Like it just all this huge secondary market that I didn't know existed. I went to a conference later that year down in Louisiana, and everybody's, talking about this thing that I just barely learned about. And yeah, it's real. And it's a very vibrant market, we'll say.
Yeah,
Lots of
my
people looking
first
for notes.
one of my first deals, I actually traded equity in 2 houses for an owner finance house on the back end.
Yeah.
And so I had all this equity sitting there that I ended up selling and making all my money in the front end because I sold the other 2 houses.
Right.
But then I still had this other one sitting there, and I was like, well, that's all my money that's tied up still sitting there.
Yeah.
And that ended up being the one that I finally sold. And I was like, oh, well, that wasn't as hard as I thought it was going to be.
Yeah.
But there was just some intricacies that I had to learn and kind of get punched in the mouth and keep on rolling with.
Okay. Awesome.
So we want to get into a little bit more of the details of this stuff to make sure that those watching, and you guys as well, what we're talking about here. So what people get interchange words a lot of times, right? So there's this thing called land contract, contract for deed. We also have a lease option. We also have, a deed of trust. All these different words that mean different things, but generally mean the same thing, right? If I say, listen, is it a mortgage or land contract? You may say, why does it matter? Well, in legal sides, if a loan goes not performing, that does play a role. Certain states don't allow land contracts. You talk to people in Texas, they say, what are you talking about, right?
I have no idea what a land contract is.
Yeah, you talk to
Contract
people
for
in
deed.
Ohio, Indiana, it's all over the place there. Michigan, right?
If you go to
So-
Louisiana, it's called a bond for deed. If you go one of the Carolinas, I think it calls it an agreement for deed. They're all basically the same thing. For our purposes, we kind of lump them together and call it contract for deed or CFD.
Yep. And we didn't know the difference. We would ask you guys to let us know what it is, if it's a mortgage or not. Just make sure you tell us what it is, because we have to price it differently. And certain states are actually discouraging land contracts with the judges. So, and certain situations where the land contract can't be foreclosed on or can't be evicted, you actually have to do a foreclosure, depending on the numbers.
And that doesn't necessarily mean it's a dead deal. It just means we just need to know what it is up front, so we know what we're going to get into here. If we need to convert that over to a mortgage at some point or something else, but we have options, we have things we can do. We just need to know what it is.
Cool.
Getting started.
You lost Melissa for half a
Oh,
second.
lost Melissa. Whoops. Hopefully she can jump back on.
We'll switch over.
So when you guys were talking about that, I didn't even realize that we could sell a lease option the same way we would sell a regular mortgage note. Because I do have lease options, but we like to take we like to see our lease options as the dating our tenant before we move them into owner finance.
Yeah.
And it actually works out really well for us. It's, we get to capture, all the tax benefits of being a landlord originally, and then we switch over into an owner finance deal. But I didn't, my concern was always, well, dang, if it's a lease option, I can't cash out of it because I can't sell it because I don't have, they have the option.
Yeah. Yeah. So short answer is we'll buy lease options. With a lease option, it's a little bit more particular, depending on the terms of the contract. They're all different, different lease options are written differently. So we just need to read through the agreement and understand what's in there. But short answer, we'll buy lease options as well. We're probably going to do the same thing and flip it over to either a land contract for deed, whatever you want to call it, or to a deed of trust or a mortgage or note. We'll probably convert it to something else sometime in the future. But short answer, we'll buy that.
Interesting. Okay.
We had a question here too. Kevin.
Yeah, Kevin asked, he does private lending
Good question.
for 12 months or less. Is there any advantage of selling short-term notes and are marketable? If a note is 12 months, 5 months, 30 years, 20 years, it's a math equation, right? So anything you want to ask, feel free to put in the chat as well. But we can price it. You may get a significant discount, you may not. We run everything through our model and we figure these kind of things out, right? Is it marketable? Absolutely. The world of notes is really buying it as the numbers, right? We base our deals on numbers. Where we're going to get into, you guys base on dollars. And we talked to Justin earlier before we went on, And that idea of basing on dollars may make sense in some worlds, but we're going to show you why it makes sense to do it based on returns better. So the other question we have from is, can you convert a note of a land contract into a deed of trust? Absolutely.
Yep.
It's done very regularly. We have Max on the audio, he can tell you about that in a short while. But if you need to, you can definitely convert that over. Call the underwriter. You go to their website and you can convert any land contract over to a note. So
and like even Justin, you're saying you need to go to a lease option and then convert them over. You don't need to. I mean, that's fine. And if you want to date them for a little while before you make it permanent, I get that. But you don't have to. You could just start off with a deed of trust, a mortgage, whatever it is in that state.
Is it as valuable that way? Is the note as valuable being a lease option over being a owner finance? Does that affect the value of that deal?
So probably in order of value, the lease option is probably going to be on the bottom of that. Again, not to say that it's not valuable, but I'm probably going to pay more for a deed of trust than I am for a lease option.
Okay.
Getting feedback. Is that me?
yeah, I'm not sure who that was, but Melissa's back. Welcome back.
Hey, Melissa. Glad to be back.
Struggling over here. It's pretty much the story of my life. Quick question about the lease option though. Okay, so let's say that we did a lease option with someone and we met you guys and you're like, okay, we'll pay more for deeds of trust and not so much for lease options. Could we go back to that lease option buyer and redo the deal, like start a DOT?
Yep.
Absolutely.
And then sell it to you. Okay.
Absolutely.
Definitely. Yeah.
We would recommend.
So kind of piggybacking off of what she's saying, is a lot of times what we do is when we advertise for the owner finance buyers, we have our lease option is say 5% down, and then our owner finance would be 10 to 15% down.
Mm-hmm.
Kind of like what she's saying, if I took the 5% down and then in a year say, okay, you still got on-time payments, let's go ahead and convert it without you coming with the rest of the down payment, would that be something that would, and then immediately turn around and call you guys and say, hey, I've got this owner finance situation or deal for sale? I guess it'd be a note at that point. Would that affect anything?
So a couple of things. Dave, I'll get you in a sec. But so 10% down is better than 5% down for sure.
Of course.
You've got now 12 months of pay history though as well. That's
right.
Also something. So that
even though that's technically rental payment.
They're making regular
it's
payments.
A seasoning.
Right.
Right. And
so even rental payments are seasoning.
Yeah. And you may say, listen, I have 2 payments, but then you say, listen, I have 12 months of rental payments I can prove. That's more attractive than some brand new person, right? Think about if you're buying a rental property, if you're going to buy a performing rental, right? What do you do with the situation where if property is already rented out for a year, you feel good about that renter.
Yeah.
Or if it's brand new rental, buy a performing rental and they're brand new, it's not so attractive.
So a 12 months kind of offsets that a bit, the 5% down.
Oh, okay. That was gonna be my next question, because a lot of times we wait for them to come up with the rest of the down payment to convert them over, but it sounds like we'd be just fine just moving them over into an owner finance as it is.
Yeah, and so maybe that's the next thing we should get into, David. We've had another question about that, about what kind of terms we're looking for, that kind of thing. Maybe that's the next step here.
Yep. Go down our checklist here. So go ahead and start off with that.
Yeah. Oh, you want me to? Sorry.
Yeah, go ahead. Sorry.
Okay. So we're looking at a few different things. When we're looking at a note, down payment is the first thing. So the bigger the down payment, the better. It shows that person's got skin in the game, and you guys all know this. This is what you do. But that bigger the down payment, the more skin in the game. the safer it is for somebody to take that on and have confidence that they're going to continue to make payments long term. So that's number one. Down payment, bigger the better. I would say, as a general rule, I would go 10%. Dave, you looking at anything different, or is that about right?
It's weird, right? With this sort of finance world, with bank originated notes, this never was a problem, was never an issue. So now the world is, I'm more worried about LTV now because of what's going on out there than actually down payment per se. So on a $5,000, I would think more percentage wise. So if that note is $5,000, but it's a $50,000 note versus a $100,000 note, to me, that percentage is big, but I can figure out the percentage wise. So down payment will allow me to figure out the percentage that was down made. For me, that's more attractive than a dollar amount.
Yeah, good point. Yeah,
but before we get to our list, I wanted to make sure that you guys have some more general knowledge before we dive into it. And we're going to have a form, I'll put it in the chat box here for you guys, that will allow you to get the full list of items that we want. Any note buyer would want, actually. So one thing you have to figure out is, are you a borrower or a lender? And what I mean by that is, a lot of you guys out there are subject to buyers, where you bought a property subject to, and you're technically a borrower to the other one, but then you're a lender to the new owner. And there's some Dodd-Frank rules behind what you're doing to make sure it stays legal. We're not going to get too deep into that right now, but if there's a question about that, we can kind of hit on things. But we got to make sure that if you're a borrower and a lender, we need to make sure if we're buying that second lien that's created, or that CFD, whatever you're creating, is able to pay off the first, and the contract shows the fact that we can do that. And in addition to that, making sure you let the borrower know that the first lien is still there. You need to let the borrower know that the subject to lien is there, or because there's subject to situations. If you have questions, we have Max on that can explain a little bit more about that. But you need to make sure your borrowers know that there's the first lien on there. Some other things are the amortization UPB. We're going to get into what that means, but understand there's a UPB, unpaid principal balance, as the note goes down, and that should stay amortization wise. And that relates to a payment, right? When you make a payment that's $742.36, if they pay $740, that wasn't a full payment. It sounds foolish, but it affects the way the balloon on the end of the payment is. Even that change, because if you take 10 cents and multiply it by 360 payments, there's a balloon at the end of it. And that will change everything out. And if it gets contested in foreclosure, we buy it and start defaulting, that all comes back into play.
So I have a quick question.
Sure.
If I can go back to the subject to question, the subject to discussion. And correct me if I'm wrong, but if I have an underlying mortgage and then I have a wrap note on it, and you buy that second lien note, it would wipe out the first and make you the first lien holder, correct?
Yes.
Yeah.
Okay. And it has to happen that way, right?
Does it
Yes.
have to? Yeah, I guess it does.
Well, I mean, it doesn't have to. We prefer to. Let's put it
Yeah.
that way.
Yeah.
Right? Because I mean, again, another thing is, if you're buying a first lien or buying a second lien, the pricing changes, just like seasoning. So the first lien is not as risky as the second, which means I'm going to buy that second at a much deeper discount.
Okay, so let's say I have an underlying lien that's dang near the same as the if I, because I'll buy subject to houses that have no equity in them, and then I'll wrap them. You know, obviously I can't sell just that second lien,
You
right?
You can actually.
I love it. I love it. Yes. So
Okay,
you
I
can
guess
tell
I'm
me the
confused
second
if
lien.
I sell that second lien.
Let's use real numbers here. You bought a
Okay.
subject to property for 40 grand. You're into it. You rewrote a note on that property, say $100,000. So you have total debt of 140,000. If I sit there and give you, say, 80 grand for it, You can take 40 of that grand, pay off the first, which I would want. And then you get 40 grand in your pocket and you walk away. And then I'm in first position now.
Right. And if
That's it.
I don't pay off that first lien, wouldn't that first lien get paid off at closing?
So there's no closing here.
Right.
We're not doing a title closing here at all. This is not a property sale. This is a note sale.
Just notes.
Okay.
I love it. I love this.
And is there any legality there that I should be, concerned with, with in a situation like that? Because if that first note gets called, I mean, I'm technically I'm out of the woodworks there. Why would I pay off that lien? Is that,
So
that makes
we would
sense? I mean,
set
I
it
know
up-
I would ethically, but
Correct. Yeah. and
why would
for
somebody pay
us,
that off?
Our
And we would
contract
want it
would
that way.
probably be set up that we would pay off the first inside of an escrow kind of account in
Okay.
that contract with you guys. Hey, listen, I need a payoff balance up first, make sure it's included in our contract would say this would happen. And we probably run it through like an escrow or attorney to ensure that money gets DV'd correctly.
Okay.
To be quasi closing, I kind of set up. That's how I would probably do it in that situation. I haven't done it yet, but that's my thought process.
Okay. So why would somebody only sell the second lien?
You can't
Why,
sell.
why
it
would
for-
somebody even buy just the second lien?
So.
Second lien holders are a little bit of a different, it's a different spin on the same thing that we're talking about. They have all kinds of reasons. Dave, go ahead. I don't do seconds.
Let's say you have a lot of loans were created with piggyback, right? 80-20 loans, right? You have $100,000 property, we can use $1 million property, whatever. The first one's like a 60, the other one's a 20, right? 20 grand, total 80 grand. So now you have up to 80 grand, $100,000 property. You have LTV at 80%, which is not the best, but fair. Now I can go and buy that second lien for 20 grand, or I could buy for 10 grand, say, right? And I can start receiving payments on that second. I'm
Right.
I'm not as secure as the first, right? I can get, we won't get into all that stuff, but I can buy it. But the problem is if that property drops in value, my second lien gets squeezed with equity.
But that'd be in a second lien smaller in a smaller second lien against the house
Yes.
versus a wraparound mortgage.
Correct. So in a
wraparound situation, we need
you
to pay
can
off
be-
the first lien.
yes, because you say you have a $100,000 second, right? And a $40,000 first, technically, right? And the property's only worth, say, 90, you're up to 140.
Yeah.
I would need you to pay off that first for me to get in a position.
Right. Okay.
Right.
That's I guess that's where I got lost, because I was
Yep.
like, wait a minute, in a wrap situation, you got to pay off the first.
Yeah.
We
So
would
we're
certainly
getting a lot
prefer
of
that.
questions in the chat. I appreciate you guys. So again, we're in the numbers. If I sit there and bought, if you bought a 72 loan and you bought it for 40 grand, whatever the situation is, and the balance of that first lien is 40 grand. You then create a new note, say for 80 grand, whatever, 100 grand. I can come in and buy that $100,000 note for a discount, say 70,000, 75,000. You then would pay off the first for 40 grand. You would collect 35 in your pocket. Then our lien, because the fact that the other one's gone, moves up to first position. And now we're in first position of your new created note.
So would you buy that? Would you buy that as if it was a first position lien,
I
or would
haven't
you
done it
still
yet,
buy it with the
but I
second
would
position
definitely
discount?
price it that way, yes.
Okay.
The
Okay.
risk level is less there because it's a first lien.
It will
And
be a
we'd-
first lien. Yeah. Okay.
Right. We'd have that understanding that the first is going to get paid off. So that would put us into first position. And Melissa, did you have a question on that too?
Well, I had a question based off of the fact that, let's say, like Justin said, we have a deal that has no equity, but then we created money with it.
Mhm.
We owner financed it. Let's say, the house is worth 100,000 and we sold it for 140,000, right?
Mhm.
You say you buy those. How do you buy those? Since you're not buying against the LTV, apparently.
We're basically buying based on returns.
Right.
Right.
We want to look at LTV as a factor, but we want to look the fact that we're buying a bond initially, right? It's a bond with a maturity date. And most of the time bonds are calculated by yield. So we're gonna say, what would our annual return be on this situation? We're gonna buy it based on that annual return. 10%, 12%, 8%, whatever the number is. And
Nice.
people calculate different things differently. So that's one of the factors, is making sure your interest rate's a pretty good high number, because the lower the interest rate, the lower my discount has to be, or more my
Right.
discount has to be, right? So if you're creating notes at 12%, you're doing much better than someone creating 8%.
So,
Gotcha.
and going back to your thing with the equity, you know, if it's $140,000 note and the house is only worth 100, we're probably going to price that on the value of the house in that situation, because technically it's underwater, according to
Yes.
present value of the property. So we're not going to, you know, we're not going to play the game where we think that the price is going to go up on the value is going to go up on the house. I'm not saying that's a bad game to play. That's just not our game. We're going to do it on today's values, today's unpaid principal balance, today's property value, whatever it is right now.
Does that make sense?
No, because
Good.
if you're saying that you can sell a note that does not have any equity in it, so can you or can't you?
Yes.
You can, but the pricing is going to be based on the lower of the two. If the property value is lower than the unpaid balance, we're going to do the pricing based on the property value, and vice versa.
And what would that pricing look like?
It depends on the state.
Step 2.
Yeah, there's a lot of questions go into that. Sorry, somebody else had ask questions in the chat. Feel free to put it in the chat. We'll definitely answer as we can. So pricing based on state for us, and we always price the fact that it may go non-performing. So that means I may have to foreclose on it. And different states have different regulations and rules and pricing on foreclosures. Where Texas is awesome, Missouri is great. Go up to Chicago, you're having more problems, right? Northeast is just disastrous. California, some of the states out here have a long foreclosure process, which means that I'm gonna have to hold that property and taxes, everything else longer. So my return is gonna be less. I also have debt license to worry about. So there's different things that go into the note side of buying things. And if you're looking to learn about the note side, feel free to reach out to us. We run a class on stuff about this stuff for note buyers. But you guys as sellers, you guys have to know the fact that every asset's a little bit different based on price of value of the house. If this is a $40,000 house or a $150,000 property, that changes my pricing.
Yeah.
Right.
Interest
Interest rate, my
rate.
pricing.
Yeah. Interest rate is a big deal. Which state it's in is a big deal.
Yeah.
Seasoning plays a part. Down payment to some extent, like Dave
Yep.
says, but loan to value. So all those things kind of go in, and we've got a list of those kind of things.
Yes,
We'll
we're
get
getting
into that.
to it stuff, right?
Yeah.
So one of the things we want to make sure you guys know is that there's a thing called a legal balance too. I recently ran into a seller finance person that was going to sell me a note, and they said, here's the UPB, and we're trying to figure out how they came up with the unpaid balance currently. And what they did is included like property taxes they paid up. Well, what you have to find out is that that's a separate dollar amount, separate from the unpaid balance. The unpaid
Right.
balance follows the amortization schedule, like a T, and then anything extra, insurances, taxes, anything corporate advances is part of a legal balance. When you collect legal balance, you can make an arrangement with the borrower, or if it goes foreclosure, I can add to my balance at the auction.
Mhm.
So make sure you have the unpaid balance there.
So, and then
So-
the unpaid balance, that's, and Melissa, I don't want to pick on you, but just to point it out, that's the problem with apartments.com, is that it doesn't calculate principal and interest. All it's tracking is monthly payment, which is good. And we definitely want to know that number, but we also, because we have an amortization schedule to follow, we need to know how much principal and how much interest is being paid every month, which is where a servicer comes in.
So we're gonna
That's
get,
where
let me jump one thing before we get there.
Yeah.
Just
Yeah.
know the fact that please don't give us PITI. For those who don't know, principal, interest, tax, insurance. All we care about is principal and interest. Why? Tax and insurances are something we don't receive as note buyers. I'm sure like you guys, we don't receive it. You guys may, and then it gets paid out, right? our servicer typically does an escrow and it pays that money out. So we don't see that. All we care about is that principal interest, which does not change no matter what happens with taxes or the insurance part.
Right.
So all these kind of deals of numbers and making sure that you don't receive part payment or you pay, they receive more, and to make sure it applies correctly. Using different services are great. There are software out there to manage these things, right? However, like landlording, we have things called note servicers. Note servicers will reach out to the borrower. They'll send monthly statements to the borrower. They'll resolve issues with the borrower. They'll, if there's a defaulted loan, they'll reach out and try to negotiate with them. Try say mods. They're our property manager in the note world. What they also do is provide a system of tracking the payments. Unlike apartments.com, where it's a rental system, servicer is actually meant for notes. They'll actually have a system where it shows you your payments and what they call a next due date. Like an amortization schedule, if they don't pay for 3 months, the next due date doesn't move until the next payment's made. So if they haven't paid in 2 years, the next payment gets applied 2 years prior. Okay. Where rentalpartments.com, if I say, give me a payment history, you guys will show me a payment history, but I don't know which one that applies to. And there hence the problem, especially if we get to foreclose on it.
And that's the thing. All of that information is important for us for our worst case scenario, which is for us is foreclosure. So we have to have all that information, has to be accurate and correct and up to date so that we can give it to the attorney so they can do the foreclosure. So that's a main focus for us as far as why it's important to track those payments the way that we'd like them to be tracked. And not even that we like, but we need them to be tracked that way so that we can prepare.
If a loan goes into bankruptcy, they're going to want to see the
bankruptcy.
history,
Yeah.
right? If it goes to foreclosure, prove the actual balance of the loan. How do you prove it, right? When payments are all over the place and stuff like that. So one thing, when we ask for our numbers, which we'll share, and we'll share your link to a form we can give you, they'll email you over the whole list of items, is we want to know that you can go to a servicer and get the dashboard. We have Sohal on here. He can explain a little bit if you have questions, where you can really take a picture of the dashboard and it'll tell you all the numbers that we would ask for, right? We'll also provide you monthly statements, notes from the borrower. So if they reach out to the borrower, all those notes are there. So the interactions, and all of us note buyers wouldn't want that information because it helps us know what the life of the loan is going on.
Yeah. Yeah.
So one of the questions we've had too is how much are note servicers? Yeah. Well, so what we don't ever get involved with, because most of our loans are bank originated, is you guys can put these in the note agreement. So
you can have the borrower pay for it, the renter.
Yeah. Mm-hmm. If that borrower pays for it, guess what? Our price will actually be higher. Mm-hmm. Because we don't got to net that out.
Pretty significantly higher too, I believe,
yes.
Right? I mean, it's a pretty hefty increase. I know when Dave and I talked about that note I had for
yes.
sale. I mean, it increased the value of the note by like $3,000 or $4,000. So it was like, oh wow.
Because for the next 10 years, I'm not paying a servicing fee. I'm collecting the whole P&I amount.
Right.
Right. I mean, luckily for me, and we were kind of taught to, when we use our servicer, to put that in the agreement that the servicer pays, or the borrower pays the servicer.
And that servicing fee can be a significant portion of that payment. Sometimes yes, sometimes not. It's usually a flat fee. So let's have Sohail chime in here. Yeah. Maybe you don't want to get into pricing. I don't know, but
which question we refer? There he is. Let me flip it over here. Oh, sorry guys. There we go. Flip over my system over here. So Sohal, welcome. I appreciate you being part of it. I do want to ask you a question about this pricing thing. We would like to know from you, how much does it cost for a note originator to charge for the fee for a monthly servicing for a performing note with Home Key?
So
with us, with Home Key, we have an all-inclusive monthly fee, which is $35. That includes managing, collecting the payment, managing the escrows, taking care of the tax statements at the end of the year. If there is an underlying lien that you need us to manage for you, we will also do that at the same price. There's no additional cost. It's $35 flat fee. We do charge a $100 setup fee, which goes to our service provider for tax certifications and things like that. But $35 is all we charge. And there are servicers out there who may charge a little bit less, who may charge a little bit more, but then it's not an all-inclusive fee. They tend to be more a la carte. The more services you use, the more you pay. The fewer services you use, the amount is a little bit less. In our case, it's all inclusive.
Yeah. So we did a question real quick about what information we need, no buyers to buy. I put in the chat a link for a form, fill it out, and you'll get an email with all the data points we're going to get into in a few minutes, what information we need as note buyers from you guys. Cool. So guys, this stuff is really cool stuff, right? And you can use a servicer like Home Key to set up a situation where you literally can send us the payment history, servicing notes. You can send everything we need, all the data points to get to. But before you get to that, I want to make sure you guys figure one thing out. Please make sure that you're understanding that if you're selling a note that you're into it for 40 grand and we price it 50, understand that 10 grand may not be a big amount, but if you can do that 4 times in 1 year, that snippet of the return is amazing, right? So you got to make sure that your price, when you see an offer from us, calculate that as an annual return versus a one-time lump sum ROI. Because that will dramatically increase your returns no matter what you do. And you could do this, if you could do this 4 times a year, season it for 2 months, sell it to us, season it, sell it over and over again, that 10 grand on 40 multiplies.
And yes, we're more than happy to buy notes from you all through the year, any day.
Twice on Sunday.
I tell you guys a funny thing about the servicer. I was, because I've always used a servicer and I didn't know that there was any other way. I had no idea how much my borrowers actually paying. I didn't even know that they were paying for the servicing. I know we originally put it in there, but I had to actually reach out to Sohail because he services my notes. And I got one of their statements and I was like, oh, well, this makes sense. I was worried about taxes and all this other stuff. And all that stuff was just taken care of by Sohail and just made it so much easier. And again, the borrower paid for it.
Hey, there you go. Excellent.
Nice.
So just looking at some of the questions we got here, what states that servicers cover? Understand the fact that you're right. Servicers are technically licensed in certain states and don't need license in other states. Every servicer is a little different. Some servicers are not in all 50 states, but you may not need all 50 states. If you're originating notes only in Texas, that's all you care about, right? I know Justin uses Sohail and Home Key. If you're originating in Texas, just call Home Key and they can do it. I know Sohail is working on adding additional licenses on, but yes. So yes, states for servicers matter. So I know we had another question from Michelle about servicing services. I would say that your services from your servicer is more about tracking the note, right? They're not going to do they can sign up for door knocks, stuff like that, but they're really just your property manager to collect and deal with issues.
I would have them do have them do more than less. They're set up to handle all kinds of stuff, but you're right, Dave. Mostly it's taking care of the payments and everything surrounding the payments. That's the servicer's main job.
So right now you guys are in Texas. Are you guys looking to get licensed in a few more states as well?
Yes, we're awaiting licensing in Georgia, Tennessee, Ohio, and then in January we'll apply for Florida as well. Additionally, we will enter Virginia, Colorado, and Indiana in February as well.
Awesome.
Well,
And
you're
Sohail's
dancing
very
all around
familiar.
North Carolina. So what is the problem with North Carolina?
I am not a big fan of North Carolina yet. They are a little bit strict. Their audit requirements, from what I've heard from other servicers, do tend to be a little bit challenging. And what's worse is the audits do happen every 2 years at a minimum, and their auditor prefers to come down over to your home office, sit there and audit the books versus just doing it from North Carolina itself, because all our records are online anyway, and we have to pay for their expenses, their flight, their hotel, their food, things like that.
Goodness.
Yeah.
But we do know other servicing companies that cover North Carolina, South Carolina.
Yes.
Oh, perfect.
There's some really good servicers that do cover those states.
Yeah. We'll be happy to help you.
Yeah, I have a list of them on my due diligence portal.jkpholdings.com/servicers. You can find it there, the list. But I want to make sure that you know that Sohal really work with owner finance investors. He understands your world. That's why we brought him on. We work with a lot of servicers. A lot of them will get the paperwork from these kind of people and actually push them away because it's not as clean cut as Bank of America, right? That makes sense for everyone.
It looks a little different. It's paperwork is a little bit different, and they just want quick and easy.
Yeah.
Then there's other ones that'll dig in and look at the actual documents individually, because that often is what it takes.
So Hal, feel free to put in the Facebook chat, also your website too, if you want. I know you're on there as well. Alex asked a question. Any issues buying a note that's in first that has a second, third, or anything else behind it? Are there discounts that come with that? Do you even care about the supported notes? Straight answer, don't.
Not really.
The only time that comes to play is if we go to foreclosure, right? And it actually comes to sale, their notes are going to get paid, but we're going to get paid off as well, right? We're going to get our unpaid balance, say it's 60 grand, and we foreclose on it. We're going to get our 60. We can't collect anything above our unpaid balance or legal balance. Sorry. We can't collect if it sells for 100. We can't collect the equity on that, right? If it reverts back to us, we get the equity, but we don't get the equity or any proceeds above our legal balance because we're not entitled to that money. So these answers, no.
No, don't care. The things that we would care about is outstanding taxes or municipal liens, things like that. Those place above a first lien in order of priority. So those things affect our bottom line. So yes, we care about those things, but any subordinate liens, seconds, thirds, whatever, no, doesn't really make a difference. Man, there's so much more to cover.
Yes, this is great. I love the conversation you guys are having. I love the fact you guys are asking a lot of questions because this is a field I've talked with Justin numerous times and he's still learning what we're talking about at the time because it's a new world of stuff. And we're looking to do a webinar and hopefully you guys all stay tuned. We do webinars every other week, but we've primarily been focused on note buyers and teaching them stuff. So we wanted to, were we working on getting a webinar on there about how to create a note, a successful note to make sure you're licensed correctly. And that's why we'll bring on Max and stuff like that to talk about what you can and can't do, such as the Dodd-Frank laws, right? You can't write a note to an owner occupied property without certain restrictions there. Things like that will come into play. And we'll talk more about that stuff on the upcoming adventures.
Just out of curiosity, Justin, Melissa, have you heard of Dodd-Frank? Do you know what that is? Okay.
Yeah.
Okay, just check.
Yeah,
I've heard
of course.
of him, I've heard of it.
Okay.
But I get that it has its place. Yeah.
All right.
The
No,
biggest thing for me is my understanding is the limitations of how many notes that we can create, that we can originate without having an originator's license.
Right.
So Dodd-Frank is a very big legal document, and there's things that we don't fully understand either.
That's part of it. Max is the expert. I always defer to him when I've got questions. I'll call him and say, hey, can I do this?
That's the main reason I even use an RMLO and an attorney. Just say, hey, here, make sure I'm good.
Yeah.
Right.
Max, if you can chime in real quick, what do you guys charge for underwriting a note to make sure it's Dodd-Frank compliant?
Yeah, great question, Dave. Standard underwrite is $679. And that's a bona fide fee that can be passed on to your borrower. But your borrower can't pay it before being offered a loan. And so one of the lending laws, Fair Credit Reporting Act and Equal Credit Opportunity Act, so FACRA and ECOA, state that you're not allowed to charge anything to a borrower prior to offering them a loan, except for the only fee that's transferable to a borrower up front is a credit report fee. And in our case, we pull the credit for you, so you can't even charge that to your borrower. So a standard Dodd-Frank underwrite is $679. We invoice you in two pieces. We invoice you $119 up front, and then we get with your borrower and we gather all of the documents necessary for a file. We work the file all the way to completion. And then if we can get your borrower to meet Dodd-Frank requirements and certify them, then we would invoice you the final $560 at loan approval. So on the loan estimate, or the old HUD one, if you're familiar with old style lending, that loan estimate, you as the lender have to disclose all of the costs of credit to your borrower. And so that $679 underwriting fee would be added onto your borrower's column as one of their loan origination expenses. So you would front us the $119, we'd get your borrower qualified, and then at closing, that other $560 would actually basically the entire $679 would be a borrower's closing cost. So you can recoup that cost at the closing table.
Nice.
Awesome.
And
Thank you
I
very
know
much.
Max has been extremely helpful for me when I'm doing some originations. And like I said, I've gone to him with questions. Can I do this? Is that okay? And he'll let me know, yea or nay.
And just a quick side note too, Nathan, for anybody that doesn't know, we don't just underwrite for Dodd-Frank. So I do a lot of commercial work and a lot of non-owner occupied work. And so if you're ever in question as to why would you want to underwrite something if the law doesn't make you, I could have a discussion with you and give you a lot of good reasons why. Just in a nutshell, though, a couple of the big ones would be, like, for instance, we have an investor in New York that buys a lot of apartment buildings and basically flips them and resells them to other investors. They can be speculative ventures. We underwrite his borrowers to his standard. That's the beauty of non-owner occupied, is then Dodd-Frank is out of the picture, CFPB is out of the picture, and you and I sit down together as an investment team, and we set the criteria that you want us to underwrite your borrower by. And so what we're doing is we're ensuring your best interest from a risk of default standpoint. The other thing that it's doing is it's creating a consistent due diligence file for your ventures. And then when you want to go and resell those notes to somebody like Nathan and David, we've got files that you can present to those note buyers that demonstrate the professional consistency with which all of your borrowers are vetted. And that can bring a lot of value to your note.
Awesome.
So Max, so for those who don't know, Max is Coley Underwriter. You can go to coleyunderwriter.com. He can talk about all this stuff in much more detail than we can. I know Michelle was asking about that. Sydney, thank you for jumping in there. I appreciate that. So all that good stuff.
Thanks, Cindy. Michelle, I just wanted to come back to your question about, so you actually act like refinancing? Yes.
Yes.
Yes, we want to refinance you so you can go out and buy, create more notes and then sell them to us again and again and again.
Yep.
Take whatever profit. We don't care.
Yes.
We want you to make a profit. We're in it for a different reason. So we're more than happy to have you make a profit off of us, selling it to us, and then you go out and do it again and again and again. And we'll buy those all day long.
Yep. So what makes it a valuable note? We won't get into the legal side of it, but understand the fact that for us, we have performing and non-performing assets, and those need certain data points to figure these things out. We're gonna go through them quickly here, but again, in the chat, there's a whole, click the form link, click on it. You actually go to a form, fill it out real quick for us. Phone number is not required, but that will actually send you an email out directly from jkpholdings.com. If you don't get it, reach out to us and we'll go from there. But what they'll do is it give you a link to either PDF or spreadsheet that you guys can get and actually just fill it out and send it to us if you want to. Make it nice and easy for you. So what do we need? And what do we not need? Let's start with what we don't need. It's comical because in the last couple of weeks, we've seen a lot of notes from several clients coming up to this webinar. I don't need to know what kind of fridge is in the kitchen.
Yeah.
Don't care. I don't care what rehab you did. I don't care the borrower was a locksmith and his grandmother was the mayor. I don't care. Credit score. Oddly enough, I don't care.
We actually care very little about the borrower themselves.
Yep. Because Max or someone else underwrit the paper that it's legal and it's foreclosable. We want to make sure that the collateral is foreclosable. So our attorneys will review it as well, make sure it's foreclosable, legal paper. Because performing assets great, doesn't matter if it performs forever. It matters if it defaults. That's when the paperwork kicks in. So if you have questions, again, feel free to put in comments or send us an email and you'll get that. We also have lien position matters. Why? We talked before about the fact that first, second, third, fourth, we can buy a fourth lien, but understand we're going to buy a significant discount because if it goes to foreclosure and there's not enough money to pay it, we get wiped out. It can happen. Original balance is another item we require. We need to know what the original balance, not what you sold it for, but what the original balance was of the note created.
So after the down payment, what was that amount that you are financing? The amount that you're actually financing.
Yep. Term. What was the original term of the note? Was it 10 years, 120 months? Was it 360 months? Right? What was that term? When was the first payment date? What that helps us do is figure out when the maturity date is going to be. Right? If you originate this date, usually a month and a half later, or whatever it is, we need to know when the first payment was made.
And going back to term, we deal in number of months. So we talk about 240 months or 360 months or something like that. If you just have it in years, that's fine, as long as it's like a round number. So if it's 18 years, that's fine. We'll figure out how many months that is.
But if it's 18 years and 6 months, we need to know that.
We need to know that too.
Right.
Would it not be easier to just give you the maturity date?
So
that too.
Yes. So there's ways to figure out how many months the term is by using formulas and financial calculators. We can, right? And if you're not able to do it, let us know. We can either figure it out for you, or there's different ways to figure out the other numbers through math, through a financial calculator, or through spreadsheet numbers to figure out what that number is. But if you have it, which should be on the note, the term should be on the note, first payment, number of payments, maturity date, and a balloon amount, which we'll get to, right? We need to know the balloon and how much that balloon is for, because if it balloons at a certain date, a certain dollar amount, that changes the monthly payment and the numbers in between.
And we are going to ask for maturity date as well. It helps us just to make sure it's accurate.
Yes.
That there wasn't a mistake where it's 1 month, one way or the other.
Or a modification happens.
Something like that.
And
Or a modification.
Let me ask you, maybe this is a question for Max, but like in a situation where we create a note that's amortized for 30 years, but there's a balloon at 10 years. I've never even done that for the reason of I thought it was more beneficial to put it out for 360 months.
Sure.
It helps the balance.
Go ahead, Max.
Yeah. The biggest issue is there are certain risky features that are prohibited in Dodd-Frank, and then there's other features that you can do them with limitations. If this, then you can do this, but if this, you can't do this. So typically in Dodd-Frank, so we're talking owner occupied 1 to 4 family, you're allowed to balloon after the 60th month. So if you do want to do balloons, just kind of try to think about it this way. The entire spirit, intent, and flavor of Dodd-Frank is to prevent home owners, right, families, from being displaced and creating another 2007 housing bubble burst. So when we talk about putting somebody into a brand new home, you can't put them in a home that next year, all of a sudden, if they can't refi it, they're looking at being foreclosed on and losing their home. And so the federal government requires a certain standard of consistency and predictability with respect to how soon do the terms of this agreement change. And so for Dodd-Frank, 1 to 4 family occupancy, think about keeping them in there for 5 years, typically.
I actually prefer no balloon. It's if nothing else, it's easier math.
Yep.
In general, I prefer not having a balloon. Dave, do you care?
No, I mean, it's a math equation for us.
Yeah.
But it pretty much doesn't matter to me because most likely we're not going to get there most of the time. Understand most loans don't last 30 years. They just either paid off or if something happens to the house, they sell it. So, something always happens. Most people don't hold a house for 30 years. So I'm not too worried about that.
Just so you guys know too, when we underwrite for you, we can always produce an amortization table for you and give that to you right off the bat. So if you're working with Nathan and Dave, that gives you kind of that opportunity to start looking at that thing ahead of time and get a read on what it's going to look like.
Mm-hmm.
Yeah, awesome.
Yeah, perfect.
Question about the form. Feel free to hit the form. It's a brand new form we have. We put it out yesterday. And a caveat, I did have this private message sent to me. No, Nathan and I are 2 different companies. We're just good friends. So we would make 2 different offers to you. That's why we're cooperative, but we're also competitive, right? So, so another thing we mentioned here is that you make sure to give us the P&I, not the PITI. We need tax insurance. You can make it a different row, but just the P&I is what we need. At interest rate, that's a definite thing we need. It allows us to figure out if the payments make sense. It also tells us the loan. If you present me a loan that's a 3% coupon rate, either A, I'm not going to bid on it, or B, if you need me to bid on it, my price would be dramatically discounted compared to the balance of loan. Because for me to get a 3% coupon up to say at 8, 9, 10, 12, 14, whatever I'm shooting for, I'm going to give you a significantly lower payment.
So
most people out there are looking for a bunch of money and they don't care. But understand the fact that for me to buy a $40,000 note at 2%, it must be a much higher UPB, much higher.
Yeah. So general advice, write it at a high interest rate without going over usury laws. Yes. And usury laws are specific to every state. So check that out for whatever state you're in. But as high as you can is great. And that helps us. That helps you get the most money when you're selling it to us. Let's put it that way.
What about taxes and insurance being escrowed? Does that affect the value at all?
Nope.
No.
So if it's not escrowed and you rely on the borrower to make that payment at the end of the year every year, that doesn't affect your risk at all. Okay.
It doesn't. It should, but it doesn't technically. If the borrower doesn't pay it, I have to pay it anyway. And if they default, I'm going to pay anyway. Right. Okay. I can ask them to pay it in escrow. I can always talk to my servicer and get it escrowed if they want to. I can do a mod, but no, it won't affect my pricing now.
One quick point also, when you're talking about trying to get your borrowers qualified, we're talking about debt to income ratio and state specific residual income. Just bear in mind that while you can write a term of almost any number of months you want, it's all usually in your and the buyer's best interest to draw a longer amortization period because as David or one of them mentioned anyway, most of these transactions won't last throughout the term of the amortization anyway. But what it does for their P&I is dramatic in terms of meeting debt to income ratio. So I have a lot of folks send me term sheets, and they'll send me a term sheet with maybe, let's say, 180-month term. And then when we calculate debt to income ratio, these people are over DTI. And simply by getting a hold of the investor and saying, if you'll bump that to 240 or 360, we can save this deal for you. So don't get wrapped around the axle with the idea that I need the PNI to amortize in 180 months or bust, because a lot of times that will bust. But I don't think, and these guys can correct me if I'm wrong, but from their standpoint, 360-month term isn't going to hurt your value at all, but it's going to bring in a lot broader category of borrowers who can meet that requirement.
Absolutely.
Yep.
Right.
Yeah, a 30-year is pretty typical.
Yeah, absolutely. We just price everything according to an annual return.
Yeah.
So yes, you're going to get a different price if there's 20 years left, but it's just a different risk level and return level. So next one we need to know is your type of property. Please let us know if it's land, if it's a mobile home, if it's a condo. What we don't buy is I don't buy land notes. Nathan, do you buy land notes?
I don't know.
Okay. I don't buy things in mobile homes typically. I know a couple of the owner finance people have been mentioning it. There's a little bit different type of note that I'm not familiar with as much as typical real estate and commercial. So that's a little bit different for me.
Same. I don't love mobile homes. I'd look at it, but it would have to be special.
Yeah. So
When you say,
yeah.
quick question, when you say mobile homes with land or in the park?
Exactly. That's the problem.
Yeah. Right. So yeah, mobile homes can be land included. It can be a mobile home with a rented land. It becomes a little bit fishy for us, which we don't get to. One question we had is what kind of note documents need from us? We're going to assume you're the originator, so we won't get into the other note craziness. If you're buying and selling a note to us, we'll need more documents. But typically we just need the mortgage, the note, and for those who are not aware, make sure you get a title policy. Title policy ensures the fact that there's no liens and it's clear title. If you don't, go get one. That makes it more attractive to us. Make sure there's no additional liens prior to the sale of the property.
And it doesn't cost a lot. It's well worth.
So all right. So I have an interesting question. So I bought a house subject to that was owner financed. And I ended up having to refinance it because the daughter came in. Long story short, I ended up having to refinance it with a bank. I almost wonder if I should have just bought that note from her. But if I bought that note from her, how would that affect me selling it later?
Not at all. You can resell it. Yeah, I mean, you could broker it out if you wanted to.
Yeah.
You don't even have to own it yourself. You could sell it to us.
Interesting.
So
and then could I still own that house subject to?
Yeah.
Because that one got really interesting really fast. I ended up offering her, I think we owed like 65 and I offered her 50 and she ended up taking it, which ended up being beneficial for us. And we ended up doing a cash out. But looking back on it, I'm like, well, maybe we should have just bought the note from her and then sold it. And then, I don't know.
Yeah,
you could do that.
But that makes more sense to me.
Yeah, we won't get into it, but basically what you need then is an assignment of that, just like you guys do assignments, but we see an assignment of the mortgage, and then you have the allonge, which attached to the note. That would just transfer from one seller to the next. And if we buy the note from you, we'd be creating that same paperwork that you're selling to us, and you're basically, the note transfer from your name to our name, and it's a paper process. And then we record with the county records. So it's official that the lien transferred over from you to us.
Very easy process. There's just really not a whole lot involved with that. So, yeah.
So as we go down the line, we need the property address, street address, city, the state, and zip code. It allows us to figure out how much the property is worth, so we can figure out these kind of numbers. Maturity date we mentioned before. the current unpaid principal balance, which is the balance of the loan as you move along. Again, if you're using apartments.com, this will be much more difficult to figure out. Recommend moving to a servicer or buying a servicing software and figuring it out and apply payments as per se. Then we
That
also
being
need to,
said,
yeah,
Yeah, if you've got something that you've only ever had with apartments.com and they're, especially if they've been totally regular and same amount every month, send that along. We can do the math on it. It's a little bit trickier, but we can do it.
Yeah.
So if you've got something that, oh shoot, I'm screwed. No, not necessarily.
give us a shot.
Send it along. Yep.
Let us know. Maturity date, current unpaid balance, next due date. And we explained before, the next due date is next date in part of the amortization schedule, not the last payment received. It's based on the amortization schedule. Most time, if it's performing, the next due date's next month. Last payment received, that is just telling us when you get received a payment. It could be yesterday, it could be today. It's ideas. And last two is a balloon. If there's a balloon, we just need to know how much the balloon is and the date of the balloon. It helps us figure out the numbers for us and things like that. The last one is modification. More than likely, you guys have never touched modifications, but if the loan is modified, we need to know the date of it and what that new terms are. Interest rate and balance, all that good stuff. If you didn't change interest rate, that's fine, but all that good stuff is there.
That's
Lots
it.
of
Question
stuff.
about
That's
equity.
what we need.
Go for it.
Again, you and I, Dave, have talked,
Yes.
extensively about equity, and you're not as concerned with equity as I was. I thought that equity and interest rate were like the biggest things that we needed to look at here. I had a note that had a ton of equity, but that really didn't affect the price of the note.
No,
And why that
it's-
is, I'm still trying to wrap my head around. I understand that if it goes to foreclosure, you're only entitled to what the, but does the equity reach a certain point where it stops making as much, stops being as much affecting the value of the note?
Give us numbers. Give us an example if you can.
Okay, so I had a $150,000 house that I had a note on it for $65,000.
Mhm.
That note was worth $55,000, essentially. So I had, $80,000 in equity. The borrower has $80,000 in equity.
Yeah, there's the key.
right.
But in a situation where the borrower only had like say $20,000 in equity, that wouldn't affect the purchase price, how much you would pay for that note.
I would say this, LTV loan to value affects if I'm gonna buy it or not. If you're looking at the fact that my loan to value is 90%, I'm gonna probably pass on it because of the risk of what's going on in the market. It doesn't affect me with my numbers, because if you're saying $85,000 in equity, I have to foreclose on it, which is stupid for the borrower to have to get foreclosed on a property of equity. When you do that, I go to the auction, I can only collect up to that balance. So even if they have 20%, I still can't get the other 20%. I can collect
Right.
up to that legal balance, unpaid balance plus corporate advances. I can only collect up to the legal balance. Now, if it's flipped upside down, right, the property worth 50 and the unpaid balance worth 100, we're gonna be bidding based on that value of 50,000. You're not gonna get much because there's no equity. I'm gonna be bidding 40,000, 30,000. And you say, well, there's a lot of unpaid balance here. Well, I can't buy it because if I go to foreclosure, I'm not gonna get that money back. That property is not worth that much money. The collateral.
And an investor's probably going to buy that. But if there's, and like you said, you'd pass up on it if there was only $20,000 in equity. because
Percentage
if it did
wise,
go, right, okay,
right?
yeah.
If you're looking at, a property that's worth 40, and it was worth 60 and it's for 40, that's a different number than it's worth, 130 and you have a 110 note.
So investors like to buy at 75%. So as long as we're sitting around that 75% mark, we
Yeah,
feel
that's-
pretty comfortable about
Yeah, that
selling.
number's moving as we go along here with the
Correct,
market, right?
correct, right.
Look, we said in the last webinar we had, me and Nathan, when we first got started, we didn't look at equity back in 2010 because there was none,
There was never
Right.
ever equity.
right?
Ever.
Everything was
ever.
underwater.
Yeah.
So for us to now play with LTV, it's kind of a new thing for us because nothing had loan to value.
And that's only been true since probably 2018.
Yes.
That's probably the first time that I saw any equity in any loan that I looked at. And I'm like, oh, that's shoot, what do I do with that? And we had to actually kind of invent and figure out what we're going to do when they did have equity. So the
You wonder
negative
why
equity
that's-
does not scare us at all,
No.
but just understand we're pricing it on the lower of the two. Either
Yes.
if it's underwater, we're going to
Hmm.
base our bid on property value. If there's a lot of equity, we're going to base our bid on the unpaid balance.
So on like Melissa's example, where she has $100,000 house, the borrower borrowed 140,000, you would probably pay only $60,000 or $70,000 for that note.
If the house is worth 100,
Right.
we'd base it off the $100,000.
Okay.
Yeah, absolutely.
Okay.
Yeah, there's more numbers, but yes, that's.
Of course. Yeah. I'm just trying to be as round as possible.
Yeah. Yeah.
Okay. Okay.
This has
That
been.
makes sense.
Again, I put in the chat, what the link is for the form that you can fill out. If you have assets you're looking to sell, if you have stuff, feel free to use that, fill it out, send it back to us. We did cover most of the stuff in that list. If we have to change anything or update anything, we will let you guys know. But we think this was helpful. If you feel this was helpful and you would like us to do a webinar on how to create a successful note, what would make it more valuable, let us know. We'll work on something for January to make sure you guys can include in that. If you're looking to learn about note buying and understanding our world, reach out to. We have webinars and videos, and we also have a intense advanced course. We're starting back up on January 3rd. It's a huge course about how to buy notes, numbers, figuring out things, what's important, all the systems, all that good stuff.
Dave, can I ask another quick question?
Please.
And this is something that I kind of had saved up. I wanted, and I think you just answered it, but I was wondering about how the market's going to affect like the values of our notes. Is it going to affect them
Russell, you're
the
not
same
allowed to
way
ask that question.
That's kind of been my biggest question lately is how that, and I guess it's just affecting the values of the houses at this point, and then you buy based on the values of the houses.
Yeah. So that's why the LTV comes into play a little bit here, because if we're 75 or 60 or 65, whatever the number we figure in our head, if it adjusts down, we know the fact we have some buffer room. But yeah, that's when it plays in part. But the reason we say you can't ask the question is that's our question for you guys. And you guys are new to our webinars and all that stuff, and those who are still on our Facebook Live. We want to ask you guys a question. Go ahead, Nathan.
Yeah, where do you guys see it? So we've got our world, right, where we're predicting things coming in the future. From the seller finance world, how do you guys see the roller coaster? Where is it going?
For me, I see it as an advantage, because if banks are going to quit lending, we'll continue to lend, and I'm sure Melissa can attest to this, where banks aren't lending to a lot of people, we can lend to them. And we can dang near name our price at that point.
Melissa, what do you think? Where do you see the house market going right now in your world? You see values dropping, staying flat? What are you seeing?
Well, that depends, right? Because I own houses all over North Carolina. There's some where the values are going down. But there are some where the values are still the same as they were. For example, if like my house is at the beach, right? They're not dropping in value.
Mm-hmm.
My house is where I live, like in Hickory, North Carolina. Yeah, they're dropping in value, but they're dropping in value at the same rate they do every time this year.
Gotcha.
So I don't really feel like we're going to know what's going on with this market until like March of next year, where we have a full year to look and see what's happened from last year to this year. Because right now, the values are the same as they would be 3 years ago in December, because they always drop about 20% from late September to February, right? Then comes springtime when everybody starts looking for houses and sun is shining and weather is warm, then the values start going back up again. So yeah, all of that being said.
Yeah.
Interesting.
We'd like to hear from outsiders what they see the market of real estate going in the crystal ball 6 months to a year. None of us really know, but we'd like to play that world of that crystal ball idea. But what we really appreciate you guys having your strength of knowing origination in this world of creating dollars magically in thin air. We were trying to bridge the gap between you guys originating and us buying and making that marriage happen smoothly so you guys can go ahead and buy more, sell more, buy more, create more. We can talk about parcels, you can sell par payments, but you can also sell a whole loan and it's more attractive for us. So
well, great. I need some money and I have a whole list of notes that you guys can
see,
Excellent.
it's easy like that, right? You literally can sit there and sell us the entire note and get money out, or not that it's always the most attractive, but you literally can sell us a part of the payment stream next 5 years, 6 years, 10 years, and keep the back end. That's also available.
David, let me ask you guys a question, and then sort of get a gauge on, from your perspective, how the correlation to the Fannie Freddie rates and what note originators can make a rate at, how that's going to affect things. So for example, when the APORs were 2.78, we were creating notes consistently at 8 and 9. So, we were a little more than a 6-point spread over, and it was very easy to do. And borrowers still could meet DTI and residual income at 8%, 8.5%. Now that the APORs in the conventional market are in the 7s or approaching 7s, to get that same kind of spread now, you'd be looking at HCM loans with rates of around 15, which is next to impossible to get. We're getting them in trailers, but we're not really getting them in stick-built homes. And the percentage of seller-financed borrowers that can meet debt-to-income ratio and residual income at a 15% APR is much lower. So if that trend continues with Fannie and Freddie keeping conventional rates that high, how do you guys see that affecting us all in note creation, and then on your end on note buying?
So for me, we have a certain return we have to get, right? And that return is now increasing based the fact that money is a lot more expensive. So for me, my desired return increases. It used to be here, now I'm up here. So my prices got to change. That's my quick and easy answer for it. Nathan?
Yeah, it'll be interesting to see what happens here. Interest rates, inflation, all kinds of things going on in the world. As it makes it more difficult for people to get loans, people like the seller finance crew, they fill a major role. We're at the same time, we're also filling a secondary role. We're more than happy to buy the notes that are coming from the seller finance. At the same time, we're also more than happy to buy the non-performers. So if and when people start defaulting on their loans, those are also very attractive to us. That's both Dave and I, that's our roots, and that's our major thing. So I don't know what kind of pressure is going to be put on to people in general, and where does it all end, and when does it begin? Good question. I don't know, but it's looking interesting.
We did a question on Facebook, and I'm presuming you guys are okay with this. If you're not, let me know. Some of the people want to have your contact information. I will provide emails only. Are you guys, Melissa, Justin, are you guys okay with it? And so Hal's okay with it. For those who are looking to learn, may reach out to you for some education, all that good stuff. If you're okay with it, I'll share your email addresses. To those who just complete the form, I'll do a quick reply on form responses, and you'll get their information.
Awesome.
I
Well,
put
guys-
mine in there too, because I know Dave, you got yours on there, but I don't think mine is actually on your
Oh,
site.
yeah, we forgot that part of it, right? We checked it last night, make sure the form response was adequate. We totally forgot to add Nathan on there. It's in there, but I'll fix the other form as well. I'll make sure, and Nathan gets the responses, the emails for the form as well. So he'll get the email responses and he
Yeah.
can reply to any questions you've got. Justin, Melissa, Sahil, Max, thank you very much for joining us. We're going to cut off the
Yeah.
live feed in a second.
Thanks,
but
guys.
stay on for a few minutes before
you
we
so much.
disconnect. Max, I appreciate it. Your information will be also out there. Guys, if you're looking for a servicer to get your things right, reach out to Home Key. If you're looking for someone to underwrite your loans, make sure you reach out to Max, call the underwriter, and he'll make sure everything happens on the up and up. If you have
We'll do
questions,
another one of these. We'll do kind of a follow-up one in January. More about, I think we're going to do more on the origination side.
yeah,
And
how to make it more attractive, how to make
Yeah.
it legal, making
Yeah.
sure that we have all the stuff needed. So
how to write that so that you can sell it to us at the selling table if you want.
Cool.
awesome.
Great stuff, guys. Thank you.
Hey, thanks.
Thank you.
All right.